Good morning. We're going to get started now. I'm sure some of our friends are still coming in from Virginia. Seems to be something going on, but we're gonna go ahead and just get started. Thank you all for coming here. To everybody online and everybody who's here in the audience with us, thank you very much for joining us for the third annual CMFA conference, Center for Monetary and Financial Alternatives here at Cato. I'm Norbert Michel, and I just wanted to say thank you also to all of my colleagues, really, especially Jen Schulp, who's done a lot of work to put the conference together. We have a great lineup of panels to discuss topics here today, throughout the day, and we also have a chat with Securities and Exchange Commissioner Hester Peirce, as well as a chairman-to-chairman sort of a panel with former Chairman Jeb Hensarling and current Chairman French Hill, House Financial Services Extraordinaire event. It's like I like to think of that one. So our theme for today is right-sizing financial regulation. And, you know, with that theme, which we honestly picked a long time ago, it might seem like we're just trying to kind of dovetail off of the administration's right-sizing efficiency efforts and all that sort of stuff. And I would caution you not, or maybe beg you, not to read too much into that. We're obviously cognizant of what's going on, but we're thinking a little bit more in an aspirational sense than just that. We will talk about efficiency and some of the details. All of those things are critically important, but we here at Cato think about things a lot deeper than that, and we're not going to just do a little bit of that. We're going to talk a lot about that kind of stuff today, sort of the bigger picture stuff. Jen and I have this book, I'm going to shamelessly plug right now. It's outside, blue cover, Financing Opportunity, where we talk about some of the foundational principles behind our regulatory framework and how we think they're wrong. Now, what do I mean by that? Well, obviously, we're at Cato, we're talking about the role of government and what we think the role of government should be, which, of course, is minimal, but that's not really the point here. The point, much bigger, much stronger than that. The point is that we have this framework built on these ideas like the free enterprise system will not work in financial markets. And we need to have a lot of federal backing, implicit backing, explicit backing. And because of that, that opens up the door to having a lot of prescriptive rules and regulations dictating exactly how financial companies, banks especially, have to run. And frankly, we think that that empirically is wrong. It opens up the door to a lot of the things that we'll talk about today, a lot of which is kind of a mess, to be frank, both in terms of just overly complicated and overly voluminous rules, as well as this classic sort of moral hazard problems, and truly just, this is just my opinion, what's most important about that is that it detracts from the opportunity that people are able to provide, the opportunities, economic opportunities that people are able to provide. Deposit insurance is just one, really, I don't think the most important, but just one important example of how we take the private market out. And the whole point of private markets is to come up with ways to negotiate and cooperate and benefit each other in mutually agreed upon exchanges. And it might sound a little boring and flighty, but that's really the whole point. And the more we have the government taking over, the less of that we're able to do on the financial side, on the private side. And we think that's important to talk about. So we will talk about a lot of the details, but we'll also talk about a lot of the bigger picture stuff. Who should be regulating? Why are they regulating? Exactly what should they be doing? How should they be regulating? What should those rules look like? And we'll spend a fair amount of time on that. The trickier part, I think, is that the bigger stuff, right? So hopefully we'll give you a new perspective, because I don't really think that that big picture piece is spoken about too often. I think it's all just sort of taken for granted. And that's what we want to do here at Cato. We want to push that envelope and get those ideas out there. We think they're very important. Hopefully we'll give you a new perspective on at least some of these issues today and end up in a better place. So to get things started, I am going to introduce Ryan Tracy. He is a financial reporter extraordinaire with Capital Account now, and he is moderating our first panel, which is on regulatory design. So that's how we're going to kick things off. Hope that you enjoy the conference today and hope that you can stay for at least most of it. Thank you very much.
I think you guys can come up. Good morning. So this is our panel on regulatory design, and I'm going to introduce these gentlemen. I want to let you know that you can submit your questions via Cato's webpage, Facebook and YouTube, or on X using the hashtag CatoEcon. So the format here will be, I'm going to let each of these gentlemen make a few opening remarks, and I'll ask some questions, and then take questions from the audience and online. So let me introduce our panel here. To my immediate right is Aaron Klein, Senior Fellow at the Brookings Institution, focused on financial regulation. Aaron also served as Deputy Assistant Secretary of the Treasury for Economic Policy during the Obama administration, and before that he was Chief Economist at Senate Banking, the Senate Banking Committee under Chairman Chris Dodd and Paul Sarbanes. To his right is Tom Vartanian, Executive Director of the Financial Technology and Cybersecurity Center, a nonprofit policy organization. He has led the financial institutions practice at 2 law firms, served in the Carter administration at the Office of the Comptroller of the Currency, which is a major bank regulator for those of us joining on X who have no idea what that is. And in the Reagan administration, he worked on the savings and loan crisis at the Federal Home Loan Bank Board. Todd Fox is president of the Visa Economic Empowerment Institute, which is Visa's kind of internal think tank for policy ideas. And he was head of global policy for Visa for more than 6 years. And then on the line, we have Tom Honig. Can you hear us, Tom?
Yes, I do. Thank you.
Tom is a distinguished senior fellow at George Mason University's Mercatus Center, and we, of course, know him better as a policymaker. He served as vice chairman of the FDIC from 2012 to 2018, and before that, served nearly 4 decades at the Federal Reserve Bank of Kansas City, including 20 years as its president. So we've got just a ton of experience and a variety of perspectives on this panel. Really excited to get started. And the topic is regulatory design. I'm going to let each of you take that kind of whichever direction you like. You know, what do you think of our current regulatory design? What needs to change? And I'm going to try to be the chairman of the committee here and keep everyone 3 to 5 minutes. I don't have a gavel, but I do my best. So 3 to 5 minutes, please, and then we'll jump in. And why don't we just go down the line? Aaron, go ahead.
Yeah, sure. So I want to thank Cato for holding this conference and for inviting me and for its continued leadership in a lot of this space, as well as in promoting heterodox thinking. And in that spirit, and given the frame of the conference of right-sizing financial regulation, I want to just start and frame today by being destructive. I want to try to attack a common analogy and framework that is used when we discuss right-sizing financial regulation, and that is that of the pendulum. If you're familiar with this space, you will have all heard this pendulum analysis in which regulation swings between too much and too little. And it is so wrong. And when you start in a wrong framework, it is very difficult to arrive to a wrong solution. So why is this framework wrong? Well, I came to economics as a washed-out mathematician. And when you do a lot of math, you study pendulums. It's a very famous mathematical and physical concept. And the beauty of pendulums is in the conditions that they're structured on, they are symmetric. And they have a fixed point where they will end, which is the correct point. And then the pendulum will swing depending on all sorts of conditions in ways that can be quantified and modeled with beautiful and increasingly sophisticated math. So why is this relevant? Neither of the two suppositions are correct when it comes to financial regulation. There is no symmetry. It is not symmetric, the consequences of over and under regulation, nor are the levels of over and under regulation in any way, shape, or form symmetric. Their distributions aren't, their magnitudes aren't. There is no symmetry in that, one. Two, there is no proper point of financial regulation at rest. There is no end point of the pendulum. The financial system is dynamic and evolving. The correct answers are different. When you guys studied the way the solar system, right, the human thought of the solar system began with an Earth-centric world. Well, now we learn that's wrong. Then there's the sun-centric world. We orbit the sun. Well, that's correct. But the sun is also moving. And so if you ever see one of those videos of like what Earth is really doing, it's turning, it's orbiting, it's moving around the Milky Way, it gets really, really complicated, really fast. And so we simplify that by saying we just kind of go around the sun as if the sun stays put. In financial regulation, we lose sight of things when we buy into this pendulum analysis. We subtly buy into the point. All of that being said, the structures that we've set up in our financial regulatory system are a historical amalgamation of the moments upon which they are created, all of which have long passed us by as our system has evolved, as our star has moved all around the universe. And so we need to think much more radically about how we regulate, the structures of regulate, and the cycle of regulation, and get out of this pendulum concept, which is based on a set of false assumptions.
Thank you, Aaron. Tom Vartanian.
Thanks, Ryan. Well, I come at this probably at the same perspective that Aaron just came. Mine may be a lawyer's or a regulator's perspective, but I think we need radical reconstructive surgery of the regulatory system, because to take your analogy, I think the system we have right now could be called the flat earth theory of regulation. And that it was all created between 1932 and 1940. We've added to it little spit and glue and some Band-Aids here and there, but 1932, the Federal Home Loan Bank Act, 1933, the Banking Act, the Securities Act, 1934, FDIC, National Housing Act, 1935, another Banking Act, 1940, Investment Advisors Act. It's all there, right? You tell me, does the economy, does the world look anything like it did post-Depression between 1932 and 1940? We have a flat earth regulatory system. What do we need to do? We need to do, in my view, and I pull this out of my book, 200 Years of American Financial Panics, which interestingly enough gave me 2 or 3 years to think about what I had done for 45 years in practice and as a regulator. I've been told nobody in this country has closed more financial institutions than me. So I signed off on the closure of 1,500 savings and loans between 1981 and 1983. I don't know what that earns me, but it did teach me an awful lot about why institutions fail, why regulators fail, and we have a system today which guarantees failure. If our regulatory system doesn't work, we will have more and more huge failures, because we have, as Aaron suggests, totally asymmetrical regulation. We have, in the 1930s, banks were 95% of the financial services system. So it made sense to pile all the prudential regulation on them. Today, depending on how you count, they're about 30 to 40% of the financial services system. So we've got 60% outside of a prudential regulatory system doing whatever they want to do, including cryptocurrencies and the Sam Bankman-Frieds of the world. Doesn't make any sense from a regulatory point of view. So what I've suggested in my book and what I'll say here is 3 things. Modernize the system of regulation. We don't need 160 regulators bothering a financial institution every day about what they're doing. We need 1 or 2, not 160. If you take all the state regulators, all the federal regulators, it adds up to about 160 as a minimum. So you got to consolidate those regulators. We got to figure out what role the states should have in a global economy where everything's online. Number 2, the regulation has got to be comprehensive. We can't just regulate part of the business, say, let's over-regulate the banks and under-regulate everybody else. Totally asymmetrical. And it's going to create all kinds of financial crisis. And I think cryptocurrency and stablecoins may be the step that leads us to that next financial crisis. And we can talk about that more. And lastly, we've got to make regulation technologically proficient. When I was closing 1,500 institutions, you know how we did it? Guesswork, right? Who's up next? Who's going to acquire them? We'll sell these to Citibank and these to Equitable. We had no data, right? The regulators today can have so much data from artificial intelligence and large models and algorithms, but we don't give them the resources. We simply don't give them the resources to do a better job. And we're going to have to do that if we want to keep up. And one of the things I have suggested is that we ought to start thinking about moving the industry into regulation. It's worked other places. I don't see any reason why we shouldn't be levering off the enormous capacity of large financial institutions and get that into the regulatory system. Put a Jamie Dimon on the board of the Federal Reserve. We can work out the conflicts. That's not an impossible task.
30 seconds or so, Tom.
And get all of that information into the regulatory system so it can keep up with what's going on. Thanks.
Maybe I can take a more optimistic view, but not a naive one. I think we're on the cusp now of a platform shift in the way we should be thinking about commerce, which gives us an opportunity to step back and ask, does our financial regulation give us what we want out of this technological transformation? There's a healthy tension. I agree, Aaron, not a pendulum, but maybe a very healthy countervailing pressure between two great ideas. One, we want a lot more economic growth. Two, we want a lot of financial stability. How do we make sure that we have systemic resilience in a world where the technology is shifting under our feet? And Tom, as you mentioned, technology can do a lot of things. It can do a lot of damage as well. So what am I talking about with this platform shift? We saw the movement from commerce as a thing that is transactions at the point of sale when you walk into a store and tender cash to card. We saw the transformation of commerce when the internet came online and things could become the conquest of distance with e-commerce, from e-commerce to mobile commerce, and now agentic commerce, where artificial intelligence will be empowered to go and purchase things, not just search, but to actually complete purchase transactions on your behalf. If we would like that system to be a driver for economic growth while maintaining stability, we do have to take a step back and ask, are we thinking about regulation the right way? Now, let me give you an analogy from my world, which is the world of payments. About 10 years ago, Visa realized that the world was changing and that to be a card network was not the kind of future-proof business we wanted to be in. We started laying groundwork with our technology stack so that we could become something more akin to an orchestrator of commerce for our cardholders, but also as a network of networks that could interact in a seamless and interoperable way with real-time payment systems, domestic payment systems, local card networks in different countries. As a result, we're now able to reach something akin to ubiquity, 200 countries and territories with about 11 billion endpoints. Those aren't all Visa cards, but you can send money securely to 11 billion endpoints. How do we now take that orchestration concept and apply it in a world of agentic commerce? The key will be making sure that consumers have trust. From a right-sizing regulation perspective, the key will be interoperability. Just as we have to orchestrate between different systems in different countries and territories, we have to figure out, as policymakers, we have to figure out how to make sure that as the US right-sizes its domestic regulation, it doesn't create an interoperability problem with the rest of the world. And so I'm very excited to think about how we can take this idea of right-sizing and make that part of a global conversation. After all, a lot of the value of this is its applications to enhance cross-border payments and money movement.
Tom Honig, go ahead.
Thank you, Ryan. Thank you for having me. I'm sorry I'm not there in person, but I do appreciate the comments so far. And I want to add a little different perspective, and that is, as Tom said, we've got a history of adding on to regulation over a period of time and then on beyond that. I mean, we have Dodd-Frank well after 1940, and we continue to build this regulatory environment. And I think what we've done is we've also, the part that we're forgetting is we've created an enormous safety net around the financial system that is expensive, that has solicited, in a sense, the need to have increasing numbers of regulation. And so as you look at this, I don't know that you can just, wave one and then have all this go away, but you can slowly, systematically begin to simplify and improve the regulatory environment relative to the safety net. And by that I mean, I have a rule. If you and it's a straightforward rule. If you keep the rules simple and the capital high, you have the framework for greater deregulation. And there's some regulations that where we are right now, you can eliminate them and you would do no harm to the system. I'm going to give you a couple of examples. They're large, they're expensive. One is, of course, the Living Wills project for the banking industry, and it goes elsewhere also. But the Living Wills is an enormously expensive process. It requires lots of consultants working with these large institutions and other, shall we say, super regional institutions. And it has never been used. It is never going to be used because these institutions are too big to fail. And you always have to have the Fed or the Treasury come in to bail them out. So why don't we just eliminate that, have the debate, and simplify? That would be a huge step forward, and we could build on it. The second is the stress test. We've made that into an enormous, expensive project for the industry, and it's all because of the so-called safety net. But it's around the idea that they're going to determine the amount of capital. But the stress tests have had little impact on the capital levels of these institutions in recent years. The major reason that they increased capital was around the great financial crisis when they were wholly undercapitalized. And then suddenly the industry itself decided to strengthen themselves because of obvious reasons. And so we could simplify the stress test, incorporate it in the examination process, and probably save lots of energy. Thirdly, I want to pick another specific, and that is risk-weighted capital. Everyone who knows me knows I'm not a fan of it. It is a highly expensive process, tens of billions of dollars over time, both by the regulators and by the industry. And it has, I think, accomplished only harm. First of all, it misallocates capital enormously. It is a political process enormously. And it is proven to be of very limited value. For example, you put a 100% weight on lending, and if you securitize it and call it a CDO, collateralized debt obligation, in the last round, you give it a very low weight. And therefore, you allocate capital towards, of course, the ability to lever up on those loans in the securitized product. Very risky, but yet given far less weight than an individual direct loan. I think that's one example. Also, government debt, government securities worldwide, in the United States, basically a zero risk weight. And yet Silicon Valley, for example, and other banks have had enormous unrealized losses, and in the case of Silicon Valley, realized losses and a dramatic collapse. So we have the wrong regulations, and we call it the capital. The capital of the industry overall is around 7%. Now, we talk about non-banks industry having an advantage because they're less regulated, but private credit, for all its issues, is better capitalized than the banking industry. And yet we don't talk about that. We talk about how how much market share they're taking away, yet they are better capitalized and able to do so. So what I'm saying is, yes, we have overregulation, and I don't think we're getting a massive elimination of them, but we've got to find and prioritize which serve a useful purpose and which only are a reaction to expanding our national safety net to an ever greater number of institutions. Because when we regulate, we also protect. And that's one of the reasons that the stablecoin industry is lobbied so hard for regulation. It now gives them what I call a foundation. And already there's discussions about stablecoin having to have access to the discount window. So you can see where this goes. When regulation becomes a source of protection, you also get really bad outcomes. And that's my point. So if we want to go back to a market system, before we had the safety net, banks were far more heavily and better capitalized than they are today. And that's where we need to head back to. And then get rid of all these enormous, not get rid of all of them, but simplify these very significant regulations from here forward. So I'll stop with that. Thank you very much, Ryan.
Well, thank you. And what do you think it is, having served in government for so long, about the way that our system is designed that's leading? You just listed, ticked off 4 or 5 different
Ryan,
things.
can you speak into your hand mic? I can't quite hear you.
How's that? Is that better?
It's a little better.
I'll speak up.
There.
What do you think it is about our system and the way that it's designed that's leading to all these, what you see as kind of very imperfect policies and regulations? What is it about the way this thing works, having served in it for so long? Why do these, you just ticked off regulation after regulation after regulation that you're critical of? Is there something in the way that, is there something in the design that's causing that?
Well, I think it's a reaction to an event always, and that's why regulation is so pro-cyclical. You get a period where you have this crisis and everyone says, "Oh, I got to react. I got to do something." So you get Dodd-Frank, or you get the 1933 Act, and in each case, though, the industry did not self-correct. I mean, think about it. Over our long history, the costs of crises have gone up as has the safety net. In the 19th century, for all the crises we had, the cost relative to GDP was relatively minor compared to the savings and loan crisis that Tom referred to, the banking crisis that I was involved in. So you get, instead of saying, well, you need strong capital, and you need to make sure that the rules are enforced, because usually it's because you've had a deregulatory environment prior to that, or hands-off, that leads to the excess. And then when the crisis occurs, there's no capital there to absorb it or to minimize the loss, and you end up with major problems. Now, there's also issues around the Great Depression, I understand, with bad monetary policy and things such as that. But fundamentally, the industry has built this support behind it from a very low-cost series of failures. I mean, they were serious failures. We got the Federal Reserve, then we got the FDIC, we got the SEC, and each one of those institutions become part of, if you have a problem, we'll add more regulations. And the same thing with the CFPB. So what I'm saying is, if you have a simple system, and I don't say that's necessarily easy to accomplish, but if you recognize that it's how much skin in the game the players have that affect their behavior, and you affect their behavior in a positive way by putting more skin in the game on their part, you will have, I think, a good argument for less micromanaging, as we do with stress tests, as we do with living wills, and more of, yes, management is responsible. The stockholders have their skin in the game, and by gosh, they better perform. That's how I react to that, Ryan.
Thank you. And I want to put to each of you maybe another way of framing that question. What do you think the biggest problem is, I think, I'll accept the premise of this conference, which is, that there are things that we could be doing better with this financial regulatory system that we have. What is the biggest problem with the way this thing is designed? If you think about it, kind of the system. And anyone who wants to take that first,
sure.
Go ahead.
The Federal Reserve. That's the biggest problem.
And we will have a whole panel on the Fed later today, but let's get into it a little bit.
So, look, the Federal Reserve, the Greek word telos means one true North Star. Every single entity can only have one number one priority. If I ask you what your number one priority is in life and you tell me three things, you do not have a number one priority. The Fed's number one priority is monetary policy. That's what it's there for. Bank regulation is not a top 3 or 4 policy priority of the Fed. You can look at their top 5, right? It's monetary policy, lender of last resort, economic research and statistics to inform monetary policy. This is the priority. This is it. When you give an agency the incredible power that the Fed has in financial regulation, power that grew under Dodd-Frank, power that has grown repeatedly, and it's not their number one priority, then you shouldn't expect them to do a great job at it. It's hard for an organization to do things that are not their top priority very well. Don't even get me started on where payments regulation falls within the Fed. And look at America's payment system today. So we need to take the Fed out of bank regulation entirely. There's a reason SVB happened on an entity that was head-to-toe regulated by the Fed. So that's the number 2 problem is a culture shift. And this is one where Tom's realism and experience may have led him to the correct answer, and my optimism and relative youth may still lead me to want to believe we can have a world which is not a bailout first world. I may be naive in that assumption, but I still want to cling to a world where we don't want financial stability. We want somebody to break Tom's record in closing institutions because failed institutions should die. And instead we have a world where regulators view they're regulated, as I agree with Tom's framework, that these are my kids and I need to protect them. And no, they are not your children. They are not meant to be protected. We have 5,000 banks in America and now actually more credit unions than banks. That's a different captive regulator story. And some should die. Some are using failed business models. That's a good thing. That means there's healthy competition. A world in which no bank is failing is a failed world. And that regulatory mindset needs to be broken. So that's my top 2, but I hope I've been clear as to what my one true North Star is.
Well, listen, I couldn't agree with you anymore, Aaron. But let me give you, I divide it into 6 categories. Number 1, it's too many regulators. All right? There's just no reason to have state, federal regulators tripping over each other and suing each other. I mean, I don't understand what the public policy, how we are served by the New York regulators suing the OCC over, jurisdiction. Number 2, we have responsibility segmented among so many regulators that nobody's got responsibility for the whole thing. And if you point me to the FSOC, I will tell you there's never been a more moribund, useless organization ever formed in the history of regulatory
But their public
systems.
meetings are so lively.
I know. For my book, I read all the minutes of the FSOC since 2011.
Oh, wow.
And it is mind-numbing. They spend more words congratulating each other over what they do rather than doing anything. And the key point they always make is, there's a fire in that building, somebody better put it out, right? So, number 3, the regulatory system is adversarial. I think we're far beyond a system that can be adversarial and really work. It's got to be collegial. Number 4, it's rule-based, not principle-based, all right? We just keep creating rules, to Tom's point, more and more rules. When I was at the OCC, we had 50 pages of rules. This is 1976, all right? This is when the dinosaurs were roaming the land. We had 50 pages of rules. Today, there's 1,500. Are we that much safer with 1,500 pages of rules? Number 5, Regulation is static. It's not real time. So I write a rule as a regulator. It stays there forever, but the industry progresses past it. The industry said, well, they didn't let me do A, I'm going to do B. And the regulator didn't deal with B, right? So it's always, the industry's always moving and regulation is static. And lastly, to come back to the bailout point, we have a bailout economy. You cannot cite me a financial crisis since the savings and loan crisis where somebody wasn't bailed out, right? The Fed came out and bailed somebody out. The Treasury bailed somebody out. And that has an effect on the markets because now the markets believe that they should take as much risk as possible because they'll always be bailed out. And the more risk they take, the more money they make.
Todd, what do you think the biggest problem is with our regulatory design?
Look, no one would have designed the system we have if we started with a clean slate today. But there's a lot of great things in the world that you could say that about. I think the important thing is, and I'm saying this from the private sector point of view, and also from maybe more of an, looking at the U.S. as a very important market, but part of a global ecosystem. I would say radically changing the system that has built up over time, admittedly, in a somewhat odd way, could cause its own systemic disruption if it's done too hastily. So I would caution some prudence and moderation in rushing to a radical reform agenda. That's one. Two, and here I'm drawing heavily upon a great book by my friends Peter Conti Brown and Sean Venata about the history of bank supervision in the United States. There's this notion of discretion on the part of supervisors, which is something that stands apart from the specific rules that Tom was speaking about. That has also become something that is very much baked into the system in the way that regulated entities think about their own regulators, really much more thinking about their interaction with supervisors. Some discretion there is not actually a terrible thing. But the most important thing I would say, where we could have change now that would have a material impact on growth and competitiveness and potentially even U.S. leadership in the global financial system, is a very mundane thing. But it takes an extremely long time to get licensed to do anything new. And increasingly, we're not even talking about what we want to do at the frontier of technology. It's more just like catching up with what has already been happening. 10 years ago, every fintech company you met in Washington, D.C. was complaining about having to get money transmitter licenses at the state level. And then for the last 5 years, we've been hearing a version of this from the crypto industry, and rightfully so. No one should feel sorry for a big global network that is trying to do business in 200 countries and territories, but for us to make good on what we have pledged to do to different governments around the world, such as enhance financial access and make cross-border money movement better, faster, and more efficient, we need to go to different jurisdictions around the world and get licenses to operate a money movement business, in addition to what we've historically done. That, too, takes an extraordinarily long amount of time. The G20, 5 years ago, set some very ambitious targets around how they wanted cross-border payments to improve. It's not a bad idea to set targets. To Aaron's point, sometimes you need a North Star in life. But the regulatory fragmentation that has happened in that 5-year period has made it all but impossible to implement that agenda. And so I love the idea of moving directionally toward higher risk appetite and a greater focus on economic growth. I think more efficiency and consolidation in the regulatory agencies is a good thing. I think making sure that supervisors are very steeped, not just in the past, but in the technologies of the future. And lastly, I would love to see some common sense movement on the licensing process so that that just doesn't become the impediment. Because, by the way, these are by and large not rejections of license applications because the underlying business idea is bad. It's something more akin to a long wait list. and you just have to wait your turn. Meanwhile, technology is moving so fast, it just means that we're not keeping pace to the extent we could be.
Hey, Aaron, this is Tom. Can I ask, excuse me, Brian, this is Tom.
Go ahead,
Ask
go
Aaron
ahead.
and Tom. I agree completely that we should be trying to address and eliminate too big to fail and all bailouts. But the question is, it's, and whenever you have these situations, it's who's going to absorb the loss is always the issue. And so how do you go about allowing for that? I mean, you have to be able to say, yes, someone's going to take that loss. Who's it going to be? And every time at the moment, since there's the public, the politician does not want the public to take the loss. How do you go over that hurdle to achieve a market economy again, or at least a semblance of that?
So Tom, SVB was so disappointing in that because SVB didn't bank people. SVB had 3 branches. You can look at some statistic, I'll tell you 30, but those are really offices. I'm talking about places with a teller. The size of SVB at its failure was about the same as M&T Bank, which has 1,000 branches. That's a regional bank, 1,000 branches in communities all over. You drive up I-95, M&T Bank Stadium is where the Ravens play. Pretty impressive football organization, right? SVB banked crypto people. Their largest customer was a stablecoin issuer, $3 billion, right? Roku was one of their 10 largest customers. And the regulators and guys like Bill Ackman, who stood to lose a lot of money, who were very rich, and Bill Ackman was running around crying like a 3-year-old on Twitter, save me, save me, save me, and they folded. And it was sad. And if you can't have the will and culture to impose losses on venture capitalists, and by the way, I have Roku, I depend on Roku for TV. My Roku was going to work over the weekend. This idea that small businesses were going to close and all this is nonsense, okay? What was going to happen was the Roku corporate treasurer was going to get a beat down because he'd been searching for yield in SVB, and if you really uncovered it, there was probably some quasi-suspect rider in their venture capital agreements on SVB's venture capital arm that somewhat required them to put their money at SVB. And there could be questions about tying and steering and loopholes in that thing in one of the deregulatory bills, Graham Leach Bliley, which are also cyclical. You made the point about regulation being cyclical. I would come back and say deregulation is equally cyclical. And, it's a culture thing. It's an addiction to bailout. And, I think the biggest junkie on the block is the Fed. They were the ones running for the bailout. The FDIC tried to close SVB normally on Friday afternoon, and the Fed was clamoring for the bailout, and by Sunday, the FDIC had gone along. I mean, that is just a fact as to what happened that weekend. People ignore those little distinctions, but the actual closing of SVB through normal processes on Friday afternoon was real, and it set off a Bill Ackman panic attack.
Tom, you raised an excellent point about the whole bailout situation, and there is sort of an incongruity because my own personal view is there has always been too big to fail banks. There always will be too big to fail banks. It's just a fact of life. On the other hand, we can't have an economy where people think everybody will be bailed out all the time. So the question becomes who gets bailed out and who doesn't. And I think there's a very fine line there that we have to run, and that is we have to have an economy where people are allowed to fail when they do a bad job. With respect to the largest 5 or 6 or however many banks that we're never going to take over because they're too big to fail, I think they have to be regulated, and I have to think they have to be charged according to being too big to fail. I think we have to just say they're not going to fail, and we have to regulate them accordingly. And that may not be perfect, but the world we have today isn't perfect either.
Well, how would you charge them? How would you make them responsible, though?
Oh, I think you have to deal with their capital. You have to deal with their liquidity. I mean, I think it takes a lot of thought because there's an interesting book came out about the time my book came out. It's called The Rise of Carry by 3 economists at MIT, I believe. And they really talk about this point a lot, Tom, and that is what is What have we done to the economy by bailing everybody out? And they call the Fed the largest too big to fail bank.
I think there's a thing where fundamentally regulation is about judgment. And one of the limitations in Congress is you can set up laws and you can give discretion, but you can't frame judgment. And I on my way down here, I was listening to another podcast about the Progressive Era and Teddy Roosevelt, who is among one of my favorite presidents. And, sometimes there's just a judgment call, and you have to have the fortitude to do it. And sometimes you're right, and sometimes you're wrong. It requires that. If we didn't have the judgment and courage to let SVB go, which is not one of the biggest banks, right, which doesn't bank people, right? It's just very wealthy venture capitalists and startups and other things which are important. But if we don't have the judgment to let them suffer losses.
But I don't want to make the whole panel about SVB, but didn't the equity holders of SVB get?
The stock went to zero as opposed to Bear Stearns, which went from $2 to $10. Okay, but the debt holders were made whole. The unsecured depositors. There's a person right now who's going to pay an overdraft fee because that bank has a higher deposit insurance assessment, and we know that those assessment things get sent down the ladder. Adam Levitt and other research that showed to be able to fill up the FDIC's coffer so that Bill Ackman can be bailed out, and so that the stable coin could do that. And Tom, I share your concern. I see a path for the next bailout, which is stable coins grow, they buy a lot of treasuries, there's a run on one of them, and we don't want to bail them out, but the treasury market is so absolutely critical, we have to save the treasury market, and that means we're going to bail out Trump's stable coin. And I see that with the clarity of a person who lived through Bear Stearns and AIG and Lehman, and it terrifies me.
Well, that's a good segue to, or Todd, do you want to jump in before I move on?
I'll make a very brief intervention, and maybe just to speak up on behalf of the smaller financial institutions. A certain amount of creative destruction is a good thing in any market, in any economy. We're in the Cato Institute, and this is like doctrine for us. But I have to say, as I began my remarks today, I shared that we're undergoing like some massive technological disruptions that are happening not just to finance, but to commerce and the economy overall. There is a way for the technology that is being built today to actually become delivered on a level playing field so that even small financial institutions can nevertheless offer their consumers the same level of trust, security, and ubiquity that large financial institutions, the so-called too big to fail banks, can offer. But it is a scale business. And so what we would love to see is a situation where technology can be delivered in a scalable way, but in a way that levels the playing field, so that no financial institution, as long as they're doing a good job of serving their customers, should be denied the ability to give their customer, whether it's a merchant, a small business, or an individual consumer, the ability to play in what is increasingly an AI-powered, tokenized global payment system.
So it strikes me that if we're talking about the way to design a regulatory system, there are some problems we're going to have to deal with. One is, how do you give the industry some input without letting the industry run the show? Another is, what about the input from elected officials, the president, Congress? And those two things aren't unrelated, obviously, because elected officials and industry are talking to each other. So, and we're dealing with these issues every day in the system we have now, so it's not exactly a discussion that's completely in the clouds. I want to get into both and each of those, and we've got some questions online that are kind of in this direction too. And why don't we start with the industry and Tom Vartanian's provocative point about Jamie Dimon being involved in writing bank regulations. And I'll just say, there was a proposal from your colleague at Brookings there, and Tom Wheeler, former chair of the Federal Communications Commission. My last beat was covering tech policy, and a big question in the tech industry is, how do you regulate these giant companies, these tech giants? And he suggested, we really do need to have more industry input if we're kind of designing a new system. His idea was something along the lines of, and I'll probably botch the details, there should be a body of industry people who are sort of formally advising the regulators, having input on them and making recommendations, and they're the final, maybe not making the final decision, but really more formally involved than they are now. So, Tom, why do you think Jamie Dimon needs to be involved in writing bank rules?
When I was doing research for my book, I was looking for examples of what I'll call cooperative or collegial regulation. And I found a few examples. Plane crashes, for example. They put together task forces of industry and regulatory people. Why? Because they want to lever off the expertise of the people in the private industry. The Biden administration actually put together a cybersecurity task force that was supposed to be comprised of both regulators and industry people. Why? Because you want to get that technological expertise into the industry. I think, I've said this a few times, I think banking regulation is probably a decade behind the banks in terms of technology, maybe 2 decades, right? And that shouldn't be. When I was representing companies like Goldman Sachs and Lehman and others, all the Wall Street companies through the firm I was in, I was impressed by the fact that they would tell me every night they went to bed, they knew the market value of the company. They knew the market value of that company. It was mark to market every day. And I said to myself, man, if I was a regulator and I had that information, wouldn't that give me a better footing to be able to do that? And then you look how regulation in the banking world works, and you go to a board meeting where the regulators come in and they say, we examined you last year and we found out you violated a rule 2 years ago. And I'm saying to myself, in a real-time environment where money is moving at the speed of light, that system can't work anymore. So how do you make all that work? And I think you take all those ideas and you say, look, let's bring industry. Let's not make this a totally adversarial approach. Let's bring industry into the regulatory process. Let's lever off their abilities. Let their staffs advise the staffs of the regulatory agencies. And you know what? I think we can figure out how to deal with the conflicts. When there's an enforcement issue, I think we know how to cut people out. But I think the experience and the expertise is just too valuable to leave aside. And so that's where I put Jamie Dimon on the board of my new Federal Financial Security Commission, regulating banks, savings and loans, securities firms, cryptocurrency, and anybody who touches money that can have an effect on the stability of this economy.
Yeah, I saw your eyebrows raised when Tom said that earlier.
Well, I was going to say, on your list, where are the consumers? So finance is a means product, not an end. Finance links savings and investors to borrowers and useful of currency. It's very important, right? When you make a car, the car is the end product, right? When you make finance, you're bringing together. It's an incredibly useful thing. And our economy has financialized tremendously. It's one of the reasons, Tom, where I was a little turned off by your 19th century analogy as a share of GDP, because we've financialized so much of our economy. I think we might have over-financialized, or put a different way, just like in the 19th and early 20th century, the railroads and the networks that were able to extract rents between the farmers and the miners and the users of those consumption, because a railroad is a means, a transportation is a means, but it's not an end. They didn't build the product, they didn't sell the product, they just moved the product. Finance does that with money. So in your world, I kind of like, if you're going to have the industry be more engaged, and we can debate the notice and public comment process, we can debate the laws that are currently there. I would argue industry is more involved in writing the rules than consumers are today. But I would say, where's the place for the users of the financial products? And I would say that we need to hear more of them, because if you think about politics as countervailing constituencies, one of the things that was very eye-opening to me in Congress was I thought you were having battles of ideologies and parties. And one different way to look at it is battles of constituencies. And if you have a great idea that has no constituency, one, how great is your idea? But two, you're probably not going to go very far. If you have a really bad idea, but it has very powerful and sometimes opposing constituencies behind it, it can move really quickly. And so, you know, I think in your list of bringing the overarching thesis I read in your question was, how can we make regulators less on an island and more engaged and influenced by the constituencies of the people they regulate? I would really prioritize the users of the financial system, not just the operators.
Yeah, let me speak to that point for 1 second, because when I started the Comptroller's Office, I was a consumer protection attorney, and I wrote all the truth in lending interpretations, and I'll tell you what I learned, and you can take this for what it's worth. I learned that when it comes to protecting consumers, you need, because of the absence of financial literacy in this country, you need a protector for each consumer, and you can't do that.
So I think that's totally wrong. The most financially literate people are often the least income. They budget on a daily basis. It has nothing to do with financial literacy. When I was looking at my research, and this is a story you would always hear, like, why do people go to check cashers? Well, they're financially illiterate, they don't understand the bank, blah, blah, blah. They don't have bank accounts, that's the other thing, right? Well, my research uncovered, thanks to the FDIC survey of the and underbanked, 70% of people at a check casher have a bank account. They know extremely well that the check casher costs them $20, and they know the bank cashes the check, quote unquote, for free. But the bank, if you deposited your check on Friday, August 31st, didn't have your money available until September 4th. And for these people, they couldn't live on your deposit is pending over Labor Day weekend. They couldn't pay their bills on the first of the month. An overdraft was $35 and the check casher was $20, and you only pay the check casher once. And so it is not a financial literacy problem. It is an architecture of the financial system that if I need to turn my check into money on Friday afternoon, these are my choices. I'm making the best choice with the structure available to me. And the people that budget the least frequently are generally the wealthiest.
If I may.
That's what we're talking, are we talking about, so we are obviously talking about different kinds of regulation. Safety and soundness is one issue, consumer protection is another. And I've been focused on allowing the banks to operate as independently as possible by having a stronger balance sheet around safety and soundness. I think beyond that, when you get into the consumer part of it, it becomes obviously more tricky. That's why you now have the CFPB because of failures in the past. So when you say streamline, we ought to be defining what it is we want to streamline. And I think the safety and soundness part of this can be streamlined enormously. I'm not so sure, given recent events, whether or not consumer protection can. So I just ask you, is there a difference there? How do you approach it? I don't know.
I mean, if I may, just protecting consumers from fraud is Visa's North Star. And it's what we wake up every morning and go to bed every night obsessing about. To put it in perspective, and maybe this can help put the whole regulatory redesign conversation in perspective as well. In 2023, I saw some data that suggested that the total size of cybercrime globally is about $7 trillion. That's projected to be $10 trillion this year. So putting that in perspective, it's like half of US GDP. A much larger economy of cybercrime, were an economy, would be much larger than most of the G7 economies. And the fraudsters, the scammers, the cyber criminals have access to very good technology at very low cost. All the artificial intelligence that we can use to make commerce more secure and frictionless, bad people can use to impersonate someone, to engage in various really insidious scams to take their money away from them. And so when it comes to consumer protection, this is the area where I've been spending the most of my time, is really thinking hard about how we can make sure that the consumer is protected and secure against these scams. So this is an area where I think it's a new frontier. It's not exactly financial literacy, but it's something akin to digital hygiene. It's the training that you get when you join a regulated financial services firm, but you don't have as just an ordinary person or a small business owner. And so to the extent that we can think about right sizing, one area that I would suggest is too small in what our current government apparatus is doing is educating the American consumer on how to protect their data in a digitally connected world.
So I want to agree. I want to recommend a different podcast from The Economist that looked into the failure of a bank in Kansas. So after SVB, I was kind of obsessed with who will be the first bank that will actually be allowed to fail and bear their losses. And the answer was this small bank in Kansas whose CEO, who'd been the president of the Kansas State Bankers Association, got crypto scammed. He got pig butchered, and he sent the entire bank's capital to this scammer through Hong Kong, borrowed from the home loan bank. He was able to run to the home loan bank and quickly liquidate their portfolio, no questions asked. And then that community lost. And I think it's very important to understand that there are uninsured depositors in this tiny bank in Kansas that lost because their CEO, who by all accounts was a multi-generation, smart, sophisticated person, got pig butchered. And the great thing about this podcast is they find the scammer who did it. And basically, the scammer who did it kind of in a lawless part of Myanmar is like, oh yeah, we used to grow opium, but that's like a really long and expensive way to addict people and take their money. It's much better to run these server farms and try to hook one person, and then you can get $20 million in this.
Indeed. And if I may, let's not blame the underlying crypto technology for this.
Oh, absolutely. No. I mean, I'm not blaming the wire scammer that did it. Blah, blah, blah. What I'm pointing out, right, it's a get-rich-quick thing. It's as old as it's been. What I'm pointing out here is the idea that the people that are being scammed or unsophisticated is false. The idea that the regulators are protecting people based on some moral structure and value as opposed to how connected and big you are and, whose board the SVB president sat on and who Bill Ackman's friends are is false. And I'm also pointing out the magnitude of this cyber scam, which I'm agreeing with you, Tom, is radically growing. I think, meanwhile, we're asking banks to fill out SARS on local pot shops, right? But not investigating the growing thing on elder abuse, fraud, and other things where banks are actually, structuring and filing. So we have all of our priorities wrong. And I couldn't underscore and agree more on the point of this as a growth magnitude, particularly the international movement of money, where there is no way to get it back.
That's right. We would love, as Visa, to be able to take the security and trust that we've built up in the card world, which is now being applied in a world of non-card payments, and really make sure that the identity, which is increasingly turned into a digital token, is protected and that the consumer has absolute trust and security in this new world. And that becomes directionally much more important when the consumer is willfully empowering an AI agent to go and transact on their behalf. So we're in a completely different world in terms of technology. Likewise, moving money into a tokenized form, moving money onto blockchains creates opportunities to solve many of the problems. And Aaron, you've written beautifully about this with just the long lag between when I initiate payment and when the beneficiary actually receives it. Perhaps that's a use case where, as we think about stablecoin, this could radically improve, both domestically but especially cross-border, with a particular focus on emerging economies. Again, if the U.S. is looking for an opportunity to lean in and lead on this, they've got one. The G20 chair is now the United States, starting in 2026. I would submit that the best pairing for a domestic focus on regulatory right-sizing is an international focus on regulatory interoperability, and the impetus for doing so is this exact issue.
Yeah, but we have a president who'd rather sit at the Kennedy Center and do an event on the draw of the FIFA World Cup than travel to South Africa to attend the G20. And I think it's very hard to lead the G20 when you're threatening to invade your neighbor to the north who's a member. I mean, the flippant things that get laughs on Twitter also undermine your ability to bring an international coalition. So in theory, I agree with you. In practice, you have to deal with the world that you have, and it's going to be very hard when you're threatening to invade Canada and Greenland and deprioritizing G20 global meetings to then say, oh, you know, we're going to lead this coalition to do this really difficult and technical thing.
I think that the important point on international coordination is we need to get out of the mindset that this is somehow ceding sovereignty to Basel, but rather that this is an opportunity to make sure that the different regulations that are happening around the world that do impact on U.S. growth and competitiveness are at least compatible. If we get to full harmonization in our lifetime, that would be amazing. But a version of U.S. leadership in this space could simply be applying the concept of regulatory interoperability.
And I want to take us back to the other side of what I was thinking of, and it's we've got a question in the chat about the impact of the politicization of the left and the right, of financial regulation, and you know, I want to go back to this concept of independence, and maybe Tom Honig, you can talk about that, because we've got an administration in charge now that thinks about this differently. And actually, in my own writings about this, I don't say independent regulators anymore. I say so-called independent regulators. And should we be worried about that, Tom? Or is that a good thing?
Most certainly, I do think we should worry about it. I think it's been an issue since regulation began. There is always a political pressure on the regulator to do something that serves a constituent's advantage. And it can be industry-driven, it can be individual party-driven. But the fact of the matter is, that's where maybe Aaron's point of culture matters. And that is that the regulator understands the rules, understands the law that they've been given, the rules that they may have written, and then enforces them, shall we say, equitably across all these issues. But too often, you get, and it happened when I was at the FDIC. I know it must have happened to you, Tom. You get groups coming in, arguing their case. This has to be done this way. You get the phone call, you get the letter from the various political individual saying, you know, you need to be doing this. We're going to start this investigation. So, you know, I tell people you can't be independent if you don't act independently, and that's the strong part of the culture, the commitment to being a objective regulator, and that's again where I come down to if you keep you can't make everything as simple as you would like, perhaps, but you can make things simpler than what we tend to do. We tend to write very complex rules that can be gamed more easily. The complexity invites gaming. And so I keep saying, keep the rules simple, but we never do, because we have to think of every contingency. Well, general principles, as someone said, I think maybe you are, general principles have to drive it, but then that individual institution, that regulatory, whether it's the SEC, the Federal Reserve, or the control of the currency, has to then enforce it equitably, and it has to be understandable to both the party being regulated and to the regulator. And I think that's where we've messed up. These rules are so impossible that they can be gamed, and the regulator becomes more of a pawn to be worked with or worked around than an enforcer of the rule that everyone understands. Yeah, I think it's a real problem.
We have lost an incredibly important feature of regulation because of the politicization of regulatory agencies. I mean, when I was at the Comptroller's Office in the 1970s, I don't think I ever heard or smelled a whiff of politics in the office. I don't think anything, what we were doing was about safety and soundness and what was right for the American people. And now I think it's become so politicized that, you know, I think we've lost that kernel of independence, number one. And number two, I think we're being threatened with losing the expertise that's in the agencies. I mean, the reason we have agencies is because those are the experts. The people on the Hill aren't the experts, right? They write a lot of letters suggesting that they're experts, but they're not the experts. The experts are in the regulatory agencies because they've been there for years and years. They know the nuts and bolts of regulation. And if you're going to trust their judgment, right, and I know this is a complicated area because they're not elected officials, so on and so forth, but if you're going to trust judgment, you got to trust somebody's judgment, and I would opt for an expert.
So let me just say two different things because I'm kind of a little bit split on this, right? First is the Trump administration is putting the chief economist of the CEA on the board of the Federal Reserve with the advice and consent of the Republicans in the Senate, just passed 1311 out of committee. This person is being given a term that after 4 months is indeterminate at the president's leisure, and he is not resigning as the chair of the CEA, which is unprecedented.
The White House Council of Economic Advisors for the...
Correct. So he's the president's chief economist, and he's going to be serving on the board of governors of the Federal Reserve at the same time. And he has said the White House ethics has blessed this. By the way, the Federal Reserve has been very silent on whether its ethics allow this. It has its own ethical rules. It has shown the courage of a turtle mating with an ostrich in terms of standing up for its own independence over the last few weeks. And I would love to know whether its rules allow for this or whether it's changing its rules to allow for this as it becomes subsumed as part of the Trump administration with the advice and consent, it appears, of the Republicans in the Senate. So the independence of the Federal Reserve is going away. And that ought to concern us for a variety of economic reasons. On bank regulation, let me just push back a little bit, Tom, because I had a different experience. I was on the TARP Investment Review Committee at Treasury. We were deciding banks that were on the border of whether they got TARP or not. And there was this bank that had a really low grade for management. And this is, I see Bill Nelson who's written on this and BPI about the subjectivity that was described in the Camel's ratings on management. And when you went into this bank, the quote-unquote problem with its management was that it had too many, in the opinion of the supervisor, it had too many branches and too many employees, and it wasn't profitable enough. By the way, its earnings, its assets were fine, its liability structure was fine, it wasn't maximizing profit. Well, when you ask, well, why wasn't this bank maximizing profit for its shareholders? It was because it was owned by a tribe. And the tribe said, if we maximize profits, we have to give everybody a check in the tribe. And instead, we want to give people jobs to work at the bank. And I tend to believe a job is a better thing than a tribe. And I also tend to believe that, well, I know tribes have sovereignty and they're free governments and they can make their own decisions. Nowhere is it written in a bank charter that you must maximize profits if your shareholders want to do something else, if your management wants to do something else. But this bank regulator, this expert, was so captive by the ideology of profit maximization that it continually downgraded the bank's management to the point where it was ineligible for TARP funding by this regulator's judgment. And that's a different type of politicization, and it makes me sad I was outvoted in the review committee to give this bank TARP because it's a different, and I don't know if that's politicizing, but what I saw were agencies captive by an ideology with no accountability, implementing this in a way that was clearly destructive to the entities that it was supposed to be managing. And I wondered how many other banks have had these similar management problems in their Camel score.
Aaron, you just defined politicization. TARP was a political action, and there was money at risk. That means it becomes political. That means lobbying becomes important. I know there were many issues. You know, Barney Frank was involved, and he had all this. You made it political by these constant bailouts, these constant safety net expansions that go on. So yes, we've expanded the safety net, and yes, we've expanded politicization because there's money at stake. And when there's money at stake, there's lobbying and there's all this game state. So what I'm saying is we made the rules complex. TARP was enormously complex. It was there for a very few, but to make sure everyone was treated fairly, politically speaking, it was expanded broadly. And it was a bailout. It was part of a bailout. But I'm saying what we need to do is, I mean, look at the banks, the TARP, the amount of money the TARP was put, it was as much as the banks had paid out in dividends as the great financial crisis started. That's political. And what do? You undermine the very foundation of a private system, and that is capital, the ability to withstand unexpected shocks. And so I keep saying, keep the rules simple and the capital strong. And we keep doing things that say, well, no, we have to have leverage, so we grow the economy. And what we do is we undermine the very structure that we're supposed to be protecting. And that's where I'm saying we need to take these rules and simplify them and make the system more accountable relative to the investors involved.
Well, I want to thank all of you. We're at time now. Thanks for the lively discussion. Great conversation. We're now going to take a 15-minute, or I guess it might be a little shorter than that, break. Please join us back at 11 a.m. Eastern for a fireside chat with Commissioner Hester Pierce of the U.S. Securities and Exchange Commission, moderated by Jennifer Shope, the Director of Financial Regulation Studies at the Center for Monetary and Financial Alternatives at the Cato Institute. And thank all of you very much.
Thank you.
Good morning, and welcome back to Right-Sizing Financial Regulation. My name is Jennifer Schulp, and I'm the Director of Financial Regulation Studies at Cato's Center for Monetary and Financial Alternatives. And I'm thrilled to be here this morning with SEC Commissioner Hester Peirce. Commissioner Peirce has served as an SEC Commissioner since 2018, and prior to that, she conducted research on the regulation of financial markets at the Mercatus Center at George Mason University. I'm going to stop there and not give the rest of your background because I want to put you in the mindset today as a financial researcher in addition to being an SEC Commissioner. So we don't have too much time. I'm going to jump right in. We will be reserving a few minutes at the end for audience questions. You can submit questions online via the Cato website or on social media using the hashtag CatoEcon. And we will also be taking questions in the audience. So get your questions ready. But let's go ahead and jump into the conversation. And kind of putting on that broader financial researcher hat, I'd like to ask you the question that is on the minds of this conference, which is what really should the goals of financial regulation be?
Well, before I start, I better give my disclaimer, which is that my views are my own views as a commissioner, not necessarily those of the SEC or my fellow commissioners. I mean, as an SEC commissioner, I have a defined goal set by Congress, right? So protecting investors, facilitating capital formation, and fostering fair, orderly, and efficient markets. But I think when I think about regulation in general and financial regulation specifically, I think about wanting to preserve the maximum realm of freedom for people to engage in transactions that they want to engage in, and then really only stepping into the middle of that when there's a reason that you have for stepping in the middle of that, whether that's a market failure or which a lot of people cite market failures when there aren't actually market failures, but if it's a market failure or if it is something else that you think you're worried about the integrity of the marketplace, right? So there might be a reason to step in the middle of that. And then we have a disclosure regime, which I think could be done privately, but we've chosen as a society to do that through government regulation. And so the idea is to give people the information they need to make decisions for themselves and their families. And so those are really the functions that I see of regulation. It shouldn't be overriding private decision-making unless we have a really good reason for doing that.
So, say here at the Cato Institute, I spend a lot of time pointing out places where we are overriding government, or we are overriding individual decision-making. How well do you think our current financial regulatory system is accomplishing the goals that you've set out?
Yeah, I mean, we have a very complicated financial regulatory system. And I think another piece that I should say is we want to keep barriers to entry low, because one of the things that's the best disciplining force on the marketplace is competition. And so the higher you raise the regulatory barriers, the harder it is for people to come in or for existing incumbents to try new things. And I think that's an area where we could really do more work, which is to try to make it easier for people to come in and try new things. And that does mean maybe taking a look at some of the accretion of regulation over time. It becomes very easy to just add more and more regulations. It's hard work to adopt a regulation, but it's also hard work to get rid of a regulation, and so they tend to just pile on top of each other. And so I think we could do a better job just thinking about that. We could also do a better job in trying to adopt more principles-based regulations, which stand the test of time better than very prescriptive regulations. But again, that's easier said in theory than done in practice. So, I think we have people say this all the time, but I do think it's true. The capital markets in the U.S. are the envy of the world, and I think part of the reason is that we've tried to get that balance right on regulation. You want people to be able to come into the marketplace and know that when a company is putting out financial statements, you can rely on those. That's important, but you also want to make sure that people have the freedom to do things. I think we've done a pretty good job at that, but when I look at the rule book and I see how big it is, it depresses me.
It's a pretty depressingly large rule book. We talked about the individual rules here and the accretion of rules over time. Is there anything in kind of the structure of the system or the character of the system? And when I say character, you gave a really powerful speech last year about kind of the openness and responsiveness of the SEC to its regulated parties. So you said sometimes they come and they just hear crickets instead of talking to the regulator and having that open dialogue. Is there anything in the structure or the character of the system that we should be focusing on in order to, make it work better for the market participants?
Yeah, and I think when I look at regulation, it's important to remember just this basic principle that we as regulators work for the people. And why is that important? I mean, of course we work for the people, right? But I think when you get into a position where you have regulatory power, it's very easy to forget the fact that you work for the people. And that doesn't mean that you say anything goes, right? We have a set of rules. They should be applied uniformly. People should comply with those. But it is important to remember that we're only working if we're working to make the systems serve people better. And that does mean that we have to have an open door to come in and hear from people. I know that as a regulator, it's often hard to learn things about what's actually going on. And so one of the great privileges of this job is that people are willing to come and speak with me and tell me what the challenges they're facing are, what the opportunities there are, what's really going on in the markets. And I also enjoy the fact that people on the staff are willing to talk to me. So I get to hear from a lot of people, but it can be very easy to shut the doors to the agency and say, we don't need to hear from you. And in fact, during recent years, there was people complained to me about the reputation of the agency, that they didn't feel they could come in and say, hey, here's something we're struggling with, we're trying to comply with the rules, or we're trying to offer this new product or service and we don't know how to do this. Can we work with you? And that was where people were getting crickets. And so really opening up the doors, and I think the new chairman is sending the right signals on this front. We want to work with you. The staff that we have at the agency are very smart, educated people. Part of the challenge, exciting challenge of the job is that they get to think about how to make the rules work with the scenarios that are arising. So we really want to have those conversations. We want people to come in. And I think that's the piece of the character that we really need to keep preserving, is this is supposed to be a joint project, right, with the people and the regulators to have the markets regulated in the way that works for this country.
And one of the things that we need to make sure that we can preserve is the ability of, say, entrepreneurs, market participants to continue to innovate and to continue to move further down the line, wherever that may be. You mentioned the SEC's three-part mission at the beginning. We often hear investor protection, capital formation, and fair, orderly, and efficient markets. There have been some proposals, including a few on Capitol Hill right now, to add to that mission and to add innovation to the mission. Is that something that is needed in order to allow the agency to support innovative changes in the marketplace?
I think it could help, and you might think, well, why is adding one word or a phrase, fostering innovation, important? But it is very natural for regulators to say no to people who come in and want to do things in new ways, because if you say yes and it doesn't work out, people are going to come running and saying, you regulator, why did you let this happen? And if you say no, it's really hard for people to measure the cost of the saying no to innovation. And one of the things that really does make life better for investors and for companies that are trying to raise capital, is when people do come up with new ways to do things, new ideas, new ways to serve people. And so an integral part of investor protection is actually fostering innovation. But because we have tended, and again, we're not unusual, but we at the SEC, I think, have tended to downplay the importance of innovation. I think sticking it in the mission would be a good reminder that yes, that is something that we should be thinking about, and we should be working toward that end. That was one of the main reasons that I wanted to come back to the SEC as a commissioner, because I thought that was something that we needed to improve at the agency, is thinking about innovation.
Thinking more about innovation, I would say I'm impressed. I've gotten 10 minutes in without mentioning crypto. And this doesn't have to mention crypto, but innovation has been kind of at the core of some of the arguments as to why crypto should be given a clearer regulatory framework. You've been very busy with that heading the crypto task force at the SEC. And one of the proposals that you've made relates to regulatory sandboxes as a way to kind of foster more innovation and to deal with some of the issues that you just talked about, where it's hard to measure the cost of failing to allow innovation in those processes. So can you talk a little bit about what regulatory sandboxes are, how you envision that, and how you see it helping to create a better regulatory environment in financial services?
Yeah, and for those of you who hear sandbox and you think this is sort of not a very attractive model, because we should live in a world, I've said I prefer beaches to sandboxes. Like Sandboxes are places where children play and the adults sit on the outside watching them play and maybe directing how they play, whereas a beach is a place where people are free to do what they want. There's a lifeguard sitting there trying to make sure that no one drowns, but really there's the lifeguard isn't hopping off the lifeguard stand to micromanage the building of a sandcastle. So I have in the past really resisted the use of things like a sandbox. My former colleague wrote a book called Permissionless Innovation, Adam Thier, and I think we really need to preserve the spirit of permissionless innovation in the United States. I work in a very regulated industry, and that means that in reality, a lot of innovation does have to get permission before it can move forward. And so the idea with a sandbox is that you have the ability for people to come in and say, hey, here's what we're trying to do. We want to build something that's a commercially viable experiment. Because if it works, we want to keep going. And so you need to have on the outs, and the incoming, you need to have pretty big flexibility to design the experiment the way you want. And then there needs to be a way out so that you can get into a long-term regulated world, and you don't have to stop your experiment when the sandbox period is over. So I think design of sandboxes really matters, and that's something that I've been thinking a bit about. The chairman of the SEC has been talking about an innovation exemption, and that's something that we're thinking about. So we have tools that Congress has given us. We can give people exemptions from rules. Sometimes we condition those on certain things. So if we want to make sure, of course, that there's going to be investor protection, that we're seeing if problems are developing as this product or service is being offered. And so there are ways to condition these experiments. And then you can also just give someone a no action letter, which is typically from the staff at the SEC, and it's saying if you do things the way you laid out in your letter, which again, it's conditioned on things, we will not recommend an enforcement action. And that's a way to let people try something different. I think one important piece too of sandboxing is you can do things iteratively, so someone can try one thing and then someone else can come in and say, yeah, I know they tried it with these 10 conditions, we think it would work with these 9 conditions instead. And so it allows you to see how things work, and it gives you a little bit of comfort that you're building on precedent. So that's some of how I'm thinking about sandboxing.
I'm going to shift gears a little bit and say a little bit about regulatory design, but in the practical context. We often hear about kind of the regulatory competition between the SEC and the CFTC. And that if we were designing a system today, this division probably wouldn't exist as a first choice option. But what we have now is a system where we have securities regulation at the SEC and derivatives and futures regulation at the CFTC. The lines have blurred a lot over time as to what those products look like. And I think there's been a marked change over the course of the past 9 months about the level of coordination and joint activity between the SEC and the CFTC. I would say particularly in the crypto context, but I don't think not just in the crypto context as we're looking forward. Can you talk a little bit about the thinking there and about how you see the need for coordination between these agencies and how that looks going forward?
As an initial matter, I don't think that a little regulatory competition is a bad thing. It can be a good way for us to see if we're not doing things maybe as effectively as another regulator. What are they doing that we're not, that we could maybe look to and model ourselves on? But I do think that the American people, again, expect us as regulators to work together. We're all serving the American people, and so we shouldn't be in a game of, let me see if I can grab your jurisdiction, and when I turn around, you steal my jurisdiction. That shouldn't be how it works. And so coordination is important. We are now really committed to doing that, and I think it's good to have crypto pushing us toward that, because Congress clearly thinks that both of us have a role to play based on the drafts that we've seen of legislation so far. Both of us have a role to play, and so we need to work together. The CFTC has had futures products on crypto for a long time now, and so that has been instructive and helpful for us, and we need to work with them around those kinds of issues. I will say, though, that we have had periods, I mean, we've had a long time to work out our relationship, and there have been times where we've had a pretty good relationship. There are other times when it's not been so good. But in my memory, when I came to the SEC as a commissioner, we were still trying to finish our security-based swap rulemaking, which is a mandate that came out of Dodd-Frank. The CFTC had largely finished their swap rulemaking at the time. The products are very closely linked, and so you want to have consistency in regulation. A lot of the same players are involved in those markets. And so we worked closely with the CFTC and with Brian Quintenz, who's the nominee to be chairman of the CFTC. He was then a commissioner. He and I worked closely together to try to have harmony. It's not to say that regime is perfect. It still needs work on both the security-based swap side and the swap side, but we were able to work together productively. We even had a joint meeting between the two agencies. And so I think that going forward, what I'm hoping is that we work closely together, especially as the market structure regulation for crypto, legislation for crypto gets finished. We'll need to really work hand in glove to make sure that the rulemaking gets put in place in a way that makes sense.
Is this type of regulatory coordination a model that other financial regulatory agencies should be following? In the first panel, we talked a little bit about the myriad of banking regulators, the state-federal problem that if you're in the financial services industry, you might have upwards of 160 regulators that you're trying to placate at any time. Should coordination be...
I'm not sure I like the term placate, but yes, I see your point.
Should coordination be something that should be a higher priority across the financial regulatory system?
I think it should. I think one of the frustrations that I encounter with people in the marketplace and even investors is they just don't know who to go to. It's really even hard to know that, and I think if we did a better job coordinating, that could be helpful. The reality is that it's a very complicated landscape. You've got, as you said, the state and federal, but you also have international, and it can be very overwhelming. And that's one of the things that makes me sad, because I think a lot of people just say, I'm not going to do anything in the financial regulatory space at all because I can't even figure out who to go talk to. And so I do think that we ought to do a better job coordinating. I'm going to put in a plug. We're having a roundtable coming up, SEC CFTC roundtable, to discuss some of the issues that we have to work through. And that will be, I think, September 29th is the date, but you can find it on the SEC website, and that's something that will be open to the public.
Great. Say something to definitely tune into. You mentioned international regulators in that kind of mix of regulators that have to be, considered when engaging in financial services. We're going to have a panel later today that's going to talk about federalism and financial regulation. But in many ways, kind of this international regulatory question raises a lot of the same issues that we think about when we're thinking about federalism and competing regulatory regimes that might impact the provision of financial services. You've been speaking a lot about international regulatory considerations lately, talking about cross-border regulatory sandboxes. The chairman has been speaking a lot about international regulatory issues as well, cross-border task force on financial fraud, his speech yesterday in front of the OECD, financial regulators. How should we be thinking about the design of financial regulatory systems in the international context? Is it competing regulatory regimes? Is the US out there trying to win it all? How should we place ourselves in this conversation?
Yeah, the international discussion is always interesting because we are sovereign, so we shouldn't have international regulators or bodies of international regulators telling us what rules to write. I think that is problematic, and that's something that I've pushed back against. But at the same time, our markets, the markets that I regulate, are very international, and so we do need to work with our fellow regulators. We have these bodies that do bring us together to do that. We also have a lot of bilateral connections. And I think that's good and important. And I, as you said, I've suggested having some sort of cross-border sandbox so that someone who wants to offer a product or service in two countries could work with both regulators at the same time to try to figure, assuming there are only two regulators, there might be more, but so that you could have, you could launch in both countries at the same time. I think there's some value there. But again, I also think that there are areas where we're really very different than our European colleagues, for example. So the US is very heavily reliant on the capital markets for funding things, and I think that's beautiful because it means that you're not so reliant on banks. Banks tend to, I would say, they're not as open to people who are coming, say you have a great idea and you want to fund that great idea. You can go to the capital markets. You don't have to have rich family and friends. You don't have to know the banker down the street to get that funding. Other countries are much more reliant on bank funding. And so it changes the dynamic of the place. And then another thing that's changed, I think, the dynamic across the jurisdictions is in Europe, there's a lot of focus now, and not only Europe, it's Asia as well, but there's a lot of focus on sustainability, on ESG type issues. And so, okay, I mean, that's fine. People can invest whatever way they want. But the problem is that they're trying to bake requirements around sustainability into the financial regulations. It's as a way of driving capital toward the uses that regulators have decided in their wisdom are going to save us from climate change or save us from whatever other ENS type issues they've identified. And my pushback on that is always, we have real problems in the world, and the Europeans have identified some of those problems, but the way to solve them is not to stick a bunch of financial regulators in a room and say, where can we, direct the capital to go? It's to let the markets identify the problems and figure out organically how to solve those problems. And so the best thing that you can do as a financial regulator is actually not try to control where capital goes, but try to make sure that your regulations are written in a way that it will go to its highest and best use. Now that means sometimes those uses will be in the US, and I want the US to be a place where people want to come and build things. I want it to be a place, it always has been, where people from all over the world are coming to study and learn and build things together, because this should be the freest place to do those kinds of things. But we can't let regulators in other jurisdictions that want to write rules that will direct capital toward favored purposes, we can't let them be the ones to write our financial regulations. And I mean, the truth is that when you start putting financial regulators in the driver's seat for where capital flows, it ends up just being driven by who has the ear of the financial regulators, right? So it ends up being exactly the kind of system that is totally not consistent with the American way of doing things, which is that people get rewarded by merit, not by who they know.
Commissioner Peirce has graciously agreed to take a few questions today. And I'm going to start with an online question, and then we'll go to the room if there's any here. We have an online question that says, you mentioned market failure. There is also regulatory failure. From inside the agency, what factors and forces best promote regulatory accountability?
Well, I think that is certainly true. There is regulatory failure, and I'm glad that the questioner raised it, because often what I hear is, well, Hester, there's a market failure, so you as a regulator need to come in. And my response is, well, you're assuming that that we can design an effective regulatory solution, which we may not be able to do. And so you do have to take account of regulatory failure as a possibility. So one guard against regulatory failure is the notice and comment rulemaking process, where you are trying to get people to weigh in on the proposal that you have, and then you can reshape it in response to those comments. But obviously, people on the inside and on the outside can't see the future. So you also want to have a mechanism for testing whether your regulation is working as intended. I think there are ways to do that. I think you should tell people up front what you're trying to achieve with the regulation, and then you can go back 3 or 5 years later and say, hey, is it working as intended? Maybe it's having great positive unintended consequences, or maybe it's having terrible unintended consequences, and then you can adjust the rule for that. But I think it is really important to remember that, yes, there are market failures, but there are also regulatory failures, and that is why we can't just assume that, we shouldn't rush to regulatory solutions assuming that they're cost-free.
Absolutely. Any questions in the room? Let's go right over here.
Thank you for the chat. It was pretty insightful. I did want to ask that you mentioned the failures or your criticism of European models of baking international issues with that of their financial system. And I wanted to ask if, in your opinion, you have gained any influential or important insights from other financial institutions that the United States could potentially adopt?
Yeah, so I think we can always learn from what other people are doing, and I think that that's something that I'm always paying attention to. You know, on crypto, as an example, foreign regulators were more out front, especially Europe. They came up with a regulatory framework for crypto pretty quickly. And I was impressed that they were able to do that because they have a complicated system there for making law. So then watching how that's being rolled out and what the challenges are that are arising from that, what the successes are, I think that has been helpful. And so I'm always, you know, thinking about ways we can learn from others. We talk a lot about financial stability with regulators from across the world, and there can be really helpful insights. What's going on in your country? How has this worked in your country? Sometimes it turns out that something that has been done somewhere else, it's a real cautionary tale for us not to do it, but in other instances it might be something that we can change something here based on.
We've got time for one more question. So kind of in the middle here. Of course, pick the hardest place to get a mic to.
Ömer Akin from Ministry of Trade of Turkey, and also I'm doing JD at GW Law School. I would like to, thank you first for these insights. And second thing I would like to ask is, normally in financial industries, industry is faster than regulatory institutions because they have to be competitive, they have to be innovative and, problem solver. And they are quicker than the regulatory institutions. And rulemaking itself is a slow process. Therefore, you need their insights. You need how to address these new problems coming. And then when you do that, actually you are exposed to regulatory capture. So they may, influence you to not regulate properly. So how you can address this issue? Thank you.
It's a good question, and it's important to think about those issues about regulatory capture. I think the rulemaking process is slow for a reason. It's slow for practical reasons, but there's also a good reason to be slow because you want to have predictability in the market so that people can build a business and know what the rules are and know that if the rules change, they'll have notice for those changes, they'll be able to weigh in. And so I think that deliberative process is really helpful. With respect to regulatory capture, it is something that I worry about, and you worry especially about, less about regulating too little because of regulatory capture, but about putting in a regulatory framework that works really nicely for the large incumbent who's able to come in and talk to you all the time and is terrible for everyone else. And so it erects a nice little fence around the industry and keeps everyone else out. And so one way to combat that is to have as principles-based rules as you can, to say, here is the objective that we're trying to achieve. You go figure out how to achieve it. One firm might achieve it one way and another way, and that makes it harder for any one firm to keep all its rivals out. But it is an important issue that we have to think about.
Well, thank you very much, Commissioner Peirce, for taking the time to talk with us today.
Great to be here. Thank you all.
We will be back in 15 minutes at 11:45 for a panel talking about the Federal Reserve as a financial regulator. Welcome back to Right-Sizing Financial Regulation. I'm Jennifer Schulp, the Director of Financial Regulation Studies at Cato's Center for Monetary and Financial Alternatives, and I'll be your host for the rest of the day. We already started off talking about the Fed as a financial regulator in our first panel, so I'm a bit excited to continue that conversation now. To those of us who aren't in the thick of bank regulation, the Federal Reserve is often thought of as the engine of monetary policy. But the Fed's role extends beyond a traditional central bank role of setting monetary policy to also a more traditional regulator of the banking system. The Fed's been making a lot of headlines lately, from questions about interest rates to Fed independence to bank capital requirements, which now makes this an excellent and interesting time to talk about the Federal Reserve's role as a bank regulator. We've assembled a great group of experts to discuss that topic today, and I'm pleased to introduce Victoria Guida, who is an economics correspondent at Politico and the author of Capital Letter, a reported column focusing on policies shaping the American economy. Victoria is going to lead our conversation, and I'm going to turn it over to her. Victoria.
Thanks so much, Jennifer. And I think it's always a good time to talk about the Fed's role as a bank regulator. Before we get started, I do want to say we will be taking questions from the online and in-person audience. So think of questions that you might have as we go through this. The online audience can join the conversation and submit questions directly on the event webpage, Facebook, YouTube, and on X using the hashtag CatoEcon. For people that are in the room, please speak clearly and directly into the microphone. So with that, I want to introduce the panel, which Jennifer set us up really nicely for. Next to me, we have Heidi Schooner, who is a law professor at George Mason University. Then we have Jay Kadia, who is here at the Cato Institute, and then Sean Campbell, who is at the Financial Services Forum, which represents some of the CEOs of the largest U.S. banks. So great range of expertise here. So to start us off, we have Jay. Everyone's gonna do a presentation.
Sure. Can everyone hear me okay? Perfect, okay. Well, thanks for having me. I'm looking forward to contributing and learning from this panel. As Victoria mentioned, I'm Jay Kadia. I'm a research fellow here at Cato Center for Monetary and Financial Alternatives. My training is primarily as a macroeconomist, and I mostly write on monetary policy and macro finance issues. So keeping that in mind, I think there is actually a lot of scope to discuss the spillover between the Fed as a regulator and its monetary policy authority. Now, the Fed has, of course, been involved in bank regulation way back to its founding, and more officially since the Bank Holding Company Act of 1956. But I think we can all agree that the primary role of the Fed is monetary policy, right? And I'm certainly not here to advocate that it should be its primary role, but given that in 2025 the primary role of the Fed is monetary policy, I think the best thing to do is to save monetary policy from as many distractions as possible, right? Now, given that, unfortunately, there's this conflict of interest between the Fed's role as a regulator and its role as the monetary policy agent. This conflict of interest can be particularly severe when the Fed engages in disinflationary monetary policy, predominantly increasing the interest rate, which unfortunately makes financial conditions worse for firms. Sorry. And the raising of interest rates, unfortunately, can expose vulnerabilities in financial institutions, particularly those with security mismatches and long-term interest rate exposures. The most obvious example of this, of course, was Silicon Valley Bank in March 2023. And it's unfortunate because the Fed was, of course, one of the regulators of SVB, but also in charge of the same policy that led the bank to fail in the first place. Now, of course, when the Fed is both in charge of monetary policy and in charge of regulating financial institutions, there's an implicit trade-off between saving one to save the other. And we can get into that more as the panel goes along. Now, it's particularly frustrating because the central bank doesn't need to be a financial regulator. There's at least two other federal financial agencies that can do that job, the OCC and the FDIC being two examples. The OCC, for instance, solely exists to do financial regulation. So it could easily subsume the role of the Fed in that. Now, of course, as the Fed becomes less independent and there's more political influence on the Fed, this conflict of interest is likely to only get worse. And we want to make sure that we disentangle these things before that actually happens. Now, the financial system and monetary policy would work better, both of them in isolation, with less bureaucracy and less confusion. So I think it's time to end or drastically curtail the Fed's regulatory authority. I'll keep that for now, and then we can get more into that as the questions come along.
Great place to start us off. Heidi?
Good morning, and thank you to Cato for putting together this panel. Like Jay, my introductory comments are going to focus on the structure or architecture of financial regulation. This is something I've studied for many, many years, along with many others, and I can tell you two things about the study of financial regulatory structure. One is that structure matters, but it's not determinative of outcomes, either positively or negatively. And secondly, that there's probably no perfect model. Even given that caveat, I have always tended toward the Twin Peaks model of financial regulation, which leans into this idea of two consolidated financial regulators, one peak being the consumer protection market regulation regulator, and the other being the prudential regulator, financial stability regulator. The Twin Peaks model does not answer the question of the central bank's involvement in financial regulation. The first country to adopt the Twin Peaks model is Australia, and they have not housed their prudential regulator within the central bank. Contrast that with the UK, which more recently adopted the Twin Peaks model, and their financial stability and prudential regulator is housed in the Bank of England. So to me, the strength of the Twin Peaks model, and some of this was discussed in the earlier panel, is that single mandate idea. So I believe that the single mandate model both avoids some of the conflicts that Jay was alluding to, and thereby enhances accountability. So with all of that as a backdrop, I just want to highlight a few observations about the Fed. And I'm going to start with, quickly, I promise, with the low-hanging fruit, and then get to maybe some of the stickier issues. So on the low-hanging fruit side, I would say, is the Fed's role as a consumer protection regulator. I really see no compelling reason why the Fed should be involved in financial consumer protection. Long before the, well, not long before, but before the CFPB was created, I wrote in favor of consolidating financial consumer protection in the FTC. Obviously, that didn't happen, but also the CFPB was not created as a consolidated regulator, I think, because it wasn't politically feasible. I think still that a consolidated consumer financial regulator probably makes the most sense. Moving on to micro-prudential supervision, so the kind of supervision that focuses on the insolvency of individual banks. I believe that the central bank's macroeconomic perspective can enhance microprudential supervision. Among other things, this is because the central bank traditionally has a more counter-cycle attitude, whereas bank supervision has often suffered from this pro-cyclical tendency that, again, was touched on a little bit this morning. Post-financial crisis, there has been greater emphasis on counter-cycle supervision through stress testing and capital rules. But again, sort of low-hanging fruit, and I think Jay might talk about this later, I think that the Fed doesn't need to be a bank supervisor for the 600-plus state-chartered community banks. Given that the FDIC already supervises state-chartered community banks, it seems like that would be an easy consolidation. Now that moves me toward the macro-prudential, so looking now at the more issues of systemic risk. I can see the logic in retaining the Fed as a bank supervisor for large banks and bank holding companies, but I also appreciate the conflict, again, that Jay will probably talk more about. The conflict exists that when you're combining that supervisory function with both monetary policy and central bank lending. Certainly the FSOC is Dodd-Frank's answer to the risk posed by non-banks, systemic risk posed by non-banks. But once the FSOC got out of the business of designating firms, it essentially became a recommending body only. And I doubt there's anybody that's going to champion that designation process today. But what we're left with is certainly not a model of accountability when it comes to systemic risk in the non-bank sector. Lastly, I'm just about done, is to me one of the most important issues, and again was touched on a little bit this morning in this morning's panel. Some would sacrifice the Fed's independence on bank supervision in order to preserve the Fed's independence on monetary policy. I'm not going to wager that trade-off, but I will say that the independence of bank supervisors has long been an international standard as reflected by the Basel core principles of effective bank regulation. So again, I'm not going to wager what that trade-off should be, but I believe that bank supervision will suffer if independence of bank supervisors is lost.
Thank you so much.
Okay, great. Thanks very much for having me on the panel today. I really look forward to the discussion. I guess my perspective is just a little bit different from the ones, and we'll kind of get into this conversation, but I'm a little bit more focused on as the financial regulator that the Federal Reserve is today, what should it be focused on in the near term? And I think that has some interplay with some of the points that my two other panelists made. So, in thinking about what the Federal Reserve should be doing as a financial regulator as it kind of looks ahead, given where it sits today, there are basically 5 points that come to mind. So the first issue is I think that it's really important, and some of these points were actually raised in the previous fireside chat by Commissioner Pierce, or Peirce, I guess. So one thing that the Fed should be doing is should be thinking about reviewing and assessing the large bank regulatory framework. Basically 15 years after the financial crisis and 5 years after COVID, both the financial crisis and actually COVID resulted in some very significant changes to the regulatory framework for the financial system and the sort of structure and composition of the financial system, which are actually quite sort of fundamental and monumental. And it's really important in the wake of big changes like that we take a look back and we sort of ask whether or not the system that we've created and the system as it exists today is working to achieve the intended purpose of regulation. And I think that's a really important thing to be doing. There are some signs that that's beginning to occur at the Federal Reserve and other regulators, so that's a positive step forward. But I think definitely some definite and concerted attention should be brought to bear on that basic question. Relatedly, but not the same thing, is that I'm an economist. As an economist, I believe that you should always be engaged in ongoing assessment and performance measurement. And I think that's as true in the regulatory sort of sphere as it is in other spheres of life, in particular monetary policy. So if you think about the Federal Reserve now regularly evaluates its monetary policy framework and it asks basic questions about, do we think that framework is working? Is it achieving the goals that we want to intend as a central bank? And I really think that a similar effort should be conducted by the Federal Reserve and other regulators too, but we're talking about the Federal Reserve today. That should be conducted by the Federal Reserve on an ongoing basis to understand whether or not the regulatory framework that they are designing, overseeing, executing on is, again, achieving its intended purpose. And you don't necessarily need to wait for either a financial crisis or an earth-gripping pandemic to make that kind of assessment. There should be an ongoing review process that's data-based and just trying to think about where are we today and are we in the right place. Thirdly, I think the Federal Reserve really needs to be committed to sort of maximum transparency in the regulatory framework. And people have been talking a lot about the Fed recently, and especially about its independence. And something that I was reading recently that really resonated with me is that the independence of the Federal Reserve is not something that it's endowed with, rather it's earned. And I think that's really important. And one of the ways that you earn independence is basically by engaging in an open and transparent manner with the American public. And I think so it's really important that the Federal Reserve exhibit maximum transparency in its regulatory framework and other frameworks as well. And when I think about transparency, what does that mean? I mean, when the Fed does something, it should say, what are we doing? Why are we doing it? What is the impact of, what is our expectation for what the impact will be on the entities that we regulate in the broader economy? And sort of answering all those three questions in a fulsome database manner is really actually quite important and something that the Fed should be committing itself to be doing on an ongoing basis. Two final points. Coordination. So this actually is somewhat related to your point on consumer financial protection, but it's also more broadly relevant for financial regulation. It is true that in the United States we have what I would call a decentralized sort of regulatory framework on the prudential level. We have a lot of prudential regulators. We have, and they have sort of different motivations from public policy and legislative rationales, but they're all sort of operating on largely the same set of financial institutions. And it's really important for matters of both efficiency of regulation and the effectiveness of regulation that regulation be coordinated. So I think it's really important that the Federal Reserve work hard to coordinate sort of its regulatory activities and its sort of overall regulatory view across the system, across all the relevant regulators. And then the final point that I'll leave everybody with, and I think this does bear on some of the questions that were raised by Jay in particular, is that I think we need to think, the Fed needs to think broadly about the evolution and the regulation of the entire financial system, not just the banks, not just the banks that it regulates, but much more broadly. And there are two subpoints here that I would make just to get the conversation started. So the first is that the makeup and composition of the U.S. financial system has changed massively in a short period of time. So if we think about the way the world looked on the eve of COVID, just thinking about the Federal Reserve, I'm old enough to remember when the Fed's balance sheet went from $1 trillion to $2 trillion. And I remember people saying, wow, that will never happen again. And then we had this little thing called COVID. And in the wake of COVID, we went from something like, I won't have the numbers exactly right, but I'll be in the right ballpark, 4 or 5 trillion up to 9 trillion in like a quarter. And we've brought it down some, but the Federal Reserve is a massively larger institution and is massively more significantly engaged in the financial system today than it was even just 5 years ago. At the same time, the U.S. government has massively increased, basically its debt issuance at the same time. And that has important implications for the composition of the financial system. So if you look at any standard metrics of the composition of the financial system and the way that it looks today, it doesn't look anything like the way that it looked 5 years ago. And that has important implications for the way that we regulate and oversee the financial system. But the financial regulatory architecture that we have is basically the financial regulatory architecture that we built after the financial crisis, and before that it's 50 or 75 years old. And there really needs to be some serious thinking about those changes. If those are durable changes to the financial system, there may well need to be durable changes to the way that we regulate financial institutions and the whole financial system. And then the final thing is, again, in the evolution of the financial system, and this is something that's going on, so I think it's encouraging, but we really need to think seriously about how the evolution of the financial system is occurring over time and whether or not we're getting the financial system that we think we want for maximizing sort of growth in the economy, but also safety and soundness, and in particular, the mix between banks and non-banks. So 50 years ago, banks would have made 75% of all loans that you see in the economy. Today, they make less than half. And that's not necessarily a good thing or a bad thing, but it's a thing. And it's occurring, and the evidence is that that trend is only accelerating over time. And we really need to think about those developments and what they mean for growth in the economy, financial stability in the economy, and how we should be regulating the entire financial system and not just banks.
Great, a lot to dig into there. I want to start with you, Jay, because I feel like the theme across what all three of you are talking about is sort of the effectiveness of the Fed as a regulator. And, kind of jumping off what Sean was saying about how the Fed should be looking at how it thinks it's doing, what are the hallmarks that show us that regulation is working? Like, it's easy to point to crises as, oh, something's clearly gone wrong here, but how do you know that regulation is doing its job?
Well, I'm not sure that it is, especially because we have so many overlapping regulators, so it's hard to identify which specific one is keeping financial stability in place. Take the Fed, for example. I brought up SVB, and I completely agree. I don't like looking at outliers to make decisions about policy. But SVB was under the specific purview of the SF Fed. They looked at the books. The Fed itself admitted that it was a policy failure or a regulation failure. So I'm not exactly sure that you can make this claim that we've had a very successful regulatory regime, America is a very resilient economy, especially its financial sector. So how much of the success of the financial sector is because of that and its representation of the goodwill of the US economy versus how much of that is because of regulation, I'm not sure.
Sean, you used to work at the Fed. What were your sort of guiding lights of trying to figure out whether you were doing your job well?
So again, my perspective is one of an economist, and I did spend a good number of years working inside the Federal Reserve, and I really think there's, the right answer to that question in some sense is not very, it's not very sort of sexy or innovative, which is there needs to be focused attention to research and analysis to basically assess the impact of the regulations in the broader sort of financial regulatory structure that we operate in. And I think there's good evidence that that is going on, and to some extent that's being effective. So, a recent example that comes to mind is thinking about the impact of leverage requirements on the financial system in the US economy. And I think that over the past, let's say 5 years or so, I think there's actually been a really good amount of sort of important empirical research which has brought to light the direct impact of leverage constraints on banks, the banking system, and the broader economy, and the impact of basically leverage requirements on intermediating financial markets such as the US Treasury market. And I think a lot of really good research has been published in that area, and I think it's been influential for thinking about the direction of policy in some of the changes that we've seen being proposed. Now that's a particular example that is a little bit episodic and idiosyncratic, but I think that's a case study that can be useful for thinking about how you broaden this out, which is you need an ongoing measurement program that's committed to thinking seriously about assessing the impact of financial regulation on an ongoing basis with respect to key variables that matter for the economy. And having worked at a financial regulator, the Federal Reserve, as you mentioned, it's a very difficult job, and the reality of the situation is that the press of policy is such that people are working on financial regulatory issues, they're working on crafting some rule or working on today's problem, and they might spend a year or two working on how to fix that or what they perceive as what the fix of that should be, and then they get a rule out and they sort of say, phew, that's great, okay, on to the next problem. But that's just the beginning of addressing a regulatory issue. It's by no means the end. And so there really needs to be sort of follow-up activity after the fact that is part of an ongoing measurement program that frankly never ends, that just looks at, okay, how is that regulation affecting the economy? How is it impacting lending? How is it impacting financial intermediation? And you can measure that using the wealth of data, quite frankly, that's created through the financial regulatory regulators, whether it be financial reports or what's going on in financial markets. It's oftentimes it's the case. It's not that there's a lack of data. It's that there's a lack of focused effort and concentration on really trying to seriously assess those impacts.
Heidi, you have any thoughts on this?
So two things. First, in terms of effectiveness, I just want to amplify, I think, Jay's point that accountability is such an important piece of that. And I've always thought that our financial regulators are a little bit like a scene from Agatha Christie's Murder on the Orient Express, that you got all these people on the train, there's been a murder, and it's very, it's hard to figure out who's responsible for it. It turns out, I think the end of that story is they all were.
Spoiler alert.
Yeah, spoiler alert. But it always seems to be a big problem to me. And again, going back to that model of Twin Peaks, it's trying to address that. I'm not, by no means is Twin Peaks a model that we could adopt in the U.S. today, but it does get at that accountability issue. And then I would say in terms of measuring the success of the regulatory regime, for me, it would be two things. Do Americans have access to financial services? I just think what's the point of the system of regulation if it isn't to make sure that all Americans have access to financial services? And then secondly, maybe this is more naive, is no bailouts, right? That we can get through a financial crisis without a major bailout. Now, I think the political economy of that is very difficult, but that does seem to me, those two things really stand out to me as measures of success.
One more thing to add for me, at least from back to our economist hat, is the research angle on this is actually pretty hard because you'd have to identify a chain of causality from the regulator to some sort of good outcome. That's easier done when you have accountability and separate institutions, and so you can pinpoint exactly where the quote-unquote success is coming from. But that's not the system we have today. Even if it were, the research would really require you to first isolate, well, how much of the financial success system, the success of the financial system is because we're nomadic and we have a robust financial market, versus how much of that is coming from a financial regulator. It's pretty hard research, although the Fed has lots of people working on research, so I wouldn't be opposed to them looking into this further, but I think the analysis is further complicated by the fact that the system isn't simple, if that makes any sense.
Yeah, so, I mean, I feel like the accountability question also sort of inherently brings up questions about the extent to which regulators should be politically independent, right? Because that can be a form of accountability, how it relates to the political system. And, you know, Sean, it struck me when you were talking about, you know, being very data-driven, just sort of like looking at what's in front of you and deciding this, you know, this looks like it's working, this doesn't. That doesn't necessarily sound quite like a politically driven process. But Heidi, maybe I'll stick with you for a second and ask, I mean, to what extent do you think that accountability should be tied to independence, not independence?
Well, I think they are related, absolutely. You want, like, let's take, for example, the recent emphasis on debanking, right? That is, to me, an independence issue in a lot of ways, is, you know, trying to take the political process out of bank regulation and the reliance on experts. I mean, to me, personnel is policy, right? So you hire the experts are going to hopefully be less distracted by political noise, and yet accountable for their mandate, I think.
So if you're looking at me, then my perspective on that, I guess, is as follows, which is, when I think about the Federal Reserve as a financial regulator, in any financial regulator, but in the context of the Federal Reserve, you know, they're not independent in the sense that the broad choice about how to regulate the financial system is sort of a trade-off between growth and stability. And I think we look to, you know, our public policy making entities to make that broad choice. So let's just say Congress or the broader political system. And there's an ongoing sort of public dialogue about where we want to be on that trade-off frontier, and the political process leads to a particular point on that frontier. So you can point to, say, Dodd-Frank or something, or, you know, other sort of, you know, legislative initiatives that effectively explicitly state a choice about where as a society we want to be with respect to sort of supporting growth, but at the same time maintaining sort of financial stability. And then the regulator should be charged with executing on that public policy choice that's been made by, say, Congress. And, you know, really what they should be focused on, and what we should want from our regulators, is that they sort of competently, incredibly, you know, affect their charge, free from day-to-day micromanagement. And that, in my own opinion, is the right way to think about quote-unquote independence in the context of financial regulation.
From my perspective, I agree with all of that. We don't usually discuss independence with respect to the Fed as a regulator. We usually think about independence with monetary policy, and I think that's presumably because there's no way to have a regulatory authority be independent from the political machine. You've seen that with sort of 3 vice chairs. Each of them have a very different agenda, and the strictness or leniency with which they regulate the financial system is drastically different under the 3 different regimes. In general, I feel independence works when you discuss monetary policy, because a big aspect of monetary policy, of course, is the credibility of the central bank. That's why we want independence from the political aspect. And that's my concern, is that if the anti-independence thing creeps in from regulation, we're just making it closer to the monetary policy aspect, which again, beat the same drum. We can't have a system where the same entity does both of these things and expect that everything will work perfectly for these exact reasons.
Well, and also getting to the complexity that you keep talking about. I mean, you know, when we think about regulatory independence, the Supreme Court seems to be moving toward a place where, you know, maybe the Fed will keep some manner of legal independence, but it seems like, you know, maybe the rest of the regulators won't. So in a multi-agency process, when you have the OCC, when you have the FDIC and the Fed all sharing bank regulation, does the Fed's independence as a regulator really matter at this point if the input is still, the OCC and the FDIC are much more politically threatened by potential firing?
So again, if you're looking at me, from my perspective, I think it's appropriate that the political process plays a role in thinking about setting the parameters for financial regulation. That's kind of as it should be. And again, oftentimes people talk about the Fed as though it's a sort of very different and special organization, which it is, but at some very high and broad level, especially with respect to its sort of regulatory mandate, it's not that different from other regulatory bodies that we have, whether that be the Food and Drug Administration or the FAA or the people that determine safety standards for automobiles. So the world could decide that we want to build cars that nobody will ever die in if we have a crash, and then we will build no cars. That's a choice that society could make, but society doesn't make that choice. There's it makes an economic choice, and it chooses a point on the frontier. We're willing to allow some fatal crashes, so cars are not wrapped in some concrete block so that nobody can die in an accident. And that's a societal choice. And then there's a regulator that's charged with ensuring that the safety standards are adhered to and that they're up to snuff and all that kind of good thing. So in that regard, the Fed's not really any different. The Fed should take its marching orders on the appropriate stance on regulation from public policy making institutions, largely Congress and the administration. And then it should execute that charge in a way that's credible and consistent. And here's where I think transparency becomes key. So to the extent that there's maximum transparency into the regulatory framework, both what are they doing, why are they doing it, how does it map to what they've been asked to do by Congress and the administration, then again, I think that in some sense that's how you earn your independence, by basically showing your work and showing that what you're doing is aligned with the public policy goals that have been set out by the people who are endowed with the authority to set those goals.
And I'll add a very small caveat to that, is I completely agree with Sean, but again, yes, it is the case that a regulatory authority will be subject to some sort of mandate of enforcing a particular viewpoint on how an industry should operate. And Sean's correct, in that respect, the Fed is like any other regulator, but the Fed isn't just any other regulator in a whole bunch of other aspects. It's supposed to be an independent research institution. It's supposed to be obviously conducting monetary policy. And that's really my concern, is mission creep on one side isn't really stopped by mission creep on the other. It's not like we take the Federal Reserve building and sort of cut it in half, and then it's like, you guys do this and we do this. And that spillover is concerning to me, in as much as it's going to then trickle down into how the Fed does the rest of its responsibilities, which I mentioned in my opening statement, is now the primary responsibility of the Fed.
So I just want to pick up on the transparency piece, and I'm particularly interested in what they think. The lawyer wants to ask the economist. So with regard to the transparency, bank supervision is notoriously not transparent. And I wonder what you all think about that being housed in the Fed, that very anti-transparent process, whether it should be or not. I'm always fascinated by the fact that my students are astounded that the one piece of information that probably everybody wants to know about their bank, they don't know, which is their camel rating. Yep. But I wonder about that sort of bifurcated approach, and whether you think there's spillover or a problem. Does that further bolster the idea of getting supervision out of the Fed?
No, I completely agree. I feel, I was assumed that you would bring up the camel rating, because that's something that the ordinary citizen here doesn't know, but these federal regulators know. Now, of course, they might say that, well, the OCC is a self-funded institution, but eventually those costs are borne out by consumers through pass-through effects. So essentially, we're the ones that are paying for those camel ratings to be calculated, not 100%, but whatever the pass-through rate might be, but we have no access to that information, right? And it would seem to me that if the concern is financial stability, transparency and perfect information sharing is the best way to ensure that. Of course, as Aaron mentioned earlier this morning, if your definition of financial stability is that no one will ever fail ever, then maybe you actually do want to keep things hidden and not have a quote-unquote bank run. But in as much as financial stability means everyone has perfect information on which bank is best leveraged or is doing its business in the best possible way, then of course the transparency aspect becomes very important.
So I also want to ask, I mean, you know, when you think about chopping up the different responsibilities of the different agencies, you know, Sean brought up the idea of the sort of the regulatory perimeter, and it seems like, you know, there is this question of, you know, banks are regulated in a certain way, but then increasingly there are other institutions that do some bank-like things or maybe need to be regulated in a financial stability type way. So, Jay, like when you think about the different agencies that have different responsibilities, how does that fit into that question?
It's a good question. I don't have an answer for you in terms of being able to fix the system right away. To me, the obvious answer would be to sort of get, in a first best case, to get the Fed out of regulation altogether. That aside, if you do keep the system the way it is, it makes sense to me that some of the larger banks move under the category of the OCC. And I think Sean, you know, mentioned this. These rules were created in a drastically different world, and they're being applied to a world that's fundamentally different than when the rules were created. I mentioned the Fed primarily became a regulator in 1956. We're 75 years away from that. Presumably, at that point, it was because the need to regulate was at the bank holding company level, because there were all these rules about which banks could charter, which banks could merge, stuff like that. None of that is applicable anymore. The OCC was primarily created to supervise quote-unquote national banks. So we have this framework, again, that's sort of been shoehorned in over fundamental premises that don't really apply anymore. So to me, the answer is always simplification, which is taking it away from the Fed and keeping it under the OCC, which doesn't have a monetary policy mandate. I have no idea if that answered your question.
No, it sort of did. I mean, so Heidi, I mean, you were talking about the Twin Peaks method. How do you think about this?
I like Jay, can't really answer the question, but I can at least answer it conceptually. The way we've created bank regulation is very institution-oriented, right? You know, the key piece is that deposit-taking entity, and then the bank holding company is built around it. We haven't defined the regulatory perimeter based on the risk, really, that we're trying to regulate, and that's the mistake. I mean, that's what makes it so difficult to get at the non-banks and those activities. If we were better able to define the regulatory perimeter, maybe by activities, not institutions, or by risk, I think we would have a more coherent structure. But that really is talking about dismantling a whole lot. And I just don't see, there's too many vested interests in the current system. And maybe Sean might have an opinion on this, but, like I suggested, putting consumer protection into the CFPB, consolidating it there, putting community banks back to put all the community banks with the FDIC. I think the industry wouldn't like any of that, right? Even though I don't think they'd see it as particularly worse necessarily, but they like the system they have. They like the system they know, so.
So I think Jay and Heidi have made some really important points, and I think, the way life works is that it's just path dependent, and there's no way of escaping that. And so if you think about the collection of financial regulators that we have today, it's really all based on historical precedent. So we had basically a civil war, and we had wildcat banking, and then we had the National Banking Act, and that gave us the OCC. And then we went along for a while, and we had the Panic of 1907, which was like the first great financial crisis, and then we got the Federal Reserve, and then we had this other little thing called the Great Depression, and we got the FDIC. So that's why, why we have what we have is not the result of some social planner sitting in a dark room saying, how should we set up financial regulation? It's really just the result of the fits and starts of history as it unfolded sort of before our very eyes. And I think a point that Heidi made was really important is that we have this strong institutional focus, and we're really not focused more holistically on sort of the activities in sort of an all-encompassing and holistic fashion. And I do think that's important. However, I also tend to think that we spend a little bit too much time fixating and burning lots of calories thinking about how to arrange the deck chairs. And that I think in some sense what's really needed is an overarching sort of somebody needs to be minding the store thinking about how we're regulating financial activities in a manner that is complete and holistic. But you can do that with multiple agencies, each of which have somewhat different charges and maybe different motivating public policy rationales. But absolutely over the top, there has to be, again, some macro view of what kind of financial system are we creating through the financial regulatory architecture that we're promulgating. Is that working? And how do we sort of have a whole of government approach, if you will, to regulating financial activity? Something that gets said from time to time, which I strongly, sort of vigorously agree with, is same activity, same risk, same regulation. So I can't think of sort of a simpler prime directive for how regulators should be thinking about regulating financial activities. And that is both simple to say, and in concept, it's actually pretty straightforward. And oftentimes in reality, what you need to do is you need to break down silos and barriers between regulators that have their own turf and their own view of what they should be working on. But in concept, that is achievable either with one regulator or with many regulators.
I do also, before we get to audience questions, want to go a little bit into the specifics. We've seen some changes already from the Fed in terms of specific regulations. We had a proposal to sort of scale back the enhanced supplementary leverage ratio. It seems like they're now in the process of, speaking of transparency, releasing a bunch of stuff about the stress tests, including the modeling, which is something they resisted for years. So, Sean, I'm curious, what more is sort of on your affirmative agenda of things that you would like to see the Fed do on the regulatory front?
I mean, look, at a high level, and happy to get into some of the details to the extent that people want to dive into that. I really think the right question to be asking is, from a capital and liquidity framework, are the capital and liquidity standards that we have in place? I represent a number of large banks, so I'm primarily focused on large banks, but this question is relevant for banks of all shapes and sizes. Is the capital and liquidity framework that we have in place today, is it appropriately calibrated for the economy and for the financial system that exists today? And something that I strongly believe in, that I said already, but since I believe in it strongly, I guess I'll say it again, which is we've really had some seismic changes in the financial system in just the past 5 years. There are other long-term secular changes that have been brewing for over 75 years. And financial regulation, in my personal opinion, has not really kept pace with those changes. Now, in the case of COVID and what happened in the last 5 years, that is understandable. In the case of the long-term trends in the banking system versus the rest of the financial system, I think there's really something there that needs to be addressed, and it's been a long-standing problem that regulators, they need to grapple with it. It's complex, but that's a fact of life, and so they need to grapple with that complexity. And so I think that's these things that we're talking about, whether you're talking about leverage ratios or whether you're talking about what's going on with stress testing or whether you're talking about what's going on with Basel III Endgame, all of those things feed into sort of the overall capital framework that our members have to contend with on a day-to-day basis. And so the right question to be asking, again, is sort of at the top of the house from a macro perspective, do we have the right amount, do we have the right capital and liquidity regulations that are sufficiently promoting growth while ensuring sort of safety, soundness, and financial stability? And so that's what I'm focused on, that's what we're focused on at the forum, and I think that's what our members are focused on.
I think my opinion on this is we're trying to understand what the speed of financial regulation looks like, what the outcome might be. The easiest way to think about that is to compare it to the monetary policy regulation aspect and see what the Fed's done there and whether you can make any predictions about the other side from that section. Sean advocates that, hey, we should have these framework reviews just as we do for monetary policy, and I think that's a worthwhile goal. But the monetary policy framework reviews, I wouldn't argue, have been particularly successful. In 2020, under a previous Fed administration, they adopted flexible average inflation targeting, and they said that they wouldn't target employment shortfalls. Well, that was a pretty bad decision. And all that they did in the next 5 years with the framework review was just eliminate all of the new things they put into the 2020 framework review. So if it's up to the Fed to self-correct on its regulation mechanism, at least from the monetary policy angle, I'm not very hopeful. Because on that side, the past 8 years say that they chose to do things that were against economics, didn't really make much sense, and then had to go back and sort of delete all of that 5 years later. And that's all the change we've had there since 2020. Clearly, I'm not a very big government regulation guy. So that's my concern with the other side as well.
Yeah, although I guess you could argue that, a review also gave them the ability to reverse that process.
So I would take the other side a little bit. I'd take a look at the changes they've made, and they learned something. And they made a change as a result of that information that they learned about. So, I understand and I sort of accept your skepticism, for which there's good and founded reason, but I take a look at the framework review, and again, they tried something. Turns out, according to many people, including to some extent the Fed itself, didn't work as intended. And they actually had the courage of their conviction to actually recognize that and make a change. I think that's a positive step forward.
No, I don't disagree on the principle of having a framework review. My concern is that the speed or efficiency with which this moves isn't necessarily something that's going to go in the direction that all of us want if we leave it to the Fed to decide it themselves.
There again, I think that's where transparency comes in.
Sure.
I'll just weigh in on a slightly different issue, but because we're assessing the Fed. It's very popular to blame the Fed for Silicon Valley Bank failure, et cetera, and obviously they blamed themselves, so that's fair. But I just want to throw out there the idea that when I read the reports on Silicon Valley Bank, it really reminds me of so many reports on so many bank failures. In other words, I don't think that the way the Fed dealt with Silicon Valley Bank is that different from the way the OCC or the FDIC has sometimes reacted too slowly to the typical signs of bank failure, which is excessive growth too quickly. That's what Silicon Valley Bank showed. That's what so many bank failures, is the impetus for so many bank failures. So I guess I just wanted to say that I'm not sure Silicon Valley Bank, that experience tells us much about the Fed as a bank supervisor.
Well, it's also kind of interesting because, Jay, you talked about there being a sort of a conflict of interest between the monetary policy and the regulatory stuff. But I almost feel like SVB is like a counter-argument to that because they still raised rates even though this ended up leading to all these unrealized losses on all these balance sheets. Yeah. It didn't stop them from doing that. I don't know whether you have any thoughts on that.
No, the most obvious counter-argument to my point would be, well, it's not like things would be different if the Fed weren't regulating. Sure, I'm not saying that the things we change will lead to some utopian paradise of financial regulation. And to the Fed's credit, it did do that, although I would argue, I think most people would agree, the Fed was at least a year too late in raising rates. So I'm not a big revisionist history now of that time period being like, well, the Fed did a good job. I don't think that they did. I think they basically concede that fact as well. I'm not saying that the Fed didn't raise rates because of bank stress, but that's not exactly the way things played out back then. And to me, it's just, as to Sean's point, we're so reactive in the regulation space. My point is a little bit more proactive, which is, here's this conflict of interest. There's plenty going wrong already. In as much as there's even more political pressure on the Fed, it makes sense for us to hash these issues out now and get rid of that conflict of interest before something gets even worse in the future.
So again, I think this point about the conflict of interest at the Fed and the cross current between thinking about what's going on in the banking sector and monetary policy is really fascinating. It's an interesting point. And again, as I think about it, given my experience at the Fed and just sort of given my background and sort of as an economist, when I think about the Fed's mandate, the Fed has a dual mandate. That's handed down by Congress, so they don't have independence with respect to their goals. So the goal is they have a dual mandate. So even if you take banking supervision out of the Fed still needs to be thinking about what the impact of, say, raising rates would be on the macroeconomy. Now, they shouldn't be thinking about it solely in an over-focused way on the impact of the banking system. I absolutely and completely agree with that. I'm not sure that there's any evidence that they do that, but they shouldn't be doing that. But there's a sense in which, again, in my own mind, there's a little bit of an intellectual shell game here, which is to say the Fed has to be grappling with the trade-off between basically price stability and macroeconomic growth all the time anyway. And so it's not immediately clear to me that taking bank regulation out of the Fed would somehow magically change things, because that trade-off would still exist, and that would something that they would still have to consider as they contemplate monetary policy, basically.
All right, well, with that, I would love to turn to audience questions. So while you all think of questions in the room, I'm going to start with one from the audience, which is related to something you said, Sean. With regard to the idea of same risk, same regulation, isn't a probable outcome of this the spread of very conservative and constraint rules across the economy, because it's hard to imagine traditional banks being significantly deregulated?
Well, again, I think in some sense the answer to that question goes to something that the previous Commissioner Peirce mentioned, which is about the really important need to foster and support innovation. So I think it's important that regulators all the time, and again, this is a point that Commissioner Peirce made that really sort of resonated with me, that it's really important that they be thinking seriously about how to appropriately sort of foster innovation. And the question sort of said something like, well, won't they always just basically be shackling large regulated banks? I think in some sense, that's where that's the margin upon which we need to be pushing. And obviously, we want banks to be safe and to be sound, and we want appropriate financial regulation. But we need to make sure that regulators are not stifling financial innovation as they're regulating the financial sector, whether it be banks or other entities. And again, that's where transparency comes into play. That's where taking your marching orders as part of the political process and appropriate bodies such as Congress comes into play. But at the end of the day, I really think we have to be focused on making sure that we are appropriately supporting innovation inside the economy.
Either of you want to weigh in?
I think he did a great job. So.
He did a great job. Over here in the room, if you could, stand up, introduce yourselves, and speak clearly, please.
Bonnie Wakatel. I'm in the investment business and an observer of the passing scene. I'd like to go back to Silicon Valley Bank and raise an angle that hasn't been stated, and that I was amazed to learn subsequently that the stress test prior to the Fed raising rates in 2022, those stress tests did not take into account the risk to the bank balance sheets of rising rates, which I considered amazing. And as you know, after Silicon Valley Bank and a couple of others were caught and an example was made to them, whether you like the way that was handled or not, the Fed immediately put into place a facility where all the other banks that were caught could bring in their devalued bonds and get credit at the discount window, 100 cents on the dollar. And in a sense, I think that was necessary because after the stress tests, it would be really breaking faith with the public impression of what the stress tests were if you had had a bunch of bank failures. So to put that into a question, it seems to me the banks got into trouble in part by following the Fed's understanding of what the risks were in the economy. I'm not criticizing the Fed. What they're doing is very difficult to do. But if you separated them out from supervision, you don't have another institution that can correct the mistake the way the Fed did through the facility at the Fed window. Would anyone care to comment on that?
I think that just because you have multiple agencies with different mandates doesn't mean that they don't coordinate. So I think that, I think that's I appreciate the perspective, but I think that you can have we've seen agency coordination, and Commissioner Peirce talked about it this morning. I do want to say one thing about Silicon Valley Bank, just because it's always a bug in my bonnet. It was the responsibility of management of that bank to manage that interest rate risk. So, when we talk about regulatory failure, we need to, I think, in my mind, it was absolutely primarily a management failure, not helped by potentially a regulatory failure, but number one, a management failure.
And to add on to that, this isn't the first example. Before 2008, all the big banks had mortgage-backed securities, which were rated AAA securities, so none of our leverage ratio framework would have stopped that from happening. You're not willing to criticize the Fed, I will. To me, it's kind of strange to say, well, they failed at their regulation job, but hey, at least they came back and then fixed the mistake they made. wouldn't a simpler framework be that, hey, we just let banks make decisions for themselves and live somewhat with the consequences of those decisions? That's a much simpler and more sensible framework to me.
I'll have another question from the online audience here. Taking the Fed out of supervision has been considered before, but failed due to opposition from the states, the regional Fed banks, and senators representing the states where they reside. What offers any greater hope of making fundamental change now?
I'm a libertarian. I don't have hope.
I don't think there is hope.
It's a good definition
And I'm not
of
a
what
libertarian, but I don't think there is hope.
So from my perspective, I sort of have a similar view to Jay's in the sense that I think making those kinds of system-wide changes is very difficult, and there are sort of political constituencies that have to be considered, which is why I also think it's I also don't think that that's necessarily a death sentence, because I think we can get to the right regulatory place with the current system by essentially optimizing the way that it's done and having some kind of a macro view on how it's done. And I think that the amount of calories and energy that would have to be burned to make significant changes might not be worth the effort, basically.
I mean, if I could just add really quickly, I've always been fascinated by the contrast with the UK, where the Bank of England had regulatory authority, lost it, then got it back again. You know, they lost it after Barings, I think. They regained it after the financial crisis, and then they lost it again. So we definitely have a different political system.
Over here. Mic's coming to you.
Thank you. I was interested in the comment about it was a management failure by the bank in Silicon Valley, which is certainly true. What would you say about the management failure of the Fed that themselves ended up with $1 trillion loss on their balance sheet because of what they were doing?
Absolutely. I mean, I agree.
Well, it's this leads to a whole other can of worms with the interest on reserves policy, which in some sense does tie in with all of this, which is that the Fed's original purpose in regulation was to make sure that banks met their reserve requirements. Currently, banks' reserve requirements are 0, and we're basically ensuring that banks keep their money in-house by just giving them cash. As a result of that, the private lending market the overnight lending market between banks has become significantly smaller than it used to be. For the most part, this hasn't gotten much coverage because interest rates were 0, so it didn't really make any difference, but it's not the world we live in today. If your point is that, hey, if the Fed can't even manage its own balance sheet, what is the signal that it could manage other people's? I'm completely with you.
I do sort of, whenever this comes up, I do sort of wonder, though, because I feel like Congress almost explicitly did not really care about the Fed being well capitalized, because they like actively took more and more of their profits. So I've always sort of wondered, like, in a vacuum, you can argue, like, why do they have these massive losses? That seems like bad management, but it also just seems like the signal from the political entity is like, you don't have to worry about this.
Well, this is just simple, very basic economics, which is that you need to operate on some kind of profit-loss margin to have efficient allocation of resources, which is not what's going to happen if you have a government entity in charge of that. And I'm sympathetic to Heidi's view on creating a risk-based structure, but the most efficient way of allocating risk problems is done by the financial sector, which prices that risk. For institutions like the Fed, they don't really think about risk as something to optimally price. They just think of it in terms of a cutoff, and it's like, okay, well, if you cross this threshold, we're going to debank you or not allow you into the payment system. And that's kind of the same problem that filters in here.
Can I ask a question? So that makes sense to me, but how do you deal with externalities if we're just going to let the market price the risk?
Okay, we're getting into now libertarian economics. Yes, there's an economic case to be made that if there is an externality that the market would, quote unquote, fail to price that in. I believe that the word is thrown around way too often for way too many things that aren't externalities. So I guess this is, unfortunately, we'd have to go the devil's in the details when it comes to me for externalities. What is the externality? Who's being hurt? And I need to be convinced that the regulation we're going to implement is actually going to fix that.
Fair. Another question here. The first panel talked about moving away from too big to fail and safety nets. How could changes at the Fed advance this kind of radical change? I'll ask you, Heidi, since you brought up no bailouts.
I think unfortunately, bailouts are a political question. So I guess, I mean, I haven't really thought this through, but Does that argue in favor of less independence if they're making political judgments, giving them the political power to decide not to bail out is appropriate to that end? But I don't think I have a great solution for the end of bailouts. Again, I think deciding to bail out is not an economic question. It's not even really necessarily a stability question because you're just forecasting whether the bailout will help. It's a political question that probably should be decided by politicians.
So I think I should take a stab at that since the institutions that are being referred to there are the ones that I represent. And so I think, if you want to think about what the Fed could do to address the too big to fail problem, I would first ask, what has the Fed already done to address this too big to fail problem? So again, we've had some pretty monumental changes in the banking system and bank regulation since the financial crisis, including a massive increase in the amount of capital maintained by our institutions, a massive increase in the amount of liquidity maintained by our institutions, a huge increase in the regulatory framework around resolution planning, a massive increase in sort of debt requirements, long-term debt requirements that could then be converted to equity capital if a firm were to fail, so-called TLAC requirements. So I think there sort of has been, quite frankly, from 2010 onwards, a sort of not a singular, but a very extreme and significant focus on shoring up large financial institutions to ensure or to make as likely as possible that the probability of some sort of future bailout will be minimized. And I actually think that's actually been pretty successful. So that's my opinion. But then if you look at, academics who look at this, there was a recent sort of research paper that was published by Darrell Duffy at Stanford University who looked at this. And the title of the paper is The Decline of Too Big to Fail. So I won't go into detail what the paper says, but I guess you can guess the bottom line. So, one should never say never in life. So of course it would be silly to say that there's no chance that any financial institution would ever be bailed out in the future. But I think that really significant strides have been made on the regulatory front and with respect to sort of the structure of the financial system to really help minimize the chances that something like that would occur again.
Question over here? You got a mic coming.
Sure. Thanks. Aaron Klein, Brookings Institution. We've talked a lot about the independence of the Fed, which is a little bit ironic as the president's chief economist gets a forever appointment as long as the president likes him there in either of the two roles, as well as his attempt to illegally fire Fed Governor Lisa Cook, at least according to the district judge. Why do you if everybody says Fed independence is super important and the markets would have a massive reaction, Fed independence has been gutted over the last month and the markets haven't done a thing. What do you make of that disconnect?
Well, I wouldn't say that the results are terrible. Of course, we agree on the principle. In fact, in a recent blog post, I wrote that if we wanted the Fed's appointee to do the least amount of damage, the best place to put him would be on the FOMC. Is because he's just one of 12 members, at least for now. But as the CEA chair, it's much more dangerous because he's in charge of trade policy and international finance. I think the reason why the markets haven't baked that in is because this is one seat on a 12-member panel for now. If you add the whole Lisa Cook situation, that might be 2. That's still 2 out of 12. But now we're getting closer to a point where it could be a problem, but I don't think that the markets bake in any more violations than that, if that makes any sense.
Over here.
Hi, thanks. Bill Nelson, the Bank Policy Institute. Microprudential supervision has as an objective making sure that banks remain safe and sound and don't fail. Since the global financial crisis, this concept of macroprudential supervision has arisen, which is protecting the safety of the financial system as a whole, or leaning against and for rising and lowering imbalances. How do you feel? Do you feel that the focus on macroprudential supervision has actually been a productive thing, or has it? In my view, it's probably done more harm than good. But I'm really curious what the panel thinks.
I'm going to agree with Bill, so maybe you guys want to take this one.
I'll start. I largely agree with Bill. I think we're in I think the Friedrich Hayek auditorium. So let me say that I think the basic problem with macroprudential supervision is what I would call the fatal conceit. And so I think the fatal conceit is that somehow the Fed, the regulator, the systemic risk regulator can somehow peer into a crystal ball and see what problems are around the corner and then get ahead of that. And again, I think this in some sense has to do with the mystique of the Fed in particular. And there's this view from many, if not most people in the public, that there's some magical wisdom inside the Fed. Like there's a secret room on the second floor of the Eccles building that you just go to. And if you walk in there, then immediately your IQ jumps to 200 and you know everything about the world and how the economy works. And I can tell you there are a lot of really smart, really dedicated people working at the Fed, but at the end of the day, they are just people. And their ability to forecast future crises, into spot imbalances on the fly is no better than the rest of the world. And so I think the sort of macroprudential idea is in some sense too clever by half. And I think that the data and experience has broadly borne that out.
I agree with you, Bill, on the fact that at best it's redundant. I'll speak again I'll put my macro econ hat back on. In as much as the Fed responds to some kind of macro variable to set an interest rate, those variables that we normally consider in economics are inflation and some measure of output, unemployment, output gap, something like that. The view from an economics perspective is that those variables would match the business cycle of the financial system as well. So in some sense, the financial system variable, whatever the Fed would look at, would match either the business cycle or the business counter cycle. So if all of those variables are going to move at the same time, adding the macro finance variable there isn't going to change monetary policy by a whole lot. Presumably because if the world is in a very bad recession, that would also be reflected by the financial markets. And if the world were doing not too badly, that would also be reflected in the financial system. So I agree with you. The best case scenario for that is that it has no effect whatsoever.
I'll just add a lawyer answer as to what the law is. The creation of the FSOC was definitely a reaction to that particular crisis and doesn't seem, obviously did not endure, nor does it, I don't know, it was a codification, I guess, of the White House working group. So I think that we usually don't get the right sizing of regulation right when we're reacting to a past crisis. And that probably contributes to some of the problems you all are identifying.
Back in the back.
David Burton, the Heritage Foundation. I wanted to ask a question that, in a sense, involves the intersection between securities law and bank supervision. We have roughly $500 billion in unrealized losses on bank balance sheets, and they carry it on their balance sheets at cost rather than at market value. If the securities laws required that the banks reflect the actual value of those assets and they were reported on their 10Qs and 10Ks, both the public and investors and regulators would have a much more accurate sense of what banks are taking losses on their loan and securities portfolios. And I was wondering if the panel thought that would be a constructive change in the securities laws.
I really can't offer much insight into that other than I know that this was a big issue during the run-up to the financial crisis and the aftermath of it, but without an accounting background, I'm not going to try to tread into that.
So my dad's an accountant. I would say I underperformed my dad because I became an economist. My basic perspective on that is that actually you asked the question and I think you basically revealed what I see to be the answer, which is you sort of indicated the prominence and the size of unrealized losses in the banking industry from those securities, but yet you didn't read about it in the securities filing because it's not there. So the information exists, and indeed during SVB, I think within an hour of the FDIC shutting the doors on SVB, there were research notes being circulated listing bank by bank who had securities losses and of what size. And so as an economist, I don't think that there's an information problem with understanding who has unrealized securities losses, how big they are. That's just not a problem. And as an economist, I generally take a dimmer view of the sort of effectiveness of those kinds of required disclosures because, again, the information sort of gets out there anyway in a market-based way. And there's a much broader and deeper question about basically that policy, which relates to basically the stickiness of deposit franchises and the natural hedge that creates, which is we would need much more than 0 seconds to talk about. But it's that's a kind of very deep and interesting question in banking, basically.
Thank you for keeping an eye on that. Yeah, that brings us to a close. That's all the time we have. It ends us on a note of transparency, which I feel like was one of the big themes today. Thank you all so much for joining us. We are now going to take a 45-minute break for lunch. Lunch will be served upstairs in the second floor conference room. And then please join us back at 1:45 Eastern Time for a fireside chat with Congressman French Hill, who is chairman of the House Financial Services Committee, moderated by Jeb Henserling, who is an economics fellow at the Cato Institute and used to chair that committee. Thank you all so much.
Tim Scott today.
Welcome back to Right-Sizing Financial Regulation. I hope everyone enjoyed their lunch. After a very busy morning, we heard about financial regulatory design. We talked about the role of the Fed as a financial regulator and had an excellent fireside chat with SEC Commissioner Hester Peirce. And now we have a special treat, a fireside chat with Congressman French Hill, who has represented Arkansas's 2nd Congressional District for the past 10 years and who is currently serving as the chair of the House Financial Services Committee. Chairman Hill has a financial services background, working in investments and banking prior to joining Congress, including founding the Delta Trust and Banking Corporation and serving as its chairman and CEO. Chairman Hill will be speaking with Jeb Henserling, who is currently an economics fellow here at the Cato Institute, but previously spent 8 terms representing the 5th District of Texas in Congress, including 3 of those as chairman of the House Financial Services Committee. I know they have plenty to talk about, so I'll let them get started.
Thank you all.
Well, thank you, Jennifer. Anytime in Washington that you introduce somebody, you hear the terms honored and pleasure. I won't disappoint you. I will use those terms, but I really mean them. So number one, it's a great pleasure to be with my dear friend and my former colleague, and a real honor to call you chairman of the House Financial Services Committee. And please believe me when I say in the depths of my heart, of all the people who've ever served as chairman of that committee, you're my 2nd favorite.
That's good.
But let me also say that French Hill is clearly the most qualified, knowledgeable, and capable individual to ever hold that gavel. And when the story comes to its final chapter, may be the most accomplished as well. So number one, well, we could call each other Mr. Chairman for the rest of this session. Maybe we ought to do French and Jeb. So, French, speaking of accomplishments, for at least 2 Congresses now, the House Financial Services Committee has been trying to pass stablecoin legislation. You got it across the finish line. Now, a lot of the language I know came from the Senate, but tell me about that and give me your hopes and fears. Some of what you tried to do did not get into that legislation.
Yeah.
Talk to me about that accomplishment.
I will, but I've got to start because the 2 of us our careers have been so intertwined over really 4 decades now, not ever working together until I was elected to Congress and came to the House Financial Services Committee with Jeb, as my leader. But you have to go back in Texas banking history. In 1982, I went to work for John Tower of Texas, the senior-most member of the Senate Banking Committee, and worked for him on that committee for 2 years, and learned a lot from Texas's senior senator there. And commissioner with John leaving the Senate after the 1984 Reagan re-elect, Phil Gramm, friend and mentor to Jeb, switched parties and became really what we know today as one of the most accomplished economic policy makers, I think, in the history of Congress and certainly in the 20th century. And so Phil Gramm became the distinguished Texan on the Senate Banking Committee, and his right hand was Jeb, and then Jeb has succeeded him in continuing his great work in economic policy making in the House. And so it's been a real pleasure for the past decade to be associated with that part of my roots of my resume. And Jeb, thank you for your leadership in the House very, very much. I mean that.
Thank you, French.
So you're right. Going back to basically the 2019 timeframe, 2018, 2019, the House got very serious about digital finance, digital assets. Where was this going to go? In Web3, in a blockchain application sense, some from a very libertarian point of view, others from a practical aspect of reducing agency costs through new technology on a blockchain, which was very attractive to me as somebody who's always been involved in financial technology since the 1970s. And then you overlaid some trends on it. First, the IMF began promoting central bank digital currencies in research projects along with the Bank for International Settlements in Basel. Secondly, Zuckerberg attempts this premature sort of incomplete idea around Libra that was launched and then flopped. And then thirdly, the third component of this learning episode, I think for the members, particularly in the House, but also in the Senate, was the collapse and failure of FTX. So all this under both Patrick McHenry's leadership as chair and ranking member and under former chair Maxine Waters laid the groundwork of members really engaging here. And what was the right point of view? How do we get this right? How do we keep America at the forefront of innovation, recognize that there's new technology coming that can make finance more available to more people at a lower cost with better audit standards, better programmability, more accessibility in terms of 24 hours, 7 days a week? And yet, how do we block it from being abused, from self-dealing and disaster, as in the case of FTX, or aggrandizement by the corporate big tech companies, as in the case of Facebook? Because that's the antithesis, actually, of Web3 and the internet. A corporate network dominance is not the intent behind a decentralized system. They're antithetical to one another. So over the past 4 years then, with that backstop, Patrick led the effort to try to find a landing spot on a dollar-backed stable coin. All that work in the 117th and 118th Congresses paved the way for then us to see in the last 6 months of 2024 engagement in the Senate, something that we'd really not had other than Cynthia Lummis and Kristen Gillibrand from New York, who'd worked together both on the dollar-backed payment stablecoin idea and the market structure idea, but it didn't broaden out from their pioneering efforts. And so Bill Hagerty of Tennessee, my old classmate friend at Vanderbilt, introduced a Senate version with some bells and whistles that were quite different from the McHenry version last October. And that allowed us in this Congress, the 119th Congress, to come in and start fresh and start strong on the stablecoin idea. And in the last Congress, I was able to pass FIT 21 with significant Democratic votes on the market structure issue. So Tim Scott and I were able to, before we were even sworn in January into our jobs, lay the groundwork for moving a dollar-backed stablecoin bill forward in both houses. Brian Stile carried the legislation in the House, our chairman of our FinTech subcommittee, and Hagerty pushed that along in the Senate. So I prefer the House version, but we were able to work between the two houses to outline a few changes that we would make to Genius, and we put them in the Clarity Act, which we passed in the House with 78 Democratic votes.
Well, speaking of the Clarity Act, though, it appears that Senator Kennedy of Louisiana said your baby is ugly.
Yeah. Well, coming from him, that's a compliment.
So given that so many believe that, blockchain puts us on the cusp of this new industrial revolution. Mm-hmm. Hester Peirce, who was here, the commissioner of SEC, talked about permissionless innovation.
Yeah.
But without the market structure bill, how are we going to go forward with the creativity of digitized financial assets? And what exactly is the problem on the Senate? Because I think we both know, never underestimate the capacity of the Senate to do nothing.
Yeah. Well, first, John hadn't mentioned that to me. I've never heard him make that comment about clarity because really what I find both in traditional finance, in the venture capital innovator sector, and in the Blockchain Association, they fully endorse the Clarity Act. It's the balanced bill. It's the bill that both respects decentralized finance and the conversion of our existing financial system into a blockchain-based success story for exchanges and innovation. So Actually, I think that the Senate would be really best to use the Clarity Act as base text and mark it up. But that's a decision they've got to make for themselves.
Well, out of fairness to Senator Kennedy, I think he said we're just not ready.
Well, they don't have the benefit of this long-standing education campaign, that I described a few minutes ago about what the House members have dealt with going back, as I said, to 2018 and 2019. But they were also not up to snuff and up to speed on dollar-backed stablecoins, and they introduced it for the first time last October, and we signed it into law in July. So I think they can get this done. Both the Senate Democrats and the Senate Republicans have special work teams who are working on this, who are collaborating to get to yes, and I think they can find their way to do that. If you pass just a dollar-backed stablecoin, it's like passing in 1996 the authority to create a cell phone, but no cell towers. So a dollar-backed stablecoin without market structure is just a thing, even though the state of New York effectively has a good regulatory structure for issuing a dollar-backed stablecoin. I'm not taking anything away from that. I'm saying the ultimate benefits of trying to use this technology to maybe hit the goals and dreams and aspirations that Hester talked about, you need both. And you cannot do it by exemptive relief at the SEC. The CFTC needs statutory authority to do this. The CFTC needs statutory authority to do spot market regulation, say, for example, of Bitcoin. And then the bank regulators, the securities regulators, and the exchanges and the ATSs and the CFTC infrastructure all needs a statutory direction. You cannot piecemeal it, in my judgment, by petitioning to the regulators for exemptive relief. So I believe market structure paired with a dollar-backed stablecoin bill will unleash that programmable financial services capability, increase competition, and lower cost in a whole variety of both domestic and international transactions.
So you had a series of bills, French, two passed on an extremely bipartisan basis. The CBDC bill, not so much so.
Right.
Clearly it appeared to be a party line vote, although on the other side of the aisle on different issues there has been some consensus around privacy. So speak to me about the politics of that and where does that go going forward? Because it's a great concern of many in this auditorium and listening in.
Yeah. Well, you're right. Tom Emmer, our majority whip in the House, introduced the anti-CBDC legislation that we did pass. It's similar to the legislation we passed in the previous Congress. You can make that topic bipartisan, but Tom's bill was more narrowly crafted. It didn't attract significant bipartisan support because of its breadth. But, Americans don't need another way to be surveilled. And we put privacy first when it comes to this concept. I don't believe our very well-developed, very competitive, very open society needs to have people opening accounts at the Fed. And so I think there's consensus among center-right people that we shouldn't have the American people banking at the Fed, and so it was a vote. And we attached it yesterday to the National Defense Authorization Bill. It was in the base text of the NDAA, which we are transmitting to the Senate. So I hope that could become law that way, and there are ways to modify it modestly, but still achieve the fact that Article 1 gives power to Congress to coin money. You and Phil just had an excellent op-ed in the Wall Street Journal along those lines. And so we just believe the Fed can't issue a CBDC, without a direct approval by Congress. And if you said that and that alone, you would get broad Democratic support on that.
Well, changing topics, if I did my homework properly, but prior to Dodd-Frank, we had about 144 de novo banks each year. Post Dodd-Frank, it went to 4.
Yeah.
You and I worked together and came to a meeting of the minds with the Senate on 2155.
Right.
The good news is we've seen an astronomical increase in de novo bank charters. They've gone from 5 a year, I think, to 12 a year.
Yeah.
Clearly, we didn't get the job fully done. So, French, I know it's a passion of yours.
Yeah.
How are we going to make community banking great again?
So when I was campaigning to become the committee chairman, and a lot of people don't know that, and it's a competitive process to be elected a committee chair.
I know that.
At least one person in this room knows it intimately. And so in meeting with the Republican leadership in the House, I said one of my core tenets, if I'm elected chair, is to make community banking great again, in the theme of the work that Senator Crapo and Chairman Hensarling did on S-2155, which is to lower the cost of regulatory burden on community banking so that they have more capital to lend to entrepreneurs and business and increase economic growth, and have less pressure on consolidation. So we've combined that same regulatory theme in all the bills we've marked up thus far. We've reported to the House over 60 bills in the first 8 months of the Congress. About 20 of those, and we have a big markup next week that will continue that, about 20 of those are in this theme of 2155 of truly tailoring regulations and also increasing access to capital for community banks, both in depository funding as well as in literal capital itself. How do you start a bank? First of all, you need to be I've done it, so I can give you, you need to be in a community that you believe can support it economically, that you've got those economic signals that's yes. Secondly, it needs to be a growth community. You need to see the competitive opening of what services you'd be offering to be more competitive than certainly well-entrenched players. And then you need to show to your investors what? That over some reasonable time frame, they're going to get a disproportionate return on investment pre-tax. And what I've argued since Sarbanes-Oxley and Dodd-Frank, two very expensive, difficult laws that overshot their mission. In retrospect, we have the benefit of hindsight now to say that. When you're in an economic fight, resolving Enron and WorldCom in the first case, or resolving the global financial case in another, you do what you have to do under those circumstances. But in retrospect, these bills have been so expensive, they make it unattractive to do certain things, and one of those is going to de novo banking. So we've tackled it: regulatory burden, capital raising capability, M&A capability and streamlining so that businesses can combine and create that growth across the whole banking sector. Alexander Hamilton told us our banks are our nurseries of our national wealth. And in a big multi-time zone continental power like the U.S., the largest economy in the world, we need banks of all sizes. And we need to make sure that they can produce a quality return. And so that's our theme. You led the way. You had success in 2155, signed into law by President Trump back in 2018. And Tim Scott and I are, on the hunt to do that, have that same thing in making community banking great again. But we want to do the same thing in capital markets and in housing, just as we have in digital.
So you
assets.
anticipated my next question,
Yep.
and that is, as you well know, we have maybe half the public companies we had 20 years ago.
Right.
Those companies are going public later in their growth cycles, which means so many retail investors lose out on those
Yep.
investment opportunities. So how do you make IPOs great again? What is that, MIPO God? That doesn't exactly roll.
I won't even
tongue.
try it. I won't even try it. A couple of sides on that, looking at that equation. One is we want to lower the quarterly and upfront cost of being public so that you don't have to be a unicorn to justify the expenses of going public, because you're right, we don't have that many public companies. It's 50% down from my graduation date from college. And as I campaigned last fall for this job, I said, how many companies, it's a test question, how many companies are in the Wilshire 5000 index? It's a little tougher than who's buried in Grant's tomb, because we don't have enough companies to have 5,000 companies in the Wilshire 5,000. It's 3,700 is the answer. So our broadest index we can't even populate with qualified enterprises. So we do want to lower that cost and make sense. Yesterday we had a hearing on the proxy access and proxy process, and that's one of the contributors. The expense of corporate governance and accounting and Sarbanes all have driven up that cost. So how do we lower it? We've got bills to try to do that. How do we help crowdfunding? All the way to IPO. And we followed up on the Jobs Act work under your leadership and under Patrick's leadership over the years to expand that crowdfunding aspect of it. We now have bipartisan consensus on my work to change the definition of an accredited investor, to let more people have access who have the expertise to go into private investing. And then finally, we have to recognize that I think we have something like 14 million Americans working for private businesses now. Because of what you say, they've delayed going public, and they may not go public.
Yeah.
Think about that for a minute. That means those companies may not ever appear in your 401k plan or your IRA. So I want more public companies so there's more investment diversity and opportunity for more of our American citizens to build wealth. But that also means that all those 14 million people don't have an automatic participation in that stock in their profit sharing plan or their retirement plan, and they even work for the company. So we're trying to also advance the ability for people to invest in private businesses. And I believe we've had a decent 10 or 15 year benchmark to look at what that might look like in the public market context under a couple of different interest rate scenarios. Under the pandemic, that's the BDCs, business development companies that have gone public, and then some of the private equity firms that have been public over the years, like Blackstone comes to mind, or KKR, just to get a proxy for public company investors, in other words, individual investors, access to private investment opportunities. And President Trump just signed an executive order to try to encourage this by suggesting that 401k plans be open. This will be a Department of Labor issue principally.
Great idea.
Have some access to private investing, just like public pension funds have now. I'm not sure, somebody in the audience may know, I'm sure a third of private pension fund assets are in private equity, and that number may be quite a bit higher with a long means testing. I mean, this is not a recent trend. So we want to look at that carefully as well. So lowering the cost of being public, but providing also additional new access for individual investors to invest in private opportunities, a combination, because we've got to recognize the market as it is.
Going back to banking, as you well know, one of the great challenges that banking has faced is what many believe to be the single most powerful unaccountable agency devised by the mind of men, the CFPB.
Always on message.
So, do you reform it? Do you send it to alligator Alcatraz? Do you deport it to El Salvador?
Yeah.
Actually, I want to give you great credit because, as I understand it, in the last reconciliation bill, you were able to constrict its funding, so there may be a reconciliation 2.0.
Yeah.
And if the Supreme Court upholds so-called independent commissions, different debate, do you now have leverage to potentially at least get this thing on budget?
Yeah.
Get it under appropriations?
Yeah, it's such a good question. So we made the first signed into law major change to the CFPB since its formation when President Trump signed the budget reconciliation bill into law. We capped the virtual unlimited funding the CFPB can get from the Fed to 6.5% from 12%. Dodd-Frank allowed it to have 12% of the Fed's operating budget. And in the House, we did a 5% cap, saying that would allow it to do its statutory required responsibilities and nothing more. We also cut away their ability to carry over funding from year to year. They had built up quite a significant slush fund in that regard. And in the House bill, we ended the excess money in their penalty fund. In other words, their civil monetary damages type fund that when they adjudicate a case for on behalf of consumers, we said when those are exhausted, those appeals are exhausted and all those consumers are paid, that money needs to go back to the Treasury. It's not some fishing expedition for CFPB. Those were not kept in the Senate bill. But the Senate was able to do the cap, not at 5%, but at 6.5%. What we're doing with the Trump administration now is trying to focus the CFPB, their staffing, their leadership on their core constitutionally, or I shouldn't say constitutionally, but their statutory responsibilities and nothing more. And we've given them a lot of assignments. We want them to repropose the 1033 rule on open banking and access to information. We want them to severely curtail and repropose their Section 1071 rule on small business lending, which is an utter disaster. So we have work for them to do. In answer to your question, I think, yes, that by the time we get through with this and we continue our work with future reconciliations, I would love it if we could find a landing spot where Chairman Andy Barr's work that's continued from your chairmanship on a bipartisan commission on appropriations approach to CFPB, could be achieved and put them in line with other regulatory agencies under using the Administrative Procedures Act, and the like. But have them strictly focused post elimination of Chevron deference to their statutory remit. And remember, this is important. I mean, people go, Elon texted, rest in peace. But that's not the way the world works. A law was passed, and it said you will administer these consumer statutes for banks over $10 billion, and that's the law. And we don't have 60 votes in the Senate to repeal that law. So we're in for boxing, narrowing, focusing, tailoring, and overseeing their work, including putting them on appropriations.
Possibly our last topic. Ronald Reagan famously once said, the closest thing to eternal life on earth is a temporary federal program. I wish I'd been born at GSE. The administration is talking about the GSEs. In my own opinion, it's kind of big on vision, small on details, but give me kind of your hopes and fears in visions and prognostication. As you well know, this was my white well when I was chairman at JC, trying to reform the GSEs. Give me your thoughts, French.
Jeb's final act before he let the House go sine die under his chairmanship was to drag us all into a full committee hearing in the third week of December of whatever year that was to have a final whack at the piñata of the GSEs. You did a lot of good work, and you had bicameral and bipartisan help.
Indeed.
Delaney and Himes and Corker over in the Senate. We had some good people who intellectually wanted to work on this. And we've had Jack Lew, Steve Mnuchin, Janet Yellen, who am I leaving out, and now Scott Bessent. And I've never been invited to a meeting, a serious meeting about what to do about the GSEs by one of our Treasury Secretaries, but it might happen this time. Secretary Bessent is doing his due diligence, which is exactly what we ought to ask, take a sober, diligent, careful assessment of the GSEs under the conservatorships, what the law says about administering in conservatorship, what the preferred stock agreement is with the Treasury, and think about what the alternatives are. In each instance, under your leadership, under Maxine's and under McHenry's, we have attempted to get the Treasury to engage on this, including we have an unanswered letter from Secretary Yellen where she had committed to give us a work plan for the GSEs by September 30th of 2021. And I check the mailbox every day. And it's not even come from Brookings, where I think she's hanging out now, to name another brand name on the other side of the equation. So I think we should have that sober look. And if Secretary Turner and Secretary Bessent, are committed to doing the hard work on that, then I think they'll find Senator Scott and I are willing to meet with them and see what the right way to do it is. But it's not easy. I read in the newspaper, on social media, oh, we just snap our fingers and something happens here. That's not the case. First of all, they're almost $200 billion undercapitalized. So FYI, breaking news. I don't think that's breaking news to anyone who's actually looked at the math here. And there's some serious issues around the preferred stock agreement. And then there are members of Congress who have strong feelings about the role of the GSEs in the marketplace.
I've met them all.
I know you have, and you've led them all. So I appreciate you volunteering to lead this work on behalf of House Republicans. Our people will be in touch with your people.
Well, speaking of leading, if I want to keep my economics fellowship at Cato, I promised I would end this on time.
Thank you,
I'm sorry we don't have more time.
Awesome to be with you.
But on the behalf of the Cato Institute, we are honored that you would be here. Thank you,
Appreciate
friend.
you. Thank you all very much.
Welcome back to Right-Sizing Financial Regulation. This panel is on government intervention in housing finance, and fortunately the fireside chat with Congressman French Hill set us up very well for this conversation, ending the chat with Congressman Hill on the GSEs. Homeownership is often described as part of the American dream, so it's no surprise that headlines are often made of raising questions about housing affordability and homeownership rates. While some have claimed that the U.S. housing market is in crisis, others question whether the facts really support such a conclusion. But regardless of the current state of the housing market, policymakers have for decades debated how much of a role the government should play in supporting homeownership, ensuring liquidity, and managing risk. From Fannie Mae and Freddie Mac to FHA lending and affordable housing initiatives, the balance between public goals and private markets has been hotly contested, which is why we've pulled together a group of experts today to talk about government intervention in housing finance. I'll introduce our moderator today, Claire Williams, who covers banking policy matters on Capitol Hill for American Banker, and she'll lead the discussion with our great panel of experts. Claire?
Awesome. Well, welcome everybody, and hope you guys had a great lunch and a great panel. We were very well set up with Chairman French Hill and former Chairman Hensarling to talk about this topic. So I wanted to start off. I'm Claire. I cover Capitol Hill for American Banker. That spans everything from housing finance to deposit insurance reform and everything in between. Going ahead and introducing my panel, we have Dana Wade at the Peter G. Peterson Foundation. We have Ed Pinto at the American Enterprise Institute, Norm Michelle with our fearless host, Cato, and David Dworkin at the National Housing Conference. I would love for everybody to just start off and briefly introduce yourself and your interest in the topic. And I guess your quick pitch, how much government intervention is needed in housing finance?
Do you want me to start?
I would love you to start.
I'd say very limited, which is certainly not the case today. I'm Dana Wade. I work at the Peterson Foundation. We're focused on budget and economic issues and fixing our debt problems. I'm here on behalf of myself and not the Peterson Foundation, so I just want to make that clear. It's funny, when I was thinking about this, I was driving in and my sister called me and she said, Dana, did you know that there is a new Spinal Tap movie, or I should say mockumentary, coming out? Does everyone know what Spinal Tap is? And I was so excited. It's coming out this week. And the name of it is called The End Continues, which is hilarious to me. And I thought, what a fitting name for the conservatorship of Fannie and Freddie, The End Continues. We haven't reached the end yet. It seems like a continuing saga. And I think that there are a lot of discussions that are very pertinent going on right now about what to do with them next, Fannie and Freddie. And I would argue that in a lot of ways, it shouldn't be too surprising, given there was a second Trump administration. And during the first administration, I think a lot of that groundwork was laid. There was a housing finance reform plan that came out, and I think that was 2018, 2019. And then at the very tail end of the first Trump administration, Secretary Mnuchin and Director Mark Calabria of the FHFA signed an updated preferred share purchase agreement that actually really did establish some of the rules of the road to allow the GSEs in particular to build more capital and actually kind of pave the way to take them eventually out of conservatorship. I think exactly what Chairman Hill was saying in the panel before this, looking at market stability, doing this in a safe and sound manner with a lot of transparency is going to be really important. But I would also say that, I think they are set up, Fannie and Freddie, to go along this path and to eventually come out of conservatorship. So when I say, a limited role of, I would say I'm more of a limited government person in general, but I think there is room for a lot, yes, I think there's room for a much smaller role for the federal government because we are a market economy at the end of the day, and we are Americans, and we like risk-taking, and we want to price that risk correctly, and we want to innovate and build, and government gets in the way of all of these things. So I have a lot of hope for the future, and I'm very excited to hear of the plans of the current administration to kind of keep going along this path.
Amazing. Ed?
I'm Ed Pinto, and I spent a number of years at Fannie Mae as Executive Vice President, Chief Credit Officer, before they went over to the dark side, as I called it, back in the 80s. I'm also a believer in the federal government having a much smaller footprint. That the road to that smaller footprint is not through Fannie and Freddie, though, because they are the government. No matter how we slice it, they are and will be the government. I would just add one other thing. The only thing worse than having two of them is having only one of them, and that's one of the items being discussed is just, well, let's have one. That would be worse than having two, in my opinion. Norbert?
Okay, thanks, Ed. Norbert Michel here with Cato. You're not going to hear a very different take coming from me here. I also believe that the role should be much more limited than it is. I think from an encouraging standpoint, Ed and I believe David was at one of the treasuries having these roundtables now, so it does look like, at the very least it looks like, Treasury is trying to go sort of plotting and carefully figure out this issue and what to do with the GSEs, and that's a good thing. Hopefully something good will come out of that. But they're listening to a lot of ideas right now, so that's good. Mm-hmm. On the pessimistic side, they've been in conservatorship since 2008, and we don't have to rehash all of that, but you can make a very good case for they shouldn't have been put into conservatorship in 2008. They should have been put into receivership. And the fact that they're still in conservatorship and that they're still insolvent, even after the Mnuchin and Calabria, we can start building capital again, rule change, by a couple of $100 billion is really more evidence that they should have been put into receivership. So fine, they weren't. So what are we going to do? Okay, well, and this is kind of to the pessimistic side, because I don't really see Congress doing much to change their charters. But the idea that we're just going to finally get the regulation right, or we're just kind of finally get the guardrails right, is kind of a joke, because we've never been able, ever been able to establish rules or guardrails on these companies that truly minimizes the risk and minimizes the footprint or anything good, right? It's always been a disaster. So I don't really have any hope for that just happening administratively, even if you do get a good rule, you know, with some kind of good capital rule or something like that now. It will get watered down later, just like it always does. And I don't have a lot of hope for Congress actually changing the charters. So what could you do? Well, I think the most productive avenue to go down is to finally, after all these years, having no administration ever doing it, write a rule that addresses the excessive use clause in their charters. And all that means is that the charters say, hey, these things are supposed to support the market, but they're not supposed to be, their facilities are not supposed to be relied on excessively. It's pretty hard to make a case that it hasn't been excessive given the market shares that they have. So just pick a number, go back to pre-2008, pick a smaller share, and just write the rule. And you know, I think that's probably the best hope for minimizing them, or shrinking them rather. That by itself will be controversial as anything, but you could do that administratively and shrink the companies. So that's what I'm hopeful for. I guess we'll see what happens.
Thank you. So I'm with the National Housing Conference. I'm David Dworkin. I'm the CEO. And we are the Unlikely Coalition. We include everybody from the biggest banks to the most progressive civil rights organizations and everybody in between. And people think, well, how could you possibly agree to anything? And the answer is you'd be surprised. There's a lot more agreement than most people expect. And on this issue, and I have participated in some of those conversations, I've also spent 6 years at the Treasury Department as a civil servant in both the Obama and the Trump administration. And so this does trigger a lot of PTSD for me. There's a certain amount of deja vu all over again when we talk about housing finance reform. But I think where the biggest amount of agreement is that we like having a 30-year fixed rate mortgage that people can actually have as prepayable. They can refinance when they want. They don't have to pay a penalty to do that. That it's fully amortizing, and that it's available in all parts of the country regardless of economic conditions. And that's the mortgage finance system that I think makes this country great. And what we don't want to do is threaten that. And so that means when it comes to reform, we're really talking about less is more. And we want to ensure that, and I think it's certainly incomprehensible that they've been in conservatorship for the last 17 years. That means that the government has basically run them, and that the taxpayer has been responsible for all of their losses. And nobody's gotten the benefit of their gains, frankly. So not shareholders, not the government, I don't know where all that money goes, but it's no one's actually gotten the benefit of it. So when we talk about release from conservatorship, frankly, one of the North Stars for me in all of this is the plan that Secretary Mnuchin wrote in 2019. I think it's very thoughtful, it's pretty conservative, and it really looks at these institutions and says, let's build on the regulatory structure we created in 2008 and focus on stability and predictability. And I think that's where my sense is that Secretary Besson and Director Pulte and ultimately the President, I'm hoping will want to go.
Amazing. Before we move into a few questions, I just wanted to let everybody know that you can submit questions for after our conversation via Cato's website, Facebook or YouTube, or on X using the hashtag CatoEcon. We'll also take some from in the room. And I wanted to start, David, with something you said about being here through Obama, Trump, and just sort of how long this has gone on. I know that in the last panel, Hensarling referenced, he was trying, this is what he wanted to do, it's what he wanted to do. And this is, it's no secret, every administration, somebody wants to do something. With Fannie Freddie, usually we want to release them from conservatorship. We've already had a Trump administration, and it didn't happen then. So what has been the problem, and what's different right now or is something different right now?
Well, it's to be determined. If it's different, it's early, and we could be talking about this with great sincerity and emotion for the next 3.5 years, and then say, wow, here we go. We're in year 22 or 21 of the conservatorship. I think that we're in a scenario now where there's an interest in moving forward. There is an interest in the White House to say that we want to actually be able to monetize the taxpayer's investment, and so I think that's a change. But part of the problem in the first Trump administration is that when you're Treasury Secretary, you basically have 5 priorities: don't screw it up. Don't screw it up. Don't screw it up. And then number 5 is, were you paying attention when we said the first 4? So when Secretary Mnuchin came in, housing finance reform was near the top of his list. And then you actually start doing the job. And it finds it's moving down as everything happens and comes up. And I think that, the challenge is going to be, can we actually maintain the momentum that we have now and get to a place where we begin that process of release from conservatorship? And what does that mean? The problem before then was that everybody was trying to create an entirely new housing finance system. And it is incredibly complex, and there are so many unintended consequences. And I think that what we found over years of doing this was that, everything that seemed like a great idea in March was a terrible idea in July. And that tells you just how complicated and risky this is. And so I do believe that this administration, this second Trump administration, is coming into this with a less is more approach. And that's not going to make everybody happy, but I do think it makes it more realistic that we can move out of where we are right now, which is basically a government utility.
Could I supplement that with a little bit of a perspective, and that is what happened really after the housing finance reform plan came out is COVID. And I mean, honestly, I think right now the Trump 2 administration is on the path that it was on before in terms of the discussions. I think the discussions that it's having today would have happened during his first term, but there was, a 100-year pandemic, and I was FHA commissioner at that time, and I mean, really the priority was stabilizing the housing market, keeping people in their homes during this very serious health crisis for a year, and so I mean, I just don't think you can underestimate the impact of COVID on all of this. So I think things are picking up again. Interestingly, though, the market was probably in better shape to talk administrative housing finance reform before COVID.
And I also think we never give ourselves enough credit for our successes. I think the Housing and Economic Recovery Act of 2008 was an incredible success. A lot of what needed to be done in housing finance reform was done in that bill. It enabled them to be put into conservatorship. It created a new regulator. But we also don't give ourselves enough credit for avoiding so many horrific things economically that a million people died. That's the biggest thing. But economically, we avoided a lot of really terrible outcomes, and it's because of the leadership that we had through that crisis.
Let me focus on something that both David said and Norbert. Norbert talked about potentially a path is to focus on that charter provision about excessive use. David described around the 30-year mortgage what I call the unicorn. David defined a unicorn. We want the 30-year mortgage to be fully prepayable without penalty. We want it to be available in every market. We want it to be available in any part of the country. We want it to be supported by the government. This is what we want. That is a unicorn.
And we don't want to pay for it.
And we don't want to pay for it. And we want it to be free. And the problem with that is the only way that unicorn exists is with government support, both the implicit or some type of explicit guarantee, or even more importantly, buying the debt. And so since the beginning of the 30-year mortgage, which really came about during the 1960s, not during the Depression, it didn't actually come about until the 1960s, Fannie Mae, which was the predecessor of Ginnie Mae, was buying those loans. The thrift industry gets into it in the 70s after Fannie Mae starts taking over the conventional marketplace and does 30-year loans with a portfolio. Then the thrift industry does 30-year loans with the backing of the federal government. And then Fannie and Freddie get into it, and they go collapse in with the conservatorship. Then what happens the next day? Well, no, excuse me, the same day. The same day, September 8th.
It was September 8th.
The Fed starts buying 30-year mortgages. And where are we today? It was mentioned a few times. I asked a question about it. The Fed ended up with $1 trillion loss on their investments. Why is that? Because nobody wants to hold the risk. But you got credit risk, but you have this convexity risk. And it's that convexity risk that nobody wants to hold. And when they get left holding the bag, they say, well, government, you have to bail us out, which there was a lot of discussion about the Silicon Valley Bank and all these other banks with the $500 billion of negative. Don't forget that the Fed had $1 trillion. So what's one of the proposals today? We need the Fed to be there to buy this 30-year debt. If this actually was not a unicorn, you wouldn't need to do it.
Yeah, any proposal that involves the Fed stepping in and buying federally backed loans is always a little scary.
It's very scary.
I think Ed nails it. I mean, we want everything and we don't want to pay for anything. The housing, like what I think of as the housing crisis that we're faced with, is that everybody thinks housing should be more affordable, but nobody thinks housing prices should ever fall. You know, we always fall into this trap. We always want something for nothing, and we always have these ideas that don't always mesh. And we look to government for the solution, and that's, okay, fine, make some kind of framework. But the mistake I think that we're making, or that we've made, is that this idea that the government should design this system, right? That's wrong. What we should do is have the government step back and set up a set of rules and let people design these things, let people figure these things out. Financial markets are good at spreading risk around if we let them. When we run to the government and we say, no, we want you to hold this risk, or we don't want them to take that risk, and we start doing all of these things, that's when we get into trouble. And that's, I guess maybe I'm wishful thinking with this now, right? But I mean, that's what we have to have, somebody to have the courage to stop doing.
Gotcha. So we talked a little bit about the Fed's role in the mortgage market, and obviously quite a lot. We're going to talk quite a lot about Fannie and Freddie in the next 45 minutes, but there's obviously other ways that the government is involved in housing finance. Is the Fed the other one we need, in y'all's estimation, that we need to get out of there? Are there other programs that you think are particularly harmful? Are there any we should keep? I guess let's separate Fannie Freddie from this conversation for just a moment and talk a little bit about the other ways that the government is involved in housing finance reform and what ideally happens there in the next 3 years.
Well, there are two things that come to my mind. Number one, there's an entire market out there. Everyone talks about liquidity in the housing market, and it is very important. And I think to some extent uniformity, but mainly kind of knowing how to price risk. There is an entire jumbo loan market, which is all private label security. So let's not forget about that piece, which I know has shrunk a little bit this year, but it's still like a $400 billion market. So that's pretty substantial. And obviously those are loans kind of at the top end of the income spectrum. However, I think it's also a good model for pricing risk, because you are looking at the security and you know exactly the risk of the borrower when you're kind of estimating that and securitizing it. I think that to say that there's a world that exists, there isn't a world that exists without government, I think that's a bit of a misnomer. But the other piece, so I've talked about kind of the high income in, the low income in, which is the Federal Housing Administration, which is, It's interesting. I ran the FHA, and it is, I would say, even for limited government folks, it's an essential safety net. And I think if you believe there is a role of government, potentially it could be in supporting first-time home buyers, which is really the mission of FHA. The thing about it, though, I will say that's a bit worrisome to me, is that the FHA market has a little bit, post-global financial crisis, turned into the subprime market. There are a lot of pretty low credit quality loans on the books of FHA. I think the default rate is something like 10.5%, which is very high in housing. And that probably even underestimates it. Ed is an FHA expert too.
There's all of the
because you
loans
have
that
a
kick
lot
down
of
the
partial
road.
claims, right? There's a lot there, but I think we should be keeping an eye on that. You want to obviously preserve FHA. I think there's a great team at HUD. Secretary Turner, I know, is very well aware of this, and he wants to make sure that FHA remains a source of financing for first-time home buyers and those who are at the lower income end, and especially lower down payment. But I think we should keep an eye on FHA as well.
I think the Fed has been completely incompetent when it comes to housing. Number one, what they did with keeping interest rates so low and then buying all those trillions and trillions of dollars of Treasury and Fannie Freddie Ginnie debt. And then they said that we're going to keep rates low in order to help get people into houses as they were fueling a massive house price appreciation boom that we still are living with, that then froze the market. They've just been completely incompetent and asleep at the switch. So they should follow the original rules of central banks, which is if you want to bail someone out, it's in a emergency. You, number one. Number two, you lend to people that put up collateral, and it has to be good collateral. The Fed only realized the first thing. You do it in emergencies. They forgot all the other rules. And that's a problem. And then the second problem is they have this view, and they have hundreds and 1,000 economists, literally 1,000 economists. And the economists don't know anything about housing. Sorry, they don't. And they basically say, we're going to look at the CPI, and house prices are going up 30% year over year in markets all across the country. And they go, that's not a problem. There's no inflation. It's transitory. Excuse me, on what planet are house prices going up 30% year over year? In
some case, 50%.
Yeah, in markets all across the country, 16% on average. Is that transitory? But to them, that was transitory.
Mm. The only thing that scares me more than the word transitory is new paradigm. And I think that and I don't want to get on the Fed bashing bandwagon here. I think that in the Great Recession, when they started buying, MBS, that we were in an enormous crisis and people were making it up as we went along. And there's no way to know just how bad things could have gotten. So to pick apart things, well, they couldn't have done that or shouldn't have done that. But they took on over $1 trillion in mortgage-backed securities in their balance sheet.
$4 trillion.
And that's right. There's $1 trillion left from that period. And they let it run off over time. And then we thought we were going to see that kind of taper off. And we ended up with another very significant crisis with COVID. And it was like they had this toolbox with this one big shiny tool in it. And they were like, let's use that again. And so now we have $2 trillion. We've doubled the amount of securities that they're holding. And they're all at very low interest rates. Those things are not running off. They're going to bleed off very, very, very slowly, because if you've got a 2.5% mortgage, you're not going anywhere. That's part of the problem we have right now is people aren't selling because they can't afford to go from a 2.5% mortgage to a 6.5% mortgage. And this is, the thing that I also worry about is that the president is talking about a housing emergency and actually declaring an emergency. What's the end game there? I'm concerned that the government not double down on this. Let's think about it in a market context. But if we're going to end up with the Fed buying more mortgage-backed securities and treasuries to get interest rates down, I'm worried that we're going to have a much bigger problem, a couple of years from now. And when you talk about kicking the can down the road, it's we could end up with really a horrific inflation situation. And inflation is the ultimate bipartisan hater of all politicians. It attacks everyone just the same way and just as effectively.
Yeah, absolutely.
And this, okay, I agree with this, but I think we could probably do a whole another panel or two on how should the Fed be structured and how much discretion should they have. And the truth of the matter is they have so much discretion right now that, it doesn't really matter what we think. They can buy as much of that stuff as they want if they want to. Like, it is a tool that they have and they'll use it, and that's the end of that. And a lot of people don't understand, we won't get into all those details, but the operating system that they have kind of excuses that, and they could keep doing this again and again and again. So like that's something that needs to be addressed, I think. But
you should have a conference on that.
Yeah.
We might do that. maybe that'll be our topic next year. Maybe
Great.
that'll be the FHA issue, though, right? I think I agree with Dana in principle. We could say, just for example, that whatever help we're going to give to whichever group we're going to give help to for housing, like that should be the FHA. Look, that's fine, but Congress has to do that.
Absolutely.
So like
yes.
Okay.
Right. It's
So
explicit,
leaving
it's
that
on
aside.
budget.
Yes.
You know the cost.
Yes, and the same thing with the Fed. None of that's on budget, right? And that's all kind of a fantasy, right? It makes it seem like, it doesn't really cost anything.
Right.
It does.
Right.
So I don't really have any faith that Congress is going to do that, which is why I'm pushing this excessive use thing. But then separately, I think, that is also worth talking about. If you have somebody, so we have these affordable housing goals, this is something else that Congress should address. If you have somebody who has low or erratic income, who hasn't ever owned a home, right? Is it really helpful for them to take on, say, a 30-year fixed rate mortgage with nothing down, or 2% or 3% down? Is that really good financial advice? I don't think so.
Well, it is if they're going to end up paying less than they were in rent, and they have a history of paying their rent.
Well, that's not a given.
No, but I think that's part of how
That's
we
a risk.
underwrite.
But that's a risk.
That's how we underwrite a mortgage. That's how we decide.
I agree with that. That is how we're doing it. But if we're talking about how should we do it, I'm saying perhaps we shouldn't. If I were a financial planner and I gave my client that advice, I would have my license revoked.
Let me add two things to the idea that Norva just came back to, which is this not excessive use. So back to the unicorn. If you want to get away from the unicorn, there are two things you could do. We used to have prepayment penalties in this country. There's nothing wrong with prepayment penalties, absolutely nothing. It's just paying something for what you're getting. And so you could say you can charge prepayment penalties, you can not charge prepayment penalties. Let the market decide and let people choose what they want. That would actually do two things. A, it would shift the risk back to the consumer where it should be, from the taxpayer, because that's fundamentally, the taxpayer's taken on that risk. They've done it 4 times now. They did it with the thrift industry. They did it with Fannie Mae in 1982. They did it with Fannie and Freddie in 2006, and now they're doing it with the Fed. So, excuse me, how many times do you have to go through this? And so let's bring market reality back to that and get away from the unicorn, which would also allow the private sector to actually offer those loans, and then you'd have more private loans taking the pressure off of Fannie and Freddie, allowing to shrink. But the third thing you could do is and that would reduce spreads, because that's another goal that is mentioned. Oh, we want spreads to go down as part of this reorganization. I don't believe that'll happen, but I do believe spreads will come down if you started introducing prepayment plans. The third thing that they say they want to do is they want to reduce the closing costs. They're $13,000 or whatever the amount, on a house. Well, getting Fannie and Freddie to do that, or getting the government to make anything affordable, is an oxymoron. It doesn't work. It's never worked. And so they're the last people in the world that you'd want to try to reduce those costs. How do you reduce those costs? Well, you say to originators, if you originate a no closing cost loan, you will be given these 5 benefits in terms of regulatory relief on RESPA and the Truth in Lending and the this and the that and CFPB. And we want you to do that because you're in the position to actually negotiate lower prices. The consumer isn't in the position to do that. The example I would give you go buy your car from the dealer, and the dealer says, now you have to arrange to get it transported from the factory to here. You go do that. Well, excuse me, you're not going to get a very good deal doing that. On the other hand, that's what we do with closing costs. You go out and find all these providers of these services, and you go negotiate prices, which you really can't do because you're buying, it's a one-off, and you do it once in your life, once every 10 years. So if you let the lenders do this, then all of a sudden you'd have downward price pressure on that, and they'd be really interested in that.
Well, two things. One is, I do believe I paid a delivery fee the last time I bought a car, and I didn't like it one bit.
You didn't have to negotiate it.
I always take that thing off.
Yeah,
You got to
good for
negotiate
you.
harder.
There you go. So there's that issue.
She's
And
not
then
getting her personal finance license revoked.
when it comes to unicorns, they're very cute, and they are very rare. And
My granddaughter loves them.
And the U.S. housing finance system for mortgages is absolutely a unicorn. I would suggest we not kill the unicorn. I'm not going to bet on finding a new unicorn. I don't think we've been very good at that. But don't kill the unicorn, because we have in this country the most successful, envious housing finance system in the world. I know, Ed, you don't believe that.
I don't believe it.
I do believe that people in this country would have a real problem if our homeownership rate went from 65% to 45% or 50%.
David, let's be realistic.
I absolutely think that.
Stick with your unicorns, but that's not going to happen.
But I think that the reason we have such a high homeownership rate here is because of the mortgage finance system that we have. It's served us very well. It is not perfect by any stretch of the imagination, but I think that most people are really happy with the mortgages that they have, and the fact that they're able to become homeowner, and the fact that you can actually become a homeowner putting 3 or 5 or 10% down instead of 20 or 25%, especially where housing prices are, given the fact that your mortgage payment is going to be less than your rent. So I think overall, that's a pretty good deal.
May I just say something, though, in terms of, and that may be true. I think that consumers don't know what they're missing, though. Because anyone who has read the Housing and Economic Recovery Act, I think everyone on this stage has, or looked at sort of the requirements in the PSPAs, which is the agreement between Treasury and FHFA, or looked at kind of just the conservatorship in general over time, it is such a limitation to innovation and growth in the housing market. This is one of the least innovative markets. We are in an age where we have so many advances in AI. We have things like the blockchain. Housing finance has not really availed itself of any of this. It's a very static market. So to your point, I think there are a lot of innovations that can happen, but they're not happening. No. And I think a lot of the reason for that is the conservatorship, and because it sort of acts like a ball and chain for the housing market, holding it down. And I think it really should be a goal, because we have to, as an innovative economy and an innovative nation, we really kind of have to look to the future and think about not how content home buyers are now. I think there are a lot of content home buyers who are at least in a lower rate mortgage, but what are they kind of missing out on in terms of where the industry could go if it weren't being held down by conservatorship?
Well, all roads lead back to Fannie and Freddie.
Sorry, yes, I know you wanted to get away from that.
No, it's great. I did want to talk a little bit about what does actually releasing, what levers currently can both the administration and Congress pull that gets us closer to releasing Fannie Freddie? Is
closer to what?
Releasing Fannie Freddie, sorry. Does this look like something that has to go through Congress? Is this something the administration can do largely? Norbert, I see you shaking your head, so.
Yeah. No, I don't think Congress has to do anything at all. I think it's completely in the administration's hands.
Well, wait though, the charters.
Well, the
tax status.
Goes, but actually releasing
goals.
them.
That's right.
But actually releasing them.
That's true.
Congress is out.
And I don't think we have to do it all at once. I think that what we have is they're in conservatorship now. We can certainly release them from conservatorship. Then the question is, well, what are the components that we actually fixed in HERA? That's not going away. And then what's the part that out of conservatorship we really need to address? Some of those we can address in this PSPA by having a new amendment to the PSPA. For instance, it says the regulator is going to have certain powers that they should have had if we knew what we know now, we would have put it in HERA to begin with. So we're going to give the regulator these powers in what is basically a consent decree. And then we're going to go forward and we're going to say, now Congress should look at this. We're out of conservatorship. The government isn't running the organizations anymore. They have boards that are reporting to their shareholders. but they also have a safety and soundness regulator. And Congress is going to take the time to say, okay, so what do we still need to fix? One of the obvious things is, are you paying for these benefits or aren't you?
Right.
And how much are you paying?
Exactly.
And we absolutely need to address that. But in the
Well, Hera
meantime,
addressed
I
that.
don't think we need to address that before we say, let's take some of these steps.
But let's be clear. In the entire time of Fannie and Freddie, they have never paid a nickel, a thin dime, a penny that's being taken away. They've never paid a penny for their guarantee, full stop.
That's right.
And
Because they officially don't have one. That's the nature of the implicit guarantee. It's
well, no,
implied.
but they've never paid for it. But the senior preferred stock purchase agreement provided for one. And who had to approve it? Oh, I'm not to mention the Fed anymore. Excuse me. Banana had to approve it. It's never been approved. There was a fee in the stock purchase agreement. It has never been levied. But Congress wants it that way.
And the PSPA is a big problem.
Yeah.
I mean,
Congress wants it that way.
In terms of getting them out.
This is not a bug to Congress. This is a feature.
I think so.
But remember, that's the reason for that is because it's the person who's paying it is the taxpayer.
And Congress
the
care
taxpayer
less.
is the ultimate, player who's paying it, but they're also the homeowner. And so who's going to be paying the taxpayer is the person who actually gets a mortgage. And that's
Except for all the people who can't.
Except for the people who can't. But we have a lot of people in this country who do, which is great. And frankly, I would like to see more.
But there's no reason to believe that you could not get to the same home ownership rate without the Fannie and Freddie system that we have. I mean,
Internationally, most countries are at or above where we are.
Well, they're not.
They are.
Most countries do not have the home ownership rate that we have. And the countries that do actually
but
put
they
a
do.
lot of government subsidy into their mortgage finance systems in different ways than we do.
They do differently, but we're not at the top of that list.
Yeah.
Can I just say, though, I think your question was what can be done administratively? Like, to this point, a lot.
Oh, yeah.
We think
Yes.
everyone talks about recap and release. Recapitalization. So there's the enterprise regulatory capital framework, did I get that right, that FHFA has put in place, which it determines the capital levels in terms of the amount of retained earnings that the GSEs can keep. That's a pretty important tool because as I think they mentioned kind of on the prior panel with the two Financial Services Committee chairmen, according to most estimates, Fannie and Freddie, in order to be safely 100% recapitalized, they're probably about $200 billion short. I think Director Calabria would say they're a lot more short than that because he wants them to operate more like a bank, which is a very valid view. But I think building capital, I think there's been a lot of talk about sort of an IPO and what that means and what percentage and what you have to do. Well, you'd have to exercise the warrants. Right?
Well,
you'd have to exercise the warrants first, turn it into common.
You have to exercise them by a
common
date
stock.
certain in about 2 years.
Yeah.
Right, well, that's true, right?
Expire.
Unless they get extended, that can be
That's a whole
extended
nother issue.
administratively.
Well, that may be able to be done administratively.
Okay.
There's probably a lawsuit about that.
Okay.
But they do expire
there will.
in 2028. They expire September
Explain the
8th,
lawsuit
2028.
issue. What is the issue there? Just so we're.
So when Fannie and Freddie were put in conservatorship, they had a number of things. They were given this backstop where Treasury would buy Fannie Freddie debt and also pay their losses. But in return, the Treasury got 79.9% of the warrants to buy 79.9% of the common stock of Fannie and Freddie, and the warrants are at a price of, bottom line, we could pass a hat around and there's enough money at a very low price, because at the time they were worthless.
Right, if the face value is.
The face value is worthless. So, and they also got the senior preferred stock had to be, the money they advanced had to be paid back. That became senior preferred stock. And then they had the liquidation preference. And so there's a series of things that are supposed to come to the taxpayer. I wouldn't plan on buying your Christmas presents from any of this. No. The government mortgage complex will make sure that money never comes to the taxpayer. It's just the way the animal works, because this is a unicorn. There isn't any money to do all this.
And the PSP has been amended, is it 4 times now? 4 times?
I've lost track.
Five, and it's all administrative, and there's no break on what they amend.
Yeah.
No, because we've changed
So,
everything
that's right,
at
that's
least
right.
once in the PSPAs, and we'll change
That's right.
something again.
And they'll do it again, yeah.
Well, they've left in the unicorn fee.
They have left in the unicorn fee, because a beautiful unicorn should at least get a fee. But I think that as we move forward on this, the question is, what's the value of moving them out of conservatorship? And this administration has been clear that the government should get paid. And the way they've talked about it, or begun to talk about it, is that they're going to do, it's not an IPO because there's nothing initial about it, but they're going to do a
public
secondary offering that is going to sell stock in these entities, and then the taxpayer will get the benefit of that in one way or another. I think
As
that,
will the GSEs, though, because it'll contribute to their retained
well,
earnings.
it can't yet. I think the way the law is structured is it can only go to deficit reduction, which is not an inconsequential value for the taxpayer to begin with. So at a minimum, without any legislation, any sales of stock goes to deficit reduction. And that is a value for the taxpayer. If we decide we actually want to alter that, we could amend that one clause of Dodd-Frank, and we could say the proceeds are first going to go to full capitalization. And I think that makes a lot of sense.
Right, but see, you say it goes back to the Treasury, but then the Treasury can decide to allow that to be.
It cannot.
Go back into. Oh.
Yeah, no, under Dodd-Frank, there's a clause, it's hidden in there, but it says you absolutely can only use it for deficit reduction and nothing else. No pay for, no nothing. It disappears and it ends up on the balance sheet, but there's no, you have to go back to Congress to actually spend it on anything else.
I get it, but it's all fungible. So,
well, there's
I get
that.
it. I get budgeting, but
Yes.
Sounds like a way to change the CFPB provision.
yeah.
Man, my job, all roads lead to Fannie and Freddie and the CFPB. It's incredible. One of the things that it sounds like the administration, without Congress, can do quite a bit. However, sort of the two people tasked with this right now is Treasury Secretary Bessent and FHFA Director.
If they don't punch each
Bill
other out
Pulte.
first.
Well, I mean, we're sitting here talking about a very serious finance topic, and yet these are the two people who are supposed to be working on this together. And let's generously say they have a personality conflict. So, how does is that a problem? Is that something that you all are thinking about, or what does that mean for the next couple
It wasn't until a couple weeks ago.
Yeah.
Well, right.
Last Thursday. Yeah.
Or whenever that
Just
was.
was very.
I don't know.
I think there's a lot of room, and actually there are a lot of serious people working on this, both in the administration and Congress. So I don't want to overlook that, and I don't want to say just because you have a disagreement with someone that you're not a serious person or a serious mind on housing finance. There are a lot of opportunities for them to continue to work together, even with frictions. At the end of the day, there are two signatures on the PSPAs, or the Preferred Share Purchase Agreements, the Treasury Secretary and the FHFA Director. So, I think that will bring them together, despite everything that we've read, which I think has given everyone a lot of entertainment value. But the reality is they're both doing their work. They're both hosting kind of roundtables and getting as much information on this as possible, and talking to experts in the industry. So I think, again, they're moving along the path and taking the steps that they need to take.
Yeah, I think they're both very serious about this process. I think they're serious about working together. I think they clearly have some very strong feelings about this, and maybe each other as well. But this is Washington, D.C.
Yeah.
They will not be the first two people who didn't get along that reached an agreement on something that was either good or bad for the American people. I'm hoping that they're going to reach an agreement that's good for the American people. And when it's done, they may like each other more or less.
Right.
But it's almost a cliche here that people at the negotiating table may not love each other.
Right, exactly. I mean, I think it'll all work out in the end. And also, I mean, you have the president as a very important decision maker, and I think both of them will adhere to
and they all
his
agree
decision.
on that.
Yes.
The president gets to make the
Yes.
decision, and he will, and he's been clear that he's gonna.
Sure. The other thing that Treasury Secretary Bessent said is that we need to move very carefully to avoid raising mortgage lending. He said deliberately. because of concerns about mortgage rates going up. Is there a way to do this without mortgage rates going up? And I mean, it sounds like we're having a bit of an ideological talk earlier. Is that the goal? So what mortgage rates go up? Yeah.
Okay, so first of all, I think that should not be the goal. Not that he's going to listen to me, but and then maybe the number's a little different than the number I'm about to throw out, but until around maybe like 2015 or so, I think the consensus academically was that the subsidy provision that was given to Fannie and Freddie was maybe worth ballpark 25 to 50 basis points. Is that really a calamity? I mean, look at where interest rates were pre-COVID and look at where they are now, and we're going to really worry about like 25 to 50 basis points on mortgage rates? I don't think that's really worth stopping anything over. I don't think that should be the main concern. Again, I think that's like if you do a lot of these reforms and get the government out, you're going to get a rate that is more appropriately priced, and that's fine, and that should be the mindset.
Yeah.
I agree with that. I think if you do it right, you're probably looking at 25 basis points or less. And if you do it badly, you could be looking at 100 basis points. And so I
Which for those
really
at home,
do not want to see that. I don't think any of us do. But it's, I think the question is the Secretary taking the risk and the complexity seriously? And I think he clearly is, and I think it's very important to keep that in mind, because you don't want to be cavalier about how much rates could go up. This is the law of unintended consequences is never repealed, and there are a lot of potential unintended consequences here, and much higher rates is one of them.
I would argue they have no idea about what the effect would be on whatever they do. I would say that. The Fed, to come back to the Fed, whenever they have their meetings, they have their dot plots and stuff. They know nothing about what interest rates are going to do. They're always wrong.
Long-term interest rates are very hard to
well, even short-term. I mean, they just go they can't do anything. And they control.
There's a lot of noise.
There's a lot of noise and stuff, but they come out with these dot plots and they're always wrong. And so, but I'm not expecting them to figure it out. Why would the Treasury Secretary or FHFA or anybody else be able to figure out? I just remember, what the treasurer at Fannie Mae said back when I was there, when asked about what are interest rates going to do. He said, I have no idea. All I know is I sell Fannie Mae debt every 2 weeks. And when I sell it, I decide, do I like the rate today? And if I do, I maybe borrow another $50 million, back when millions were numbers.
Can I just say, though, I also think that the housing market is not a delicate snowflake. It is resilient. I think bond markets in general are. I mean, there have been a lot of changes if you look at tariff and trade policy this year. And, for the most part, markets reacted and then they stabilized. So I'm just kind of viewing if you're selling off, 5% or whatever of Fannie and Freddie, that to me is something that the markets can recover from. I think as long as you have a long-term plan and that you communicate transparently to the public and to markets, that it should be something, that everyone can kind of hold hands and do. And the other thing I'll add is that I think increasingly, we know that the benchmark for mortgage rates is the 10-year. And increasingly, the 10-year is even becoming untethered from Fed decisions, and the ability to control that is really something that we need to keep an eye on. I think it's so much more about, and that's the number one job of the Treasury Secretary, right? He manages bond markets.
Sure.
And there's so much there, that complexity in bond markets that's really going to drive mortgage interest rates that have nothing to do with this discussion.
And Ed's right. I mean, we really don't know what's going to happen to interest rates. If we did, I would be having this meeting on my yacht.
Yeah, exactly.
Right.
So it's the question is, wherever rates go, we don't want to double down and make them get worse faster.
To clarify,
because before we go to questions,
really fast to clarify, I'm saying maybe it's 50, and even if it's 100 basis points, we're talking about that's worst case. Get rid of them, annihilate them, right? Nobody's talking about that. They're not going to disappear. Right? The money, the institutional investments that are going to buy these mortgages and make these securities, that's not going to disappear. So there's no reason to think that worst case scenario would even play out. And the worst case scenario is smaller than the rate change that we've had since COVID.
Well, sure.
Smaller than the rate change we've had in 4 weeks.
Let's take some time for some questions here. Does anybody have any in the room?
Hi, Justin Chardon. Thanks for the discussion. Real quick, I think it's not quite fair to say that the GSEs have not been, or been in a black hole of innovation during the conservatorship. They've created the common securitization platform in UMBS, the credit risk transfer regime, loss mitigation framework. Now, maybe they would have done more outside of conservatorship, but just to add that in. My question is about Treasury's responsibility to the taxpayer in an exit. And there is tension between maximizing taxpayer value and making the GSEs valuable to investors. How do they, what legal responsibilities do they have to try to maximize the taxpayer's share in an exit?
None.
Yeah, I mean, if you go by the PSPA, that's spelled out as basically liquidation preference in these fees. I think there's an incredibly high chance that they will say, okay, we're done. We don't have any liquidation preference or something.
I think you're right.
Something along those lines.
And to some extent, it's a distinction.
Not that I think that's a good thing. But
yeah, but I think in some extent it's a distinction without a difference. 65% of the taxpayers are also homeowners and home buyers. And so the question is, who's getting the value? Now, if you're going to have the taxpayers paid at the expense of 65% of the American public and probably 85% of the people who are voting today, then you got a problem politically. So ultimately, I think the liquidation preference will be what we say it is.
Go back to Silicon Valley Bank that was talked about this morning. Those depositors were supposed to lose all that money. They had no more, the taxpayers, the FDIC, what happened? They made a political decision and they all got reimbursed. Full stop.
Yeah, and the reason we do that is because we recognize that the scope of the crisis could actually create more crises on the back end of it. The reason we bailed out AIG isn't because we liked AIG. The reason we bailed out AIG was because of all the other companies that would go bankrupt if AIG went bankrupt.
Yeah, contagion. But also under a receivership, right, there is no, the structure is pretty clear in terms of who gets paid out first, but we're really living in a situation where it's not clear. And there is no, there's no predetermined structure in terms of priority.
And to your point about innovation, I would just say that the whole, and I can go through each of the items you mentioned, but the thing about this common securitization platform, that was originally supposed to be so that private sector and Fannie and Freddie and the federal home banks, everybody got to use that. That was the original plan that Ed DeMarco came up with, and that's how it was originally pitched. And it got peeled back until it eventually became just Fannie and Freddie, and it actually, truth be told, and I can tell this because I know the history of this, it really was just for Freddie. Freddie was the one that couldn't compete. Freddie was the one that had the pricing difference on its security. And once they came up with the common platform, which Fannie paid 60% of, even though they got zero benefit from it, that benefited Freddie. That was all a political decision.
Okay, I'm going to take one from the queue here. To what extent is housing finance being asked to solve problems with access that arise in entirely different areas of policy, such as zoning policy that affects supply? So I wanted to talk a little bit about this because I know there's a housing bill going through Senate Banking Committee, passed unanimously out of Senate Banking Committee, that addresses housing supply by giving federal funds to municipalities that have certain kinds of regulations. So I wanted, as we're talking about this, is that an acceptable way for government to get involved in housing finance or housing availability? And I don't know, to what extent do these two things overlap?
Well, there's a big difference between an incentive and a mandate, right? I think incentivizing local jurisdictions to make good decisions is one thing at the federal level, but mandating or controlling or in any way making those decisions and superseding local jurisdictions is a bad idea.
Yeah,
so I think that's the fine line there.
But we've had the housing bill, just to say, was put together by Senator Warren and Chairman Scott, and those are not your typical partners in writing legislation. The bill passed what is, by most definitions, a reasonably partisan committee unanimously. That says a lot.
It certainly says a lot.
Bad sign.
I will agree with that. I'll just leave it at that.
So I called
said, I'd like to see this bill move forward.
I called the road to nowhere.
Magic wand.
I call it the road to nowhere. And let's just talk about the one thing that was just talked about. Excuse me, Dana, but we've got a history of this providing these incentives without mandates, and that was the PRO Act. And it started with $25 million and then went to $85 million. Now, as the consolation prize, Senator Warren gets $1 billion. She had $8 billion.
That's a lot.
$8 billion in the original housing, whatever they called it, bill that failed. And so what does it do? And how did HUD implement it? It basically rewarded cities that promoted affordable housing, inclusionary zoning, and things like that. Market-based solutions were not looked at. And so we've written up, the history of this thing. And so this would just continue the same government tilt towards subsidized housing and inclusionary zoning. There is a solution. The solution.
And I wasn't commenting on the specifics of the bill, by the way.
But this particular
feature
is a really bad one because we have a history of it. As HUD has implemented it, and HUD has implemented it. But we do have a solution, which is through the states, not the federal government. Texas just passed SB 15 this session, signed by the governor, and it basically does two things. It provides by right the ability to have, for larger cities in Texas, you can't have small lot sizes, minimum lot sizes larger than 3,000 square feet. Generally, they were at 5,000 to 8,000 square feet. That's a huge change for the state of Texas to crimp the powers of their municipalities. And secondly, they, by right, said you can build residential housing in commercial zones, something that when Pew did a survey had 82% support, and they passed that by right. Those two bills, I think, are going to be game changers, and we need more states to do that. It'll never come through the federal government or the Road Act.
What is the federal role in all that?
None.
Exactly.
None. There is no federal role.
Thoughts you wanted to finish up there? Are we good?
No, I think Texas has been a leader in this for 100 years, and there's a reason why in a lot of crises, Texas has done very well, including the Great Recession and with the recent housing price crisis, because of property rights approach that is often, it's often a leader in.
Excellent. All right, any other questions? Yeah. You say your name and affiliation, please.
My name is Ömer Akin. I'm from Turkey, from Ministry of Trade of Turkey, and also I'm a JD student at George Washington Law School. I would like to ask one specific thing, like when it comes to housing, I feel sometimes systemic risks regarding macroeconomic situation is also an issue. And the more people pay actually, high interest rate on mortgage, then their, mortgage payment share on their disponible income is increasing. And they cannot pay, actually. Their risk of default is increasing as well. So, like, to me, the more you pay high interest on, mortgage, then it creates more burden on individuals and difficult to finance, and then it creates risk, and then if they have default, housing price will collapse because other people will not afford to buy the same housing again. I'm not saying that the crisis of 2008 gonna happen again, but just high interest rates creates a systemic risk on housing market. How federal government can address this with, good monetary policies?
Control your fiscal budget, right? That's a big driver of inflation, especially as we have...
And interest rates.
And inflation is a driver of interest rates, right? And so the need for fiscal reform and how it ties into housing, it can't be overemphasized, in my opinion.
And what actually has happened in the United States is that as interest rates have gone down, debt ratios go up. And then, they actually just keep going up. So interest rates are here, interest rates are there, interest rates are here, and the debt ratios just keep going up. Because under the CFPB rules, Fannie, Freddie, and FHA maximum debt-to-income ratio, 57% pre-tax. Fannie and Freddie, maximum debt-to-income ratio, pre-tax, 50%. Back in the late 80s, it was 36% for Fannie and Freddie, probably about 44%, 45% for FHA. We've really taken the debt way up, and interest rates are lower than they were back in the 80s.
And you can say the systemic risk part. You can say rates go up and that causes the payments to go up, so that's a systemic risk. But if they go down, just like Ed said, then the debt goes up. So then that's a systemic risk. So there's no way around the systemic risk. So that should not be the focus. That absolutely shouldn't be the focus.
Well, and that is the case you've just made, and everyone else says, for a 30-year fixed-rate mortgage. Because in a fixed-rate mortgage, it's the investor in the mortgage that has to manage the interest rate risk, which a sound investor is capable of doing, as opposed to saying the consumer should manage their own interest rate risk. And then what you end up is, if we didn't have a fixed-rate mortgage and interest rates had gone up 200 basis points like they have, you would have a real foreclosure crisis in this country that we have not seen.
We already have a foreclosure crisis in this country.
We don't have it now. We had it before, but that was a demand-driven.
FHA has taken something like, I forget the percent, 8% of its portfolio has been to kick the can down the road with temporary, what do they call them? Partial claims. Partial claims are the new way to hide foreclosures or loans in foreclosure. And we track it every month. And every month, the total, it's a 12-month running total. And every month, it's $500,000. So there was last month, for 12 months, it was $500,000. 2 months ago, 5, 6, 8, it's always $500,000. They just keep they keep putting more and more people on a rolling basis. They only have 8 million loans, yet they somehow keep having 500,000 having partial claims, which, by the way, they then, I believe, say isn't going to cost them anything because house prices are going to keep going up in perpetuity. Well, we just got the latest house price appreciation number for the month of November, which we can project using data we get, and it's 0. So across the country, it's 0. Now, some places are going up, some places are going down, but it's 0. So FHA has said we're never going to make losses on these partial claims that we're making out of the fund. We're not going to make losses on them because we're going to get the money back in the future because of house price appreciation. I wouldn't take that bet.
Right. You mean the full-on partial claim, you tack it to the back of the loan.
They tack it to the back, and then on the assumption that house prices just keep going up and the people will be able to pay it.
Right.
Well, what we did was we helped a lot of people not lose their homes during COVID when they lost their jobs through no fault of their own. And we said, we're going to let you take these payments instead of putting you out on the street in the middle of a pandemic. We're going to take those payments and put them on the back end of your mortgage.
But
these people went back to work because we now have very healthy employment scenario, and they are paying those mortgages.
But why are they still doing
that was made permanent, right? When I authorized that, it was as a temporary response to a global pandemic, making it permanent and essentially subsidizing rates. You know, it sounds like a good thing to do, but there are a lot of implications. And in fact, I think a lot of those have driven the increase in defaults, and I think you're going to see more.
All right.
Again, it's 500,000 every month. It's a rolling 500,000. When did the pandemic end? That was years ago. This is still going on.
Right.
All right, I think we need to start wrapping it up.
Thank you. Thank you, I appreciate it.
Thank you.
Awesome. We are now going to take a 15-minute break. Join us back at 3:50 p.m. for the panel discussion, Federalism and Financial Regulation, moderated by John Hill of Law 360. And thank y'all for a lively and very interesting discussion. Appreciate it.
Thank you so much. Thank you.
Appreciate it. Great to see you. Thanks.
Great to see you.
Welcome back once again to Right-Sizing Financial Regulation. Our last panel was on government intervention in housing finance, and it was a very exciting and spicy panel, which one doesn't always get with housing finance. We're excited to follow that up with a panel on federalism and financial regulation. And I have to admit, having put together this conference, it's a bit like choosing your favorite child, but I've been excited about this particular panel all day. When we talk about the complexity of the financial regulatory system, particularly in DC, we often focus on the intricacies of federal regulation. But that's far from the only financial regulation at play in our federal system. State regulations impact banking, securities offerings, payment systems, and more. From questions of the dual banking system to preemption to regulatory competition, federalism looms large in our financial regulatory system. So what should the balance be between state and federal? And what are the trade-offs? That's a wide-ranging conversation for sure, but we've put together an excellent panel of folks equipped to shed light on those questions. So I'm excited to introduce John Hill to moderate this panel. John is a senior reporter covering banking and financial services for Law 360, and I'll turn it over to John.
Thank you. Yes, good afternoon. I am John Hill. I'm the senior banking reporter at Law 360. I'm pleased to have the privilege of moderating this panel today on federalism and financial regulation. We do have a great lineup of experts here to help us talk through some of these issues that Jennifer laid out. I'd like to introduce you all, but first, just as housekeeping, they're going to give short opening statements, and you also will have a chance to submit your own questions. I'll ask my own, sure, but you'll have a chance to submit your own online through our website, the Cato website, Facebook, and YouTube, or on X using the hashtag CatoEcon. Questions will be answered following the conversation of the panelists here, and you are able to submit questions in person here. The audience here, you'll have a microphone, I believe. You'll have a chance to do that if you want. Stay tuned for that opportunity once we get there. But to go ahead and introduce our panelists, to my immediate right here, we have Roberta Romano. She is the Sterling Professor of Law at Yale Law School and the co-director of the Yale Law School Center for the Study of Corporate Law. Her award-winning research has focused on state competition for corporate charters, the political economy of takeover regulation, shareholder litigation, institutional investor activism, and the regulation of securities markets and financial instruments and institutions. To her right, we have Joanne Needleman, who leads the Financial Services Regulatory and Compliance Practice at Clark Hill PLC, where she advises banks, fintechs, and other financial institutions on regulatory compliance matters at the state and federal level. She's a past president of the National Creditors Bar Association and a former member of the CFPB's Consumer Advisory Board. To her right, we have Penny Lee. She is the president and CEO of the Financial Technology Association, which represents leading fintech innovators who are shaping the future of finance. She's also the co-founder of K Street Capital, a DC-based angel investment group. And finally, to her right, we have Julie Hill, the Dean and Wyoming Excellence Chair at the University of Wyoming College of Law. Previously, she was a faculty member at the University of Alabama School of Law and the University of Houston Law Center. Earlier in her career, she represented large financial institutions in private practice in DC here. Her work focuses on the unwritten rules of banking regulation. So, Julie, why don't you lead us off?
So, of course, when we're talking about federalism, we're talking about a dual system of banking that has federal charters and state charters. And so you might think that in a system like that, the states have wide latitude to do what they would like with the banks that they decide to charter. I'm primarily a banking person. But that's, of course, not exactly the case because, just to take two examples, one, the Federal Reserve gets to decide who gets access to its payment systems, and a bank without a way to move money isn't much of a bank at all. And then second of all, FDIC insurance for financial institutions is almost ubiquitous. And so if the FDIC doesn't want to allow a new financial institution to have deposit insurance, that sort of forecloses the possibility of a state charter too. And so we have this dual banking system, but we have federal law and federal regulators that are essentially a check on much of what states might want to do. And this isn't just an academic exercise, or it could happen, a hypothetical. It's something that it has actual implications for states as they try to innovate and to address unique areas of concern in their states. For example, the Territorial Bank of American Samoa was chartered by the legislature there in American Samoa after all of the financial institutions, commercial financial institutions, left American Samoa. And the bank there spent months and months trying to convince the Federal Reserve that it should be able to have access to Federal Reserve master accounts so that it could actually transact business and move money to the United States mainland. They still don't have deposit insurance. When Colorado wanted to charter credit unions to serve the marijuana industry, both the Federal Reserve and FDIC said that was a bad idea. And when Wyoming set up its special purpose depository institution charter to allow cryptocurrency custody with 100% reserve, again, the Federal Reserve said that that's a bad idea and we're going to veto you. And it's not just the veto over state that has federalism implications. There's been this long debate about what federal charters should be. Should national banks or national charters be national favorites, such that when they compete with states, they always win? And we heard some of that this morning. In fact, I think we heard one commentator say, well, the states ought to just go away. I think that there are probably bankers in all 50 states and many of the territories who would like to differ. But then there's the other side, that maybe what national charters are supposed to be are just competitive equals. And we see this debate emerging in the latest Genius Act. So it creates a federal charter for stablecoin issuers. States can also have their charter, but they have to be the same. And so you say, well, maybe that's competitive equality. But on the other hand, the federal charter gets set up first, and then the states get to start their charter after that. And so maybe the practicalities of the timing have set up a system where we really have a national favorite. So anyway, I think there's lots of issues to talk about, some of them new, emerging, and exciting, but some are issues that we have kicked around in banking for 100, maybe even 150 years.
Wait, Penny.
Oh, well, thank you all, and I appreciate everyone for staying here for the last panel. Always appreciated. As John said, Penny Lee, President and CEO of the Financial Technology Association. We represent financial technology, fintech companies that hopefully most of you have in your wallet and use on an everyday basis. We represent, I would say, I always have to caveat now, especially since Genius passed, we do not represent the crypto industry, but we represent the traditional fintech industry as such. So we are, 8 out of 10 of Americans do use a fintech on a daily basis. We are the companies that allow you to split your check at dinner, be able to walk out of a ride share and not having to pull out a wallet, to be able to facilitate an incredible amount of lending and access to capital, commercial lending, small business, consumer, buy now, pay later, earned wage access. Some of the things that, hopefully a lot of Americans are using in a way to lead a better financial life. We see this tension, especially on the federal and state. Our member companies are without borders. We transact across state lines. We transact globally. A lot of our member companies are doing cross-border transmissions or payments, both from a commercial standpoint, but also from remittances with individuals and consumers. And so it's difficult oftentimes when you have, I know one member company was telling me recently, I think they had 202 separate different licenses that they had to obtain to be able to to have all of their products being able to function, whether that be money transmission license or individual lending license or whatever. But he was in charge of overseeing and signing off on 202 different licensees. So oftentimes our members will look to opportunities to have federal preemption, whether it be, but the United States is behind on certain things such as data privacy rights. From a federal side, AI is going to be one in which was debated during Genius on whether or not the state should put a moratorium while the federal work on things, but things that are kind of, foundational and infrastructure is ones I said I think we would lean to having the Fed, the Congress or others think about ways in which we can move inoperably, ways in which we can, while the laws are harmonization, but also at the same time want to be respectful of the states, because they're oftentimes, as these new products are coming online, they're oftentimes either have openness to sandboxes, being able to see kind of what the regulatory rigor needs to be, what a responsible operator standards that they need to achieve to. New York, I think, is an example, especially they were first on Bitcoin licenses. They were really the leading edge on kind of how, on digital assets, how to put them into a regulatory structure that I think has been a model not only for other states, but also was very instrumental in shaping Genius and also in other jurisdictions across the globe. But we always have this tension right now, especially as new products are coming online, buy now, pay later, earned wage access. We also have we're seeing a lot of movement in wealth management. One of our member companies, Pontera, is doing some really creative things and innovative things in the space of 401ks. Administration just put out an executive order allowing for greater access. However, the states are limiting some of the innovation that can take place. So we spend a lot of time educating the community, regulators, both on the state and federal level. I think overall we would love, again, harmonization across multiple state jurisdictions, and where it makes sense, especially from an infrastructure standpoint, data privacy being one, that we have, that the federal does set standards that everybody can adhere to.
Thank you. Joanne.
Thank you, and good afternoon, and I appreciate Cato for the invitation. So I think, like Penny, I've been in the non-bank world. I represent a lot of banks, but I say the majority of my practice is non-bank. And preemption has been an extremely hot topic, and it's something that when Dodd-Frank came out, it's embedded in the statute. They talk about following the Barrett Bank regime of what preemption should be. And for non-banks, it's really been complicated. The last couple, I would say the last year especially, it's kind of like, you think about it this way, every state has a speed limit. While there could be a national speed limit, every state has a different one. Well, that's easy to comply with. So if I'm in DC, the speed limit's 60, and I go to Maryland and it's 75, I can comply with that. But we're in a situation now where we're starting to see this kind of weakening of the standard of federal preemption, at least from my experience. And we have all these patchwork of states and attorneys general who want to get ahead of the curve. They want to be New York, they want to be California, they want to be North Carolina, Illinois. And it's really hard from a compliance perspective, and that's, I think there really needs to be a discussion with preemption about compliance. How do you comply? So I think looking to figure out, and it's going to have to take a lot of adults in the room to figure out who's going to set the policy, who's going to deviate from the policy, and how we're going to work together to do it. But if we continue down this path, and we're seeing it with privacy rules, we're starting to see it with AI, I'm seeing it with other consumer protection statutes, where you start having patchwork of laws, a few things are going to happen. First of all, a lot of businesses are going to leave those jurisdictions. I mean, we see this in California and New York all the time. No offense to anybody in the room from California and New York, but there are clients of mine who are making conscious decisions to leave states. That's not good. That's not good for everybody. But there needs to be an understanding of, maybe the policy gets set at the federal level and that it can be refined at the state level, but to have, I'm seeing clear opposite philosophies and regulations that are unable to coexist, then I think I think at the end of the day, for consumers and business people alike, it's going to be extremely harmful.
And just to clarify, preemption is sort of when Washington pulls rank, when there's a conflict between federal and state law, and says, the federal one will be the one that you follow. And the Barnett Bank standard you were talking about, codified in Dodd-Frank, that's the idea that the state can't enforce a law against a national bank unless it prevents or significantly interferes. If it does, prevents or significantly interferes with the exercise of that bank's powers. Interestingly, of course, we don't get an actual ruling from the Supreme Court interpreting that until last year. So, more than a decade after Dodd-Frank, and that wasn't even that clarifying necessarily.
Yeah,
so there is still a lot of uncertainty about
on
that.
Cantera. They said basically, here's the rule, but you states have to go do the analysis and then come back to us, or somebody can come back to us and say that the analysis was wrong. And that's what happened in the Cantera case regarding mortgage escrow accounts. But you make a good. I think the challenge, I will say, for Penny's constituents and my clients is there really hasn't been a determination about preemption for non-banks other than it being written into Dodd-Frank. And the gentleman who was here this morning talking about payments, I think there were some of the struggles that he was having with respect to where do I follow the national policy or their state policies. We saw in Illinois there was an interchange fee law that the legislature wanted to pass. The OCC got involved in that, and it was
also data restriction.
Yes,
severe data restrictions
That's
on
right.
what you could do with the data or how.
But only in Illinois.
But only in Illinois. That was what was
right.
Yeah.
So we're starting in our non-bank world. We're really starting to see where do we have to draw the line with preemption, and I think I'm going to speak for you for a second that we really kind of want it because it's just the nature of the type of work that our clients and constituents do to have that kind of overall policy. Now, states are always welcome to come in and make it more restrictive, and we see that all the time, and that's well within the state's rights. But when they start to actually conflict, or as I said at the beginning, make it impossible to comply, how are consumers how are they benefiting from that? So that's the struggle that we see every day.
Roberta.
So I could say a lot about this because I've written about this in another context, but that's not going to be for my opening remarks. And so my other panelists have focused on the more innovative sectors in finance, non-tech, kind of crypto, and non-banks, fintech. So I'm going to focus, though, my remarks on the traditional large commercial banks. So a panel on federalism, when we think of federalism, we think of the advantages or the benefits of competitive regulation and experimentation. Brandeis's noted remarks of the states as a laboratory. And so there are 2 points that I want to make about this. First, with multiple regulators, if exit and entry costs in or out of these regimes are not prohibitive, then regulators obtain feedback about what the regulated entities think about how they perceive or what they value in the regulation from the outflows and inflows. And when you have only one, an exclusive preemptive regulator, right, they don't get that kind of information or feedback on this. Now, there are multiple regulators in banks, right, for big banks, OCC, New York State, right, the Fed and the like. But in the most essential piece of bank regulation, capital regulation, there isn't one. There's one standard, the international capital requirements set by the Basel Committee, right? And of course, the FDC sets fees and rules for all of the banks who are participating in the deposit insurance scheme. And so I'm going to take a different approach because I think there's a problem with that piece of bank regulation, and that is when you have a uniform scheme, right, for all banks everywhere, if you've made a mistake in your regulation, or more importantly, or usual, if the regulations have obsolesced because of the dynamism in financial markets, and of course because the regulated entities will innovate so as to reduce their regulatory costs in ways that can't be anticipated, well, then when it's harmonized for all banks, then what might have been something that could have been localized ends up in a cascade of a global crisis, something that becomes much greater in scale. All right, and let me just give an example of this. So as was mentioned this morning, and most people know in this room, the Basel weights are based on the riskiness of assets. And when these were set up, partly because of government policies to want to foster home ownership, but residential mortgages were given much lower weights. That means much less capital had to be held by banks for those as opposed to corporate loans. Now, at the time, right, that made sense. Mortgages were prime mortgages. The people who got them were high credit people, and they put down large down payments, as was mentioned earlier in the panel. And so they were less risky. But by the 2000s, right, we started having subprime mortgages, right? And they're based on a different approach, not on ability to pay, but on housing rates, prices going up all the time. Right. And banks could have subprime loans. They had the same capital requirements as prime loans, but they got a higher return. And then they could securitize them and get even lower capital requirements. And so the regulations sort of incentivized banks to undertake this, and we know where that led. And there's some data, if you look at sort of the sectors in the financial industry that were not Basel regulated, those sectors did not, the institutions in those sectors did not hold on average as high a percentage of securitized subprime mortgages as banks did. So but the suggestion here is that, if you have, I've advocated that what Basel really needs to do is you want to have some way to let states engage in experimentation and deviation from those rules. Say a state thought, and state here means a nation state, right? Not a US state. So say a nation thought they'd rather have a high capital requirement that's a leverage ratio, like Tom Honig was talking this morning, rather than a risk-based system. They should be permitted to do that. Now, I've argued there are certain kinds of conditions you might want to minimize systemic risk from deviations, but you want to sort of bring in or try to bring in some regulatory competition into that system to sort of limit, as I said, sort of the issue that harmonization could have actually contributed or exacerbated the global financial crisis in terms of its scale. That doesn't mean banks won't necessarily all do the same business model anyway, but the regulations sort of incentivize them or provided like a note, this is what you might want to do. So that's my first point. The second point that I wanted to raise is a mechanism for mitigating the fact that we don't really have competitive regulation in this system for the banking regime for large banks, is to adopt the procedural mechanism of sunsetting. So what do I mean by sunsetting? That means after some number of years, right, regulation, statutes, and implementing regulation needs to be reviewed or revisited. So in the work that I've been doing lately, I've focused on crisis-based legislation in response to financial crises, because that's the setting where there's very little information about what contributed to a crisis and what the remedies are. And as was mentioned this morning, right, you're working on the last crisis, and so you have problems that can come up with the legislation. But the argument about sunsetting is so that we're going to revisit it. Now, there were many suggestions this morning about doing review, and in fact, in the Obama administration, the OIRA agency said, all new regulations, we want you to sort of put something into the regulation that says how you're going to evaluate if it was effective. People who have looked at that found the agencies didn't do that, and what you need is bite. And so sunsetting gives bite to requiring revisiting, because if you don't do anything, the regulation or the statute is just repealed, right? So you have to do something, whether it's just you have to readopt it, whether just as is or in light of information that's come out over that time. If we had regulatory experimentation, the kinds of things that Commissioner Pierce was talking about with the sandbox or beaches kind of idea, that gives you more information about what's the effect or how our policy is working. And so sunsetting can do that. I was going to give it as my example. So Congress sometimes does revision, but it takes a long time. I was going to use Glass-Steagall as my example, but actually we had examples from the last panel about GSEs, right, or Chairman Hill about 2018, they started on this. So it takes a long time, right, for Congress to respond. And the benefit of sunsetting, if we're worried about accountability of regulators and the like, it forces Congress to reevaluate this. It puts it on their agenda immediately, as opposed to in a crisis or like years when we're lucky if there's some change in the administration or something like that. And so to conclude, I think what we need is an adaptive regulatory system, right? Because it's a dynamic system of new products, new markets, new entities coming in, and the system we have doesn't do that. And so I think in some sense, we don't need preemption, right, about this. In some sense, we need to have more ways to generate information of what's going on, right, in the system. And so I would advocate these kinds of policies I was saying. So let me say one word about preemption. So this is a little getting into this discussion. So there is another way, right, to not have to deal with 50 different states. And so this is the motto that we have in corporate law that I've argued should be extended to securities law. And that is, if you had sort of what we refer to as an internal affairs rule or a choice of law doctrine that would say, okay, it's just one government. So if I'm in Wyoming controls, and New York or Connecticut, it doesn't matter what other state you are, my Wyoming rules are going to sort of deal with your license or these other things for your non-bank entities. That's equivalent to having, one, you don't have to have 200 licenses if you have reciprocity across the states. And so that's another way to approach it. So you don't necessarily have the federal government, but this would also then retain the idea that you could have regimes that differ across the states. That could offer things for different clients, for different clientele. Not every non-bank may want the same thing, or tech companies. So I would sort of argue that that would be an alternative. Most governments don't necessarily like that because they're saying the consumer in my state can't have my consumer law. It's going to be some other state's consumer law. So there is that issue that state governments might not like that. But that would be a way to deal with some of the issues without necessarily saying it has to be just one regulator. Yeah.
So on your point about harmonization, it sounds like you're describing sort of a parallel of what you have in agriculture, where monoculture and the concern that if you have one field of crops that gets a disease, then they all get wiped out unless there's diversity within that.
That's right, just like the ecology, yeah.
So you were talking about prudential requirements, like capital requirements for banks. When you say states, you are, to clarify, talking about nations as opposed to having 50
when Basel,
states.
I was talking about nation states. But just now I was saying sort of for the U.S. model, where we're talking about fintech, that could be states. So I've argued for in securities regulation, let's take an example. So now it's preempted, right? There are state regulations, but the federal rules are going to dominate over a state rule. But if you had the same system we have for corporate law, for securities law, that could be a state, that could be a foreign country. If you wanted to have your shares issued in Spain rather than the U.S., or if you want them in New York, right, or something like that. I would argue it could be either of them. But you're right. What I was first talking about for capital requirements, that would be like the U.S. versus the U.K. or some other country. It's certainly true. The U.S. is very dominant on the Basel Committee, and one could say we get the rules we want, more or less, in Basel. But
well, and your point about sort of sunsetting regulations, federal regulations automatically after a certain period, how would states respond in a situation where you might have regulations sunset that they don't really have an ability to replicate themselves? Something like a prudential rule at the federal level that just doesn't get reauthorized in time. How would
so to have sunsetting be effective, you have to have a certain set of things embedded into it. So number one, you actually have to have the Congress to be informed. So you need like a blue ribbon panel of experts that review this, or they're generating information so they can give them information. You'd have to have it on something like a reconciliation process, so you can't have filibusters, so there's a time frame in which it has to be considered, that committees can't block it, right? So you have to have it on a pace so that when we know this is the period when they expire, you can't have someone just block it so it gets expired. Now, I assume for most of these things, this could force actually more compromise, right? Because no one's going to want there to be no regulation at all, so they're forced to sort of do something. And hopefully they're informed, so we've now got information about sort of the unintended consequences that I guess Ed was talking about in the other panel. You've got more information about that so that you can revise the pieces of the legislation that aren't working as effectively, or just they might have worked 5 years ago, but now the market has changed and you need to do something else. So that's the kind of idea. Some people think when you say sunsetting, the real goal is to have no rules anymore. And the idea is that you could get higher quality rules if you have that being done. But you're right, you have to set it up so that they can't delay, so that there's a vacuum. Right. So if and you could have an extension, right? So if we don't have time, so we'd extend it for X number of months or a year till we have enough information, so we could do something about the rules.
Interesting. So Penny, you were sort of talking about changes in the provision of finance to make it more borderless, more digitized. I'm wondering if you see sort of federalization as kind of a natural endpoint of a lot of this regulation when things do become so interconnected that it becomes difficult to have 50 states doing that. You know, I think Aaron Klein would probably disagree with me in saying there is no such thing as a natural endpoint to regulation, but do you think there is sort of a trend in that direction?
Well, I would say there is a trend, and I think that there is a recognition, again, that these are products that are being used digitally. You're not going physically to a bank. You're not, you know, having that relationship like you used to, and when everything is on your phone, it doesn't matter what part of the world you are in, as long as you can be able to transact, that is going to work, and that's where you're going to do your, you know, have your financial life. And so with that, you know, I always joked it shouldn't matter. I know we're in DC. You know, you shouldn't matter if you're going across the 14th Street Bridge to Virginia or the American Legion to Maryland. You should be able to have the same kind of you know, experience that you have on your app, irrespective. Instead of either governs or jurisdictions. I mean, a 5-minute walk across a bridge shouldn't make that determination. So I think there's a recognition on the from a lot of members in Congress to try to take a look at some of these things that do affect it on a global or, you know, domestic side. But as we all know, and to Roberta's point, it was interesting on sunsetting, we think we've tried now for 10 years to get a data privacy rule, and we're still not there. And one of the biggest issues is not wanting to preempt California. California has probably 56 members in the House, very, you know, and it is a very difficult voting block to move around when they say our standards are the best and we don't want to lower anything beyond it. And so that's what's, you know, along with a whole host of other issues, but that has been a real sticking point because California was first on kind of how you deal with data in particular. So, you know, we also, but, you know, to the point on sunsetting, I think that's great and it's ideal, but do worry, you know, we're in a situation right now when every time you change administration, there's a full review of rules, there's a full review of, you know, Congressional Review Acts repealing, there's withdrawing of rules, there's getting, you know, letting them aside. And so you're in a vacuum right now. And you have to have, for businesses to operate, you have to have certainty. And so without mandatory deadlines, without mandatory, you know, I don't know how you get around, someone who worked for the Senate, I don't know how you get around the 60 vote threshold, you know, on mandatory rulemaking or mandatory statutes on that piece of it. But otherwise, you're in where we are now, which is on some issues, we have this ambiguity that is allowing individuals to work in anti-competitive behaviors. They're working, you know, with their own kind of knowledge, or they're stagnant because they do not know what to do and they don't know where the rules actually sit. So they're just stagnant right now. So that's my only issues with sunset is there has to be a foreseen mechanism. I think it's good to review. The private sector will always require you to review because we will always be out innovating regulation. But what's not helpful is to be in this ambiguous setting without clear rules because everyone to its own could be detrimental.
We've discussed a few examples of state-federal conflict. So you have the escrow interest law in New York that was the Supreme Court case. You've got the swipe fee law in Illinois. You've got fair access laws in some states, something called the DDIMCA opt-out, you know, the idea that you can ban states from, or lenders in other states from exporting their home state interest rate into your borders. But something like, let's say, the mortgage escrow interest law probably isn't going to be existential for the mortgage industry writ large, you know, if states are able to charge those fees. There are, in fact, some states that require banks to do it, and banks do it. But where are you seeing instances of states trying to assert themselves, states trying to regulate, maybe pass laws in a certain area, that you do think have a lot of chance to have consequential stakes for the future development of a particular product or service area? Something like maybe buy now, pay later, that is in a nascent stage that you really need to watch out about what you're doing now to be able to ensure that it can flourish properly.
I mean, I can answer that from a almost a supervision enforcement perspective. I had a situation last year. We represented a non-bank entity for a multi-state NCFPB exam at the same time, 7 states and the CFPB. And most examinations on non-banks are focusing on their compliance management systems, making sure that the roadmap of how they're engaging products, they're following the law, they're managing risk. The CFPB came in and looked at this company, and they don't do a CAMELS rating, but they do something similar. Everybody kind of hopes for a 3. You're not getting a 4 or 5. I mean, you know, you hope you don't get a 4 or 5, and you're never getting a 1 or 2. So this entity got a 3, which was fine. The states came in, looked at the same data, looked at the same programs, and gave them a 4. How do you reconcile that? So to your question and your point, how is that going to impact? How do we know what we are supposed? How is an organization or entity going to know what they have in place is appropriate? Is it going to pass muster? If I'm trying to satisfy 50 different chiefs, that makes it really difficult, really, really difficult. To your point about sunsetting, I think it's a wonderful idea. They did it in more. If you remember, it was RESPA.
Yeah.
There was going to be a sunset of, I think, the mortgage debt to mortgage ratio.
This to do with TARP.
Yeah, and you know, everybody started hand-wringing about it, and at that time, I think Kathy Kraninger was the head of the CFPB, so she kind of punted it a little bit. I think what you're saying makes a lot of sense. It's just, again, we're going to be the adults in the room to really enforce it, put the politicalization aside, and try to, and do for the greater good as to what these regulations can be.
Well, that's why it has to be. You know, but you know, the state of Texas actually sunsets every single administrative program and agency on a periodic basis. Okay, now, I guess they're not quite as polarized as Congress, but you know, there's a study by Curry and Lee that show, like, even though we think Congress has massively polarized from, like, say, the 70s, they actually pass the same amount of laws, right?
And,
they're bipartisan.
They're only in session every other year. So maybe there's something to that. Just kidding.
But I do think that sort of if they only had to deal with one state, right, and not all the other states, right, and you know, the consumers in your own state will be protected because they've got consumers, the state that would be regulating, whether it's Wyoming or New York, they've got their own consumers to worry about, so why would they have laws that would hurt the consumers in another state? It would be equally hurting their own state. So
John, to your
I think
point,
I don't know if that would be easier to get them preemption. Maybe, you know, Congress maybe wouldn't want to do that because they want control, and so maybe they would like preemption better than the states, but it would deal with the 56 people from California.
Yeah, exactly. You know, it's one product that is kind of, you know, is earned wage access. And right now you have 14 states that have put together a regulatory system, does not define it as credit. You have other states, Connecticut and others, that are defining it as a credit product. And then you have, you know, the politicization, I would say, a little bit of the CFPB, where you had, you know, rescinding a 2020 order, an opinion order, the rescinding of the rescinding to issue an interim, proposed rule. And then that got rescinded by the Trump administration, but now state attorneys generals are using the proposed rule as one in which they can now bring enforcement against, even though it was never enacted, because their state doesn't have it. And so it's like this really hot mess around earned wage access. And so, you know, we're working on a federal bill to codify what this product is at that federal level so that everybody is consistent, because pulling out of one state because they've changed their definition, only being operated into another when people, again, their funds are fungible, is very difficult.
So what you're describing there is a situation where states are, you know, stepping up, let's say, or, you know, being more assertive on a particular product area, and they are trying to create a regulatory regime that fits for them. And then that creates, it elicits a response where then there is a federal overlay that comes in possibly on top of that. That dynamic, does that set states up for a catch-22, particularly in things like charters and all, where you can have a state migrate, or an institution migrate from a state to federal charter, where essentially if any time they try to regulate in a different way that goes against the grain from the entity, it encourages increasing federalization. So they lose power either way. Is that sort of the dynamic you're seeing?
Again, it goes back to what I was originally saying, is just some consistency, especially in these new products. Like, you know, in 2020, it was defined as a non-credit product. In 2024, an opinion was changed, and it said, no, in a proposed rule, you're now going to be a credit product, and we're going to rescind everything. 2 months later, that got rescinded. And so it's just, you know, there's just at some point someone, you know, needs to be, quote unquote, the adult in the room needs to say whether it's on the federal side, because otherwise the patchwork of states is going to continue on this particular product. Just an example of one. And we see it in multiple ones.
Julie, you made an interesting point earlier about cannabis banking and like, access to the Fed payment system earlier. It feels like you're describing almost hidden preemption, where it's like that there are these federal regulators that have the ability to kind of stamp things out at the state level through gatekeeping powers that they have that are separate from just whether there's a straight conflict in set of regulations. Are there other examples you can think of where you see this ability of federal authorities to curb state regulatory impulses?
So I think I mentioned a couple of the others. One is states or municipalities that want to charter banks, and the federal government just said, we're not into that. We think it's too fraught with corruption or mismanagement. That's one area. Another area are these sort of unique charters like Wyoming has for special purpose depository institutions. You could see the same thing with stablecoin before Genius, right? But I guess I wanted to comment on, you know, I think you kind of have to be a little careful what you wish for, right? So with fintech, and whether you consider it, you know, fintech classic or fintech, you know, 2.0, whatever it is, you've got to remember these are not banks. And so when you're talking about dual banking, this is sort of outside of that. And so you're largely looking at a regulatory structure that lives in the states and has no federal equivalent whatsoever, right? And so these are types of activities that either are related to activities that the states regulated before or are wholly new and only the states have taken some action on now. And so I'm certainly sympathetic to the idea that it is not efficient to have 50 different rules, some of which conflict, and that is hard for businesses that want to operate online or across borders. But you have to be a little careful what you wish for because, well, lots of reasons. One of the reasons is if you're completely dependent on who's in the White House, that changes, and we've seen that approaches to especially consumer protection things vary widely depending on who's in the White House. And I don't know that it does fintechs broadly any good to have, you know, consistent rules that change wildly and might disrupt your business practice, you know, every 4 years. And you might be better off to have to deal with the idiosyncratic approaches of various states, because then all of your eggs aren't in one basket that changes wildly. I also think that we saw some hints of this, right? I mean, you were talking about a fintech that was having an exam that was 7 states and the CFPB. That suggests that those 7 states have managed to get themselves together. So now you're not at 50 states, now at least you're down to 43, you know, because you've got 7 that can agree.
Well, let me clarify. Each of the 7 had a different opinion.
Well, I mean, I do think
yeah, I hear what you're saying.
I do think that one of the things that the Conference of State Bank Regulators is working on is states are not, at least most of them, I think California we could leave out, and maybe perhaps New York too. But I think most states understand that it's not in their interest to have such wildly divergent practices and requirements that we drive people to be begging for federal regulation and oversight. And so I think that one of the things that we're starting to see more and more is states trying to think about how they can get together to make it so that while they have some autonomy, they're also not making it so that we can't have the types of financial products that the people in their state have come to know and love, right? And so I'm really hopeful on the state side that while different states have different ideas, that we're moving to a place where states recognize that there has to be some way for managing just the massive mess or cluster that can come with 50 wildly divergent rules. And I think you're always going to have a few states who say, well, we're bigger and more of a state than the rest of you, and so we're going to do what you want. You see this with the CAFE standards for vehicles. California doesn't care. But you might well have the same thing with preemption, right? Because I think California's position is going to be, well, we can always require a higher standard. So, it's not even clear if you have preemption, if that's the standard or if states can still have a more restrictive standard.
Roberta, you were talking about a choice of law, being able to select the state whose laws you'd want to operate under. Does that kind of also introduce the monoculture risk if you have, let's say, everyone choosing Delaware and then, whoops, it's body of law?
Well, except if Delaware gets a lot out of line, which we saw recently in a set of Chancery Court cases that drastically changed sort of the traditional role of a judge with respect to looking at business decisions, you get companies starting to look for another state. In fact, the legislature stepped in and reversed some of those opinions. So I think
your strategy would preserve that ability to move within.
Yes, so you need, as I said, you need to have exit and entry that's not at a prohibitive cost. And so then you'll get that feedback effect and generate information about different policies. So I think that's important. And then, the other thing is when you have it that way, sort of the policies bubble up from the grassroots of the entities, right? As opposed to when you have one, it's just coming top down, right, from that state. Or not necessarily one, but you have California, right, as opposed to all 49, right, or something like that. So I think that you have some built-in protection. Obviously, so people worry about, okay, in corporate law it's a little different because the regime is really directed at the people who choose it, which is the shareholders. Right? And banking is a little different, right? There's externalities to the taxpayers because of our deposit insurance system. And the rules, if it's the bank choosing it, we have there are other kinds of issues at stake that make it a little more different. But in part, these are political choices from our democracy, right? And people get, if you have quality leadership, that's not a problem. And, people get the leadership that they vote for, right? So that's sort of the other sort of side of this, right? In these areas. But I think that's how I would respond to it. So, it's certainly true that Delaware is kind of like a uniform law, that so many companies have it, but it's not. It's actually only about 50-odd% of the New York Stock Exchange. It's still a lot. And if you look at IPOs, it was much higher. It was like 99% of IPOs chose Delaware. But there are some states, in terms of absolute numbers, right? California and New York, because they're big states, have a lot of companies in their states. Right. But, that's not to say that a lot of them don't move to Delaware when they can, right?
Joanne, as a practitioner, you were just describing your experience with exams, the disconnect between the federal and the state approaches. Is that getting worse? How is the trend from what you've actually been seeing with your clients?
It's getting a lot worse. I think, again, in my world with the CFPB being neutered, for lack of a better word, states are really feeling empowered to chart their own path, set their own rules, set their own expectations, and it is really difficult for businesses, and these are not large banks that have real risk departments. They don't have the infrastructure. They can be anything from a small payments company to debt collection to mortgage servicers, you name it, and everything in between. And they've spent the last 10 years building these infrastructures and being told that they have to manage risk a certain way, which was not in their psyche before Dodd-Frank, but okay, they did it. Now it's coming back rather than having one playbook, which we all had in our offices and binders of what the CFPB exam manual was. Now we've got to kind of piece together. I don't have a written exam manual for California. I don't have one for Idaho. I don't have one for New Mexico. So they, now again, granted they have borrowed from the CFPB, but they have different expectations that are not articulated. That is really, really hard for a business to allocate resources, especially, and these are all, for lack of a better word, small businesses. So it is, and attorney generals are getting, what we've always say about attorney generals, AG stands for aspiring governor, right? So they're all looking to make their mark as well. And so it has become a very challenging environment, and I foresee that it will continue to be at least till after the midterms and maybe until potentially there's another administration. But I guess it's also, the last panel, be careful what you wish for. Everybody didn't like the CFPB. I worked with the Bureau 10 years ago. They were good and they were bad, but I do believe that there should be a federal regulator for non-banks. What that looks like is a whole nother probably symposium here. But
that's an easy one. We'll talk later.
But as I said, at least there was one playbook. Whether you liked it or not, you knew what the playbook was. Now we're going into uncharted territory, and it's going to become a serious drain on a lot of businesses. At the end of the day, it's going to really hurt consumers.
Can I say one thing about, I should say, Delaware does have a competitor, and it's called the Model Act. And so it's, as you're saying, sort of groups together, small states, right, who don't have the resources and don't have the courts and the like, they follow something called the Model Business Act that, you probably know about it, the corporate section of the bar, does the rules, and they're not always the same as Delaware. So it's an alternative system, so it's not completely monoculture.
Well, I want to work in some questions from the audience, both online and here in the room with us. This is sort of picking up on your point there. Model uniform state laws, like the Uniform Commercial Code, generally seem to be of high quality as compared to federal or one-of-a-kind state laws. Could this be a better option than preemption?
Well, that's partly what I'd say, although I would argue that not necessarily all the states need to be part of the Uniform Act, but that certainly is an alternative to it, right? As is reciprocity across the states so that an individual state too, but I think Julie can talk about that more.
Well, I would say, I think that uniform laws are interesting and useful. One of my favorite examples recently from uniform laws where it was sort of unclear under the old UCC how you take a security interest in digital assets. The Uniform Law Commission considered and sort of decided it was too early to act, so Wyoming made its own law. And it started attracting people, and then lo and behold, the Uniform Law Commission decided we probably needed a law like that. And so I think that there is opportunity, even among the states, to kind of get to a good place, because when one state can innovate, everybody has to decide, are we coming along, or is this not going to work out?
Do we have any questions from the audience in the room? Yes, go ahead. We'll have a microphone coming over to you here.
Sylvia Singleton with Cato. So there's a tendency when one starts drafting a federal law that's going to be preemptive in talking about the most regulatory states like California or New York as if they are the leaders. And I think it's worth really questioning whether the first to regulate, the most heavily regulatory, should necessarily be perceived that way. Maybe the states who have not regulated are in their own way leaders. I was wondering if anyone could kind of comment on that assumption in sort of putting together federal statutes.
Well, I can make an analogy to corporate law. Delaware, which we think is the leader state, is not always the one that comes up with the first solution. So let's take one big example, which was when they allowed companies to limit the liability of their directors for personal damages for negligence. This was in response in the late 80s to a so-called D&O insurance crisis. And they weren't the first state to act. Actually, there were two other. Indiana went first, and it adopted a gross negligence standard. And then another state adopted a limited liability statute, and Delaware actually went that route. And there was a third state, I think Virginia did like a damages rule. So it's, often a pioneering state, but sometimes, and so consistent with what you're saying, sometimes you might want to see what other possibilities are when you're choosing it. I assume that the reason why people focus on that is to say that there's a view that if the federal government has a law, the states can go above it, but they can't go below it in the standards. And so that's probably why people would talk about a leader.
Yeah, I think it also depends on who holds the pen. I don't think French Hill would be as adherent to maybe a California and or New York, although I do know on the Genius bill, they did consult with Adrienne Harris in California quite a bit to understand, in particular Adrienne Harris, to understand kind of what lessons they've learned. They've been at this for a lot longer. What would they possibly change? Some they adopted, some they did not. I know there was a couple of issues that DFS would probably have objected to that ended up in the final Genius bill. And so it would be hard to react to a state that hasn't acted, because you don't know exactly where they're going. And so a lot of it, especially on the federal side, depends on kind of who has the pen. But I do think that your point is well taken, but I think there's lessons, if you can take the lessons from a regulatory, whether it be overly restrictive or, barely, what have you seen? How has the market changed? What is the data behind kind of the use case on this? Have you seen a rise in, delinquencies or something, nefarious behavior, or has these laws settled certain things and there's a great robust sector provided? So.
And on that, I was trying to think if I could think of any examples of laws where the preemption was there is no law.
Yeah.
Right? Or there is no regulation on this. And I was having a hard time coming up with one, but if someone else has one, I'd like to hear it.
I'm lost too. But another sort of assumption, the idea that preemption tends to weaken consumer protections. That's often, of course, you are preempting a state consumer protection law, and therefore you have a lot of consumer advocates who tend to oppose preemptive regimes. Is that assumption accurate? Can you comment on how that assumption actually ends up playing out as far as making policy? Should consumers fear preemption?
I mean, certainly there are federal laws that preempt, right, like the minimum leverage ratio or whatever that are designed to, prevent or protect consumers, right? So that are designed to prevent the worry about states racing to the bottom, right? So I think bank capital rules are meant to fall within, I mean, we can argue about whether they actually do, but I think that they're meant to fall within that umbrella. I think that the reason that consumer laws often get trotted out is because banking laws were originally written, just to keep the banks from taking people's money and going broke, right? So they were focused on credit risk and market risk. And so it wasn't really until later that we started to worry about business practices. And again, it was states that came up with them first. And so I think that's why we tend to focus on consumer laws when we talk about preemption, but really some of the very first preemptive acts in financial regulation were designed to keep financial institutions safer and to prevent state laws from being more lax, I think.
I think consumers are better protected with preemption. Because I think the unintended consequences, and we talked about this throughout this panel, is when you start to have different states, businesses will leave those states. Then that runs into the whole issue of access to credit. We saw in New York there was really restrictive states with respect to certain areas of debt collection. And what happened? Lawsuits ran up, like 20%. So with the ability of trying, with consumers trying to resolve debts, because it became so restrictive to do it, the creditors were like, I'm not even going to waste my time, setting up service companies, trying to work with consumers. I'm just going right to suit. How does that benefit consumers? So I think preemption from a consumer protection standpoint is much beneficial to consumers. Now, again, I remind people that preemption doesn't prevent a state from enacting any law. They can be more restrictive. They can fine-tune what the federal standard is, and many states do that. But having sort of a baseline of what the expectation, especially with consumer protection laws, which a lot of them that the CFPB had jurisdiction over were laws that had been in effect for years, having that baseline available protected not only consumers, protected businesses, allowed the financial services engine to keep rolling. But when you start to have, we're seeing this now in issues of medical debt. There are states now that are banning the credit reporting of medical debt. I don't know how you can do that when you have a federal statute that says that any state statute on medical debt is preempted. So there's going to be that battle that is definitely brewing and going to be coming down the line. I don't know how you do that. And what's going to ultimately happen is consumers are not going to get access to medical care.
Well, I thought they can't do higher interest rates. Aren't they preempted, like usury laws preempted? I don't know if that's
This is about
or
the
something.
reporting of medical debt.
No, I'm saying separately as another area.
Yeah,
Is that the same?
Absolutely.
That would be the same thing?
Yep, absolutely.
Penny, I feel like your members must have a feeling about that.
I would say that I mean, I guess, just to Joanne's point, is I do think it is good to have a federal body that is kind of laying out where consumers, unfortunately, to Julie's point, it has been the current iteration or the iteration of the CFPB, it's been too volatile to the political whims, and so you just have these incredible changes. But can you codify certain things that are in statute that can be more durable, that can be more enduring across the political winds? I think that's where we would land, is whatever, working to now think through what was being left to interpretation, what is subject to every 4 years of a pendulum swing. Can we now go back to Congress, clarify certain things, make sure there's written, understanding within statute? But to that point, I think it is beneficial oftentimes to have the federal preemptive kind of standard. California and others can be more restrictive if they want to, but at least there's a baseline consistency of, FCRA, there's a baseline consistency, no discrimination, no red laws, there's a baseline there of how the consumer should expect their interaction with the financial product.
Yep. Any more questions from the audience? Yes, we'll get you the microphone here.
Good afternoon. It's just a late time. My name is Peter Gabriel, and my question is like in the product sector, like there is industrial classification, like a product is, there are standards followed throughout. So like a product, whether it's electrical or a car or anything, there are standards that are throughout the same, I believe. So I'm not quite an expert about the federal preemption, but I'm assuming that it will help standardize the services, the kind of services that are provided by the fintech, and that they have to be followed. So I would think that would help states also to adhere to those same standards, which means provide stability and predictability to the services. So the consumers would benefit, but also the businesses would also benefit from predictable and stable rules and standards.
I would agree.
I think you've got agreement here on the stage.
Yeah.
And just very quickly, finally, are there areas where you see the absence or weak preemption as more tolerable than others? You mentioned like AI and data privacy there's an important need to have kind of consistent federal standards. Are there areas where there's sort of the inverse of that, where it's like, it's okay to have more experimentation here?
Yeah, I actually think some of our, what has been helpful is to have some of the states have sandboxes and to be able to have innovation offices. I know California got hit a little bit, but they have a great innovation office. and we meet with them regularly, trying to explain the product. They have a very rigorous rulemaking process, which they adhere to. Some of the outcome might not be exactly what you want, but the process is something, it has a lot of rigor to it, and which you appreciate, that they've taken time, they're studying the product, they're learning about the product, they want to know more about the product. And so there's oftentimes, which we appreciate, is the states that are willing to engage before the product becomes a massive giant. Like, they understand how to get some regulatory rigor behind them, whether that be just in money transmission licensing, whether that be in just how do you do compliance, even at a smaller scale. So I'm not here to say that states should be banned like they in a previous panel, but we want to make sure that there is, again, we would always prefer a consistency across the states, and appreciate what CSBS is doing on money transmission license. They have model bills. More states are adopting the model bill. It's one exam, one license, so you can have that consistency. Would love to work with CSBS and others to develop more of those kind of states, and territory, Districts of Columbia kind of model laws to be able for that consistency.
Well, we are at time. Thank you, Julie, Penny, Joanne, Roberta. Thank you for joining us today. We will now hear closing remarks from Jennifer Schulp.
I said thank you all. That concludes today's Right-Sizing Financial Regulation Conference. There was so much to cover. We barely scratched the surface. I think this panel alone suggested several other panels and conferences that we could have. So we hope that you'll continue to join us as we continue these conversations. If you missed any part of today's conference, the recordings will be available online. If you'd like to share any part of today's conference, the recordings will be available online. We hope that you'll follow the work of Cato Center for Monetary and Financial Alternatives. We have a team here, including Norbert Michel and Jay Kadia, who spoke today, and Nick Anthony and Solveig Singleton, who are all focused on right-sizing financial regulation in its many forms. You can find us on X at Cato CMFA, or look for our work on the Cato Institute's website. I have a few thank yous to give because it takes a lot of work to put on a full-day conference. I'd like to give a special thanks to Anne Rulon and Hope Hoshi, who helped me put together the conference here, and a thank you to all of the Cato Institute staff who helped make this event happen, from our events staff, especially Ryan Moore, to our audiovisual team here in the auditorium, Jonathan, David, Darren, Cecil, Alcid. I think that's everyone, but if I missed someone, I'm sorry. To our marketing team, to our facilities team, it's really a group effort to put on something of this size. Thank you very much. Again, thank you to our audience for joining us today, for all of your great questions and engagement. Please continue this conversation. It's an important one, and we don't want to let it drop here. If you're here in person, please join us for a reception out in our winter garden. And if you're here online, please continue to follow us. And we hope to engage in these conversations more in the future. Thank you.